futures at limited capacity, and engineers are working to restore that capacity. You're going to see on our ticker below, there are some prices there, but anything that has a half moon on it, you see that little blue half moon beside the Dow futures and now beside the NASDAQ futures, any of those are currently closed because of the data issues. So these are not real-time accurate prices that are reflecting what's happening in the broader markets. What you do see right now is the Nikkei, the Shanghai, those prices are correct. Those are still trading. Bitcoin is still trading as well. But again, most of what traders are going to be interested in, as the S&P futures, as you can see at the bottom, those are not accurate reflections of what's happening in the market right now. We're going to show you some of the moves in the large ETFs that track the indices. Based on those proxies for the markets, we could see fractional gains for stocks at the open, and we probably should point out for you, too, that just before futures went down, it was looking like things were positive, pointing to positive futures moves. I think the S&P futures were up by about 0.1% before that went down. And here's what you see right now in those major ETFs that tracks things. Invesco's triple Qs, that's up by about 0.4%. The SPDR for the S&P 500 up by about 0.25%, and the SPDR Dow up by just fractionally, just by less than 0.1%. We will continue to follow all of this, but guys, if you were looking at what happened last week, things were looking pretty good for what had been a relatively weak market, or weak month for the markets. Last week, you saw the Dow, the S&P 500, the NASDAQ 100, the Russell 2000, and the Dow Transports, all posting their fourth straight session in a row, and it really turned around the markets that had seen so much weakness for the month of November.
You're looking at a pretty down month for November. It's the first time we've had a down month in November in a long time. It looks like it'll still be down, depending on what happens today. Now, today is already a low volume day, so this could be a little bit choppy if these futures issues don't get fixed right away, particularly in the Treasury market. As Steve knows, we're still riding the Williams rally, which was based on, John Williams saying that look, we probably likely should have a cut. And that's what really sparked that 4-day rally after questions about the AI trade. So if the futures are unsteady today, or there's wide spreads between bids and asks, it could be an interesting
I just want to say thanks for having me in on a day when nothing's working. I mean, I haven't done it for like a year, and you have me in and nothing's working. I mean, it's all right. I mean,
there's no correlation.
Welcome to the big leagues. We're going to throw you right into the heat and the fire.
I know, and they got some sort of half moon symbol. I mean, what's up with that?
Yeah, the half moon symbol, again, for anybody who's just waking up, and we'll repeat this throughout.
Thank you.
If you see a half moon near the symbol, it means that is not active in trading. But I'll tell you, just about most things that people care about are not going to be
And
traded.
you feel good about these ETFs as proxies? They're okay?
Perhaps. I mean, I won't say I follow.
Why don't we just show the Mag 7? I mean, the individual stock futures are trading. We should point that out.
Right.
And since the Mag 7 have been driving the market, there has been a bit of broadening, but I think would be useful if we start showing those tech stocks, because those are the ones that have really driven.
I know this is pathetic to ask on national television, but when I'm looking at this 10-year at 3.99, is that a real quote?
I don't believe so.
You don't think so?
I don't think so.
And my Fed probabilities aren't working.
No,
I don't know.
Fed futures are not
All right,
trading.
so the only actual thing to do is to talk to Dana Telsey, who has actual information.
That
We're
could
going to
be
get
where
there
we
in a
start.
second. I've got to read this story. Developing story. One of 2 Guard members shot in a targeted ambush shooting in Washington on Wednesday has died. Sarah Beckstrom was 20 years old. She began serving in the West Virginia National Guard in June of 2023. President Trump said she died of her wounds last night. The other guardsman was identified as a 24-year-old Andrew Wolf. The president said he was in very bad shape and fighting for his life. The suspected gunman, Ramanullah Lakanwal, was also shot and taken to a hospital. The CIA said he's an Afghan national who worked with U.S. forces during the war in Afghanistan. Late last night, President Trump posted on Truth Social that he is, quote, permanently pausing migration from all third world countries. He also said he would end all federal benefits and subsidies to non-citizens.
We don't know what that means, right? What does the freeze mean? Which countries are...
The Wall Street Journal already editorializing against this move by the president. I mean, this gentleman, this terrible person who committed this was working for the CIA in Afghanistan, and the Wall Street Journal pointing out this morning that is not helpful for U.S. forces that will eventually go in. There are many Afghans who have come back because they were in danger for staying in Afghanistan. Of course, by the imbroglio, perhaps we shall say, for how Biden exited there, but you still had to bring back these people.
Meanwhile, Russian President Vladimir Putin's breaking his silence on the peace plan that was proposed by the U.S., saying Moscow is ready for, quote, serious discussions. He said that the plan could be the basis for future agreements, but no final version exists yet. And he confirmed that U.S. envoy Steve Witkoff is expected to visit Moscow next week and meet with Putin. A lot of intrigue over the past week about who leaked it and whose motives, and whether this will really throw a wrench into the process. But this could be interesting.
Yeah, and to see if they are serious about it, because to this point it has been Russia that has been the bulwark that has kind of thwarted anything you could have going on in terms of peace talks too.
Apparently, Ukraine also said that that anything that forced them to give up sovereign territory was a non-starter for them. So it doesn't seem like the parameters of this are being embraced by either side,
Right.
we can tell.
All right, as Steve mentioned, Dana Telsey's here. It is Black Friday.
On a much cheerier note.
Shoppers are hunting for the best deals. Joining us right now is Dana Telsey, Telsey Advisory Group CEO and Chief Research Manager. And Dana, I would guess it's a little tougher to know exactly what's happening on Black Friday morning than it used to be. So many of the retailers actually close on Thursdays now instead of staying open that entire time. You're trying to figure out what's happening from the cyber perspective, which is tougher than going to the mall and maybe doing bag counts along the way. What do you think right now about where the American consumer stands?
I think overall what we've seen so far, given a bunch of third quarter earnings have been reported, more still to come, there's been resilience, and frankly, surprisingly, when you have companies like Gap talking about strength across all income cohorts, typically you hear about the pressure on the lower income consumer and the resilience of the higher end consumer. But one of the things companies, particularly just on the discretionary side, have done is newness and product innovation, collaborations, Taco Bell and Hollister, Love Shack Fancy and Victoria's Secret. We've had Martha Stewart and American Eagle Outfitters. So you've had newness in order to drive interest and demand, but definitely that lower income consumer, they are more pressured. There's a reason why. Where's the traffic been? Look what Walmart has said. Walmart's getting more higher income growth, and you're also seeing the off-pricers, whether it's TJX and Ross, talking about traffic strength. So I think there's cautious optimism for holiday. We've got a long way to go. And as you said, it's not like it used to be. 6 a.m., Macy's is open, Best Buy is open, but really it's 9 a.m. to 7 or 8 p.m. that is holiday hours on Black Friday today.
You know, that is a surprising thing, that it's not one class of the retailers that are doing well. This definitely feels like an operator's market where you have to have the right strategy and you're going to see some real winners and losers.
Yes, it's not the same for everyone. At the same time, the marketing's different, social media marketing, TikTok, Instagram stories, you gotta show up. Also, you're thinking about what consumers are doing with newness to their wardrobe. Definitely, it's not just leggings like in the past, it's denim jeans with embellishment and rhinestone. And look at the casual chef boots at Steve Madden that's showing up with brown suede, and we're lucky it got cooler outside.
So the ones who have particularly done well versus those who have not, maybe focus on who's losing in this market.
Well, we've had companies where the transformations are just beginning. I mean, Bath & Body Works is typically a holiday winner. When they project a high single-digit decline for holiday 2025, that's not winning, and the new CEO is first beginning his strategy. You've thought that department stores, I mean, it was a huge surprise on Kohl's. What that could mean for Macy's when they report next week could certainly be a positive. The statistic that 40% of Macy's product for holiday is new, that newness matters, and that's different. That should be encouraging. But if you're not capturing that consumer with social media newness, you're not going to be in the mind of the consumer today.
I'm glad you're not using the word choiceful. That is a word that I can't stand the word. It seems to be what everyone's talking about, but it does refer to the price sensitivity. And so what are you seeing in terms of price promotion, and how much margin room do a lot of these retailers have given what's happening with tariffs, given what's happening in the supply chain? Will there even be much room for price promotion?
So a couple things. I think companies, they're being very mindful of promotions. It seems like as the holiday season goes on, consumers are waiting for more promotions. Even Urban Outfitters talked about that the other day. But overall, And keep in mind, I like going to stores, I like seeing things. I was walking everywhere, taking my pictures, compared it to last year. The promotions this year so far are similar to last year. Do they have room to take price? They do, and we've been having this price tracker of 80 items since April, given tariffs and the whole tariff environment. Yes, you do see selective price increases, more are probably coming, but overall, whether it's 30 or 40% off, that's where you're seeing the promotional spigot, and it's not scary. It's something that retailers are managing. Inventory levels, for the most part, they're wearing down from the lower priced items before tariffs. That remains to be seen as we go through 2026. But even the higher end items, if it's something new that people don't have, they'll buy them. Essentials are where everyone is making sure they have enough opening price point goods. And I agree with you. I'm sick of the word choiceful.
Dan, we're almost out of time. Can you run us through your top 3 picks in
Well, I think
like a minute?
yes, of course. It's going to be Walmart. I think we're going to have a good Steve Madden season. I think Macy's is a winner for holiday. And I think TJX on the off-price side.
Okay, perfect.
David, just real quickly, when I look at the metrics of the consumer, yes, the unemployment rate is up, but a 4.4% unemployment rate means that 6% of people are employed, okay, or 95.6% of people are employed. I got wage gains at 3.8%. So wallet-wise, it's okay. But I look at the consumer sentiment numbers, and they're really pretty lousy. So how do you balance that? What's happening on the wallet side of the consumers, they seem okay, but the sentiment is down.
I think overall, a lot of times what consumers do and what they say and how they feel are totally different.
Right.
And I think when you come to the holiday season, there's always family celebrations that people want to celebrate. So I agree with you, those metrics of the consumer are still pretty
The
solid.
financial ones are the
Yeah,
ones you follow.
I watch credit card delinquencies, because
Yeah.
that's something that I'm watching closely, and I think
I
there's
watch
some
it too, but I
pressure.
don't see much really to be concerned about.
Yeah, not yet, but it's something to be
The
watching.
coming back of the payment for the student loans has affected younger people, but overall, in terms of the macro data, the aggregate data, it's not that bad.
Yeah, tax refunds are coming, and who knows if that $2,000 check
So
comes
that's a
soon.
big deal. We
Yes.
haven't talked maybe enough about that, but the way the tax law was structured, you know about this,
Yeah,
Robert.
yeah.
The first quarter and beyond of next year are gonna have a massive influx of high refunds that, are gonna help consumer.
You know, the idea behind that was because people in the first round of tax cuts in 2017, the Trump administration felt they never got credit for it because it was all sort of divvied up in single payments in their regular paychecks. And so it never became this one visible concrete check that they got that was attributable. So this time they say, look, it's gonna be a one-time check. People are gonna love the tax cuts because, yes, $2,000 is a meaningful amount for a lot of families, but I think it's gonna be a one-time
But I'm not even
thing.
talking about the $2,000 check, I'm talking about the idea that when the tax law changes, people have not adjusted their withholding for the change in the tax law.
Right.
So for example, they changed the SALT deduction,
Yeah.
and most people in those states with those deductions haven't altered it, so they're going to get, 2006 is a different story.
Yeah.
That may or may not happen.
Right.
But this other thing is just from the existing bill, they're going to be high refunds.
Right.
Dan, I know you are on your way to the stores, but thank you for stopping by here first.
Thank you for having me. Have a great holiday.
Thanks, Dana.
Chelsea.
Thank you.
Coming up, we'll talk markets ahead of this holiday shortened trading session, and we'll take a look at some big 2026 calls from major banks. Squawk Box coming.
welcome back to Squawk Box, everybody. If you are just joining us, the CME has halted futures trading because of a cooling issue at a data center. That means the stock index futures, gold, oil, bonds, foreign exchange instruments, none of them are operating or open for trading at the moment. The data center operator says that it has restarted several chillers at its Chicago data center and that engineers on site are working to try and restore capacity. But it also means that most of the numbers that you see at the bottom of your screen are not going to be operating right now. The Nikkei, the Hang Seng, Bitcoin, yes, those are all operating. But as you can see here with the S&P futures, there's a little moon next to it. The same story for the Dow futures, same story for the NASDAQ futures, and many of these other numbers that rotate through. Anything that has a half moon by it is not showing you an accurate read at this moment. Again, these are all shut down because of a data center issue for the CME. It's a big deal, particularly for anybody who's looking to roll into the next contract. This is the last trading day of November, so traders who are trying to make sure they can roll into that next contract are particularly frustrated by this. We'll continue to keep an eye on this and, of course, bring you any updates as they come. But again, if you're just waking up, don't pay attention to the S&P futures, the Dow futures. Don't pay attention to the NASDAQ futures. You're not going to see good prices for oil, good prices for treasury yields. We'll continue to keep you updated as we see going through this day, but it's already a holiday shortened trading day, and this just adds to some of the confusion.
Becky, I don't know if I should say this, but I have this Refinitiv machine in front of me that has this app, and I do appear to be getting quotes on the 10-year. At 398, it's moving, is my point. And the chart shows it's up, well, 39883, but the point is it moved off of 399.
Yeah.
So whatever is going on, I'm getting this quote, and I'm assuming it's accurate, and I'm getting it minute by minute. So for what that's worth, and I got the 2-year at 347. And it's, again,
I mean, if that's the case, it would match with what we saw from last week with yields coming down after we heard from John Williams, as you were pointing out before, on this idea that the Fed is more likely to cut interest rates than we thought a week ago.
That has been a moving story, and I think you've got where it is right now. And big Wall Street banks are making their calls on where they see the market headed next year. Deutsche Bank making the boldest move, forecasting the S&P 500 to hit 8,000 by the end of 2026 as the AI boom rolls on. That's followed by HSBC at 7,800 and JP Morgan and Morgan Stanley at a paltry 7,500. Bank of America is as optimistic as its rivals, sees the S&P reaching 7,100, which implies a gain of roughly 5% from current levels. Joining us now, John Belton, Portfolio Manager for Growth Equities at Gabelli Funds. Okay, where do you see it? What numbers are 7,100, 7,500, 8,000? Pick a number.
I'm not going to pick a number. That's too risky. I'm not going to do that in a public forum. But I do think this issue
Well, you
is
can give me any number, just don't give me the date.
Let's go 7% higher from here, the long-term average.
Okay, great. Yeah, that's bold.
So, I mean, I do think this issue this morning, it's showing how important data center infrastructure is to the economy.
Yeah.
I'm originally from Chicago. I worked down at the Merc for a summer, so things have obviously gotten a lot more electronic from when I was down there. But yeah, I think a lot of the market's performance will come down to these big tech companies, and there's a lot of debate about them right now. So
They were just debating in the prior hour this AI or the Fed. I'm not sure it's a binary choice here. I think it was a little bit of both, right? And I think the Fed came along and maybe calmed down the AI concern. Is that how you read what happened last week?
yeah, I mean, I think the Fed definitely calmed down the interest rates concern.
Yeah.
I think, if we take a step back and we rewind just 6 weeks ago, which now feels like an eternity ago, I think the backdrop was the market was getting excited about this idea of rate cuts against an economic backdrop of growth reacceleration next year. Then there was a bunch of drama that you talked a lot about with Fed officials, where maybe this dovish rate path was not so dovish, and then simultaneously some of the data released started to cool down a little bit. So this rate cut into growth reacceleration sort of reversed a bit. market became a little bit more risk off, probably some fatigue as well after a big run. I think that is what really impacted the AI stocks more than any fundamentals. So I think the two are inextricably linked at this point.
What do you think is going to be the driver of that reacceleration if in fact we do see that next year? Is it just more of the same from AI infrastructure investment, and is that going to mark a reacceleration?
Well, I mean, I think you were talking about with your last guest, tax refunds is going to help consumer spending. I think other provisions of the big beautiful bill, like expensing of capex, I think should help spur.
But outside of AI, we haven't seen a noticeable impact of full expensing and immediate bonus depreciation. We just haven't seen it. What makes you think we could see that next year, even though the benefits were supposed to be this year?
Well, I think it's companies have had more time to implement plans with the new policies, so I think that could cause a reacceleration in sort of the non-AI capex.
Robert, that's an important point because my sources at Treasury think that companies don't know about it. They think they're just not hip to
Who
the
doesn't
new.
know about it? I mean,
That's their feeling. That's their
the
feeling.
biggest lobbying push by corporate America is to get bonus depreciation into that tax bill, and they got it.
Call the Treasury people. That's what they're telling me. And
I mean, if they don't know about it, that's
well, I mean, I'm not sure
concerning.
everybody knows that it's happening. And I want to go back and clarify what we talked about in the prior segment.
Yeah.
I used $2,000 for the thing that the check that Trump.
Oh, the tariff check.
What you meant is that there's an increase of as much as $2,000 in the refund,
Right.
which is a big deal, perhaps. Let me come back to this non-AI trade. There was a lot of talk the last couple of years about, hey, get into the equal weight S&P because those companies are finally going to have their day in the sun, but it's still been shining mostly on the 7. Is this a year, you think 26, when finally investors realize value?
You keep trying to get me to make a big 2026 prediction, but no, I mean, I think we've been seeing the broadening out trade over the last few weeks or the last month. I think that can continue, but ultimately, fundamentals are going to drive stocks. Earnings growth is going to drive stocks. We really have not seen strong fundamentals outside of the big tech companies. So I think the big tech companies, actually, I think five of the Mag 7 have seen their forward price earnings multiples derate this year. So yes, they're still driving a lot of performance, but the performance is coming from earnings growth, not multiple
Yeah, I
expansion.
was going to say, and it's far forward earnings growth, and that's where the rub comes in. Do you believe the far forward earnings growth for some of these companies?
Yeah, I mean, for the tech companies, you're
Yeah, I
saying.
mean, look, they've got incredible track records. If you look at an NVIDIA or any of the like of this, and people will say, yeah, this year, absolutely, next year, absolutely, but you start looking at it 2027 and beyond, and that's where people are a little less certain that this incredible growth can and will continue.
Yeah, I mean, law of large numbers definitely starts to kick in. It gets harder to grow off such high levels.
Harder to
of
make sure no
earnings.
competitors come in, that you can still maintain that much of an advantage over everybody.
We have to go. John, just real quick, are tariffs and margin compression factoring into your outlook?
I think definitely, and I think tariffs have been something that's been slow to sort of show up in company data, in economic data. It's definitely having an impact, but I think companies are learning how to deal with it. So,
John, thanks for coming in and joining us on this day after holiday that I've maintained for many years should actually be a holiday.
No, this is fun.
Well, this is fun, but I'm just thinking like the day after Thanksgiving.
Here's what I think, though. I think there are a lot of people who are watching from home this morning who get up and they want to know what's happening. So I think it's important that,
I'm not saying we shouldn't work. I'm just saying it ought to be.
national holiday.
If you look at the productivity of the country, we can afford another day off. And there was actually a commercial last night on one of the football games arguing that the day after the Super Bowl should be a national
I was
holiday.
going to say, which day would you rather have, the day after the Super Bowl or the day after Thanksgiving? I take the day after Thanksgiving.
I don't like to have to choose. I would like both.
You want to be, what you're saying is you want to be French, right? You want to work 4 days a week.
I don't think they're that stupid. 6 weeks off in the summer.
The cherry, it's real.
All right,
Look at
coming
me.
up.
She's in the chair.
Coming
She's in the
up.
Joe chair.
Coming up.
I'm in the Andrew chair. Give us more days off.
Coming up, a bizarre story about a Dutch chip maker that has lost communication with its China unit, and automakers are warning that it needs those chips to keep production going. We have details coming up after the break. chipmaker Xperia has published an open letter calling on its China unit to restore supply chain operations. The company said it published the letter after repeated attempts to establish direct communications through conventional channels, but did not get any, quote, meaningful response. Now, in the last few minutes, this is important, Xperia China did respond with a statement saying there's no situation where, quote, it cannot be contacted. So that's kind of strange. It said the Dutch company has implemented destructive measures against its employees, including deleting email accounts and terminating IT access, and that it demands the company, quote, abandon improper intentions to replace Chinese capacity. Now, why this matters? Well, it's a big problem for automakers because Xperia makes billions of low-tech chips that are used in cars, connect the battery to the motors, for instance, the lights to the sensors, braking systems to the airbag controllers, entertainment systems, all that stuff. Automakers have repeatedly warned of a looming shortage of these chips, given that that could halt production. So this appears to be an intra-company battle between Xperia and its China unit, which maybe was worried about some treatment of workers, but they have phoned home, it appears, or at least issued a statement. So we'll see whether that actually affects the production of these chips or not. Kind of a strange situation where they both went public. Xperia saying, please call us, and the company in the Chinese unit saying, we have this issue. So,
Wow. That is a lot to take in. And by the way, there's a story on the front page of the Wall Street Journal today about a very interesting situation with Intel hiring a TSMC, Taiwan Semiconductor chip executive, and Taiwan now investigating that executive's residence, saying that they're worried he's going to be taking TSMC secrets with him back to Intel. He's Taiwanese, but he does have a PhD from Berkeley, and he worked at Intel starting in the 80s until 2004. He was responsible for a lot of Intel's superiority in the chips industry. He went on an advisory role for TSMC starting last year, and the company was fine with that. They say they thought he was going back to academia, but when they found out he's going to Intel, it really sparked concerns. And I can understand that from Taiwan, because if Taiwan doesn't have the U.S. kind of beholden to its chips, it probably feels like it is much less secure in terms of a China takeover, in terms of leverage for that. So, he's saying no way. Intel's saying they don't think there's any problem here, that this is a spurious kind of investigation. But you start thinking from a nationalistic point of view, from Taiwan to see what's happening with this, how the United States is so eager to make sure we are no longer as reliant on Taiwan or China or anybody else.
So it's geopolitically sensitive. It's also so commercially sensitive now, because in this AI race, whoever gets the leg up in providing those chips, whether it's to NVIDIA, whether it's to Google, whether it's to everyone else, I mean, that is the growth, right? So if they've got secrets from TSMC that are useful in AI production, which I'm sure they are, and I'm sure that's the core of the issue.
Yeah.
There's a lot of money at
But
stake.
it sounds like this guy in particular is, like himself, a walking reason, a guy who was very responsible at Intel for a lot of the growth for 20 plus years before going to TSMC. You see the United States kind of saying you can't leave with those secrets when you go over. And by the way,
Maybe Intel just didn't have them.
What he did, he was responsible for a lot of Intel security.
When Intel was successful, right?
But you can bet the U.S. government's going to have a say in this too, because they now own 10% of Intel.
Right, that's true. That is true.
The geopolitical perspectives on this, things are going to get hotter and hotter.
Yeah, that's true.
All right, when we come back, the latest on the CME outage that has halted futures trading this morning. Plus, Zootopia 2 off to a good start at the box office. We've got the details straight ahead. Squawk Box, we'll be right back. folks, welcome back. 5 things to know ahead of today's opening bell. Listen up if you are just waking up. A data center issue has halted trading of futures and options on the Chicago Mercantile Exchange. That means that stock futures, foreign exchange, and commodities are currently not available to trade. But in the last few minutes, BrokerTech US, which is the CME unit that deals in electronic trading of treasuries, has had its service restored so you can see yields, we believe, that are accurate at this point. We're going to continue to bring you updates on that story as we get them. In the meantime, the Securities and Exchange Commission is investigating Jefferies' relationship into a bankrupt auto parts maker, First Brands Group. That's according to an FT report that said the regulator is looking into whether Jefferies gave investors enough information on its fund's exposure to the failed auto business. And Alibaba has started selling its new AI smart glasses in China. It's its first attempt to break into the wireless market dominated by Meta. Prices for the Quark glasses start at about $270 US. Alibaba says that they'll be integrated with its apps, including Alipay and its shopping site, Taobao. And Apple is challenging India's antitrust penalty law, under which the company could face a fine of up to $38 billion. This is the first challenge since that law went into effect last year, allowing regulators to use global revenue when calculating fines. Investigators say Apple is abusing its monopoly in the iPhone app market. Apple has denied all wrongdoing. And Disney's Zootopia 2 taking in just over $81 million globally in its opening day on Wednesday. That included $39.5 million in domestic ticket sales. The release marks the biggest opening day in China ever for a Hollywood animated film at $34 million. And guys, I guess there are different ways that you can see this one. You see it in 4D, as my brother and sister-in-law and their kids did. It smells, the seats move. My brother said he was almost going to vomit at times because of the way it moved around, but you've been into those 4D theaters where like water sprays in your face as you're doing some of these things along the way too. I think that's what they're thinking the future is, these experiences. And by the way, it was $100 for 4 tickets. So they get you for a matinee with 2 kids.
$25 a ticket.
$25 a ticket for 2 little kids and a matinee in the middle of the day.
Okay.
So
I don't have to worry about it because I don't think I'm in the target audience.
maybe not for Zootopia too.
No,
Zootopia was good. The first one was great.
It was.
It was really good. And
Zootopia?
yeah, and then Shakira's song, Try Anything, that was good. And I guess she has a new song for the new one. So that's
Much to see there.
Where did you get Robert Frank? I don't expect
You have
it.
2 daughters, you know, they were both younger when that came out.
10 years ago when the first one came out.
Yeah, so they're
Are they going to go to the second one?
I don't think so.
Too old.
Yeah. They might listen to the song.
Yeah. All right, we've got much more on the holiday box office right after a break. And later, the CEO of Shopify will join us to talk about the Black Friday sales rush. Squawk Box, we'll be right back.
All right, welcome back. The 2025 box office has climbed to $7.38 billion so far this year, with hits like Minecraft, Lilo and Stitch, and now Wicked for Good, edging slightly ahead of last year, but still trailing 2023. Joining us now is Paul Dergarabedian. He's the Comscore Senior Media Analyst. Paul, Thanksgiving, always a big weekend and 3 or 4 day weekend for movies. What is it shaping up like? What's doing well? Do we have any early numbers on Thursday or what the weekend could look like?
Yeah, that's a great setup for what's going on right now at the box office. So we're looking at Zootopia 2. The first film opened in 2016, made over $1 billion at the global box office.
Wow.
On Wednesday, yeah, that's huge. On Wednesday alone, it earned $39.5 million at the box office in the domestic market, US and Canada. So Thanksgiving is a really huge time for movie going. Obviously, people are, with family and friends, and they go out to the movie theater. And having Wicked for Good, the second installment, obliterate the first film's opening weekend. The first one opened to $112.5 million domestically. Wicked for Good opened to $151 million domestically. So we're set up for a really solid Thanksgiving. Wednesday, the day before Thanksgiving, through Sunday, it'll be at around $300 million, according to our Comscore data. So great time to go out to the movies. A lot of big movies coming up in December. So we're in that home stretch of the year, and as you pointed out very astutely, we're running at about $7.5 billion in the domestic box office year to date. To get to the $9 billion threshold, which is what we really want to get to, we need another $1.5 billion. Last year for this same period, the industry brought in about $1.6 billion. So I think we can do it. We're gonna, I think, clearly surpass last year, which did $8.77 billion. So we're on a great pace right now with Avatar on the way, Five Nights at Freddy's 2. On Christmas Day and Christmas Eve, and then Christmas Day, Wednesday and Thursday, there will be a baker's dozen of films coming out on those 2 days alone. Anaconda, Marty Supreme with Timothy Chalamet, Song Sung Blue with Hugh Jackman and Kate Hudson. So a lot of big movies on the way. So I think we can get to that $9 billion threshold. Global box office also very robust. But yeah, a lot out there to see in movie theaters right now.
And I'm looking at the top 5 releases so far for 2025.
Yeah.
And it looks like 3 of those 5 are Warner Brothers movies. And
Yeah.
I'm wondering whether now we're obviously Warner Brothers could be sold. There's discussions that they'd like to have that sale if it happens before the end of the year. What do you think, if we have that consolidation, that will mean for movies? Will we have, since we have fewer production studios, will we have fewer movies, bigger movies, but fewer of them? Do you think there'll be opposition to that consolidation? What, at the box office, what do you think consolidation will mean?
Well, I'm hoping it doesn't mean fewer movies. We need a pipeline of films, and Warner Brothers has had an absolutely tremendous year. I mean, back in April, a Minecraft movie, and then Sinners, and Superman, of course, F1 the movie, so many great films from Warner Brothers. They've had a massive year. I think we just want more. We need as many films as possible in the theaters, but it's not just quantity, it's quality of movies. And what brings people into the theaters, it seems to be, particularly in the last couple of years, PG-rated films. Last year,
Kids dragging their parents to the movies. That's what gets people to the movies.
That's exactly right. That's what's happening. So, it becomes an event, as you spoke of a little bit earlier, when the whole family goes out to the movie theater. That PG-rated film, like A Wicked for Good, Zootopia 2, last year, Moana 2, and the first Wicked, powered the biggest Thanksgiving frame ever with $425 million, and more to come. There's a SpongeBob movie on the way. But then, of course, on Christmas Day, you have some, awards contenders out there as well.
With great trepidation, I will recount a conversation from Thanksgiving yesterday, where a bunch of Gen Z kids there said that Gen Z doesn't want sex in movies anymore. Have you heard this thing? Because it doesn't drive narrative? Have there been these studies? Am I
They're
making
more mature than every generation that came before.
they don't want it anymore? Have you heard this, Paul? Or were they looking
I
at
haven't
it?
heard that, not in my house, but I
Not in
just
your
have to
house.
say that, no, but the PG movies, which have done tremendous business, that says something, but also, you know, it's huge this year. Biggest year ever for horror movies, according to our ComScore data. We are looking at a record. Sinners, Weapons, Conjuring, Black Phone 2, all these big horror movies. So simultaneously, we have PG movies and a lot of R-rated horror movies doing well. So there's something for everyone out there. But the Gen Z, what they're saying about that could be true.
Maybe this just got owned by my nephew.
Maybe that happens on Thanksgiving.
Apparently there was a
That's
study
pretty
about
funny.
this. I don't know.
And we'll do an official study at some point.
Thanks, Paul.
Thank you so much. I really appreciate it.
Still to come on Squawk Box, we'll talk something I know a little bit about, inflation and the Fed, with former Fed Vice Chair Roger Ferguson. Plus, Amazon executive Jay Marine will join us. He's the head of Prime Video US as well as Global Sports and Advertising. Squawk Box coming right back.
All right, welcome back, everybody. Let's get the weekend forecast right now from AccuWeather. Here's Ariel Scalise. And Ariel, this is a really big travel weekend. You got a lot of people who may not be traveling today, but could be starting today and definitely Sunday. What are they in for with the weather?
Yeah, we're going to have a lot of slowdowns, and it all starts with the very cold air in place. Chicago, AccuWeather real field temperatures today in the 20s. Cities like New York City, Philadelphia, and D.C. going to feel more like the 30s as we head through the afternoon. A lot of sunshine from L.A. to Jacksonville, which means your flights for today in and out of Atlanta should be good to go. Boston, you'll see a few flurries in the afternoon, but that shouldn't impact air travel. Chicago, things are looking good, but we're eyeing you up an area of 6 to 12 inches of snow moving through this weekend. And New York City, we're going to have some gusty winds today, 30 to 40 mile per hour wind gusts. So I think that could cause minor delays in the morning, but as volume increases through the afternoon, we're expecting some of those moderate delays. So I am feeling for people, Becky, who are making those travel decisions this weekend, and to help you make the best decisions and be more in the know, make sure to download the AccuWeather app and be safe for all those travelers. Another big winter storm, Becky, on the way this weekend.
Oh, no, that's not what we want to hear. Ariel, thank you.
Already counting down the summer.
I know, at least counting down to longer days, but I guess we have to wait through December 21st for that, too. Okay, we've got a lot of waiting to do.
Wrap it up.
All right. Ariella, thank you. We appreciate it.
No problem.
Squawk Bots will be right back.
do.
All right, Welcome back, everybody. It is 7 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Steve Leisman and Robert Frank. Joe and Andrew are off today. By the way, if you are just waking up or just joining us, a data center issue has halted trading of futures and options on the Chicago Mercantile Exchange. That means that the stock futures, some foreign exchange, and commodities are currently not available to trade. But in the last half hour, BrokerTech US, which is the CME unit that deals in electronic trading of treasuries, has had service restored. So those treasuries yields are giving you real-time data. 10-year right now is right at 4%. The 2-year is at 3.5%. We'll continue to bring you updates on that story as we get them, but it is an important day, particularly because it's the last trading day of the month. And that means that anybody who is trying to get this contract rolled over is going to be particularly concerned about this. We'll continue to watch it, though.
Yeah, and meanwhile, the retail sector is shifting into high gear for Black Friday. Our Courtney Reagan is live at the mall, Paramus, New Jersey, with the setup. Courtney, what does it look like?
Hi, good morning, Robert. Perfect timing, because truly, the doors are just opening right here behind me. Aritzia is the store right behind me. There has been a line that has been forming, and everyone is flowing in. There's lines at Lululemon and Hollister, sort of down this corridor. Lots of Gen Zers, as you might expect, hitting the stores early. And I can tell you from covering Black Friday over the last decade and a half, the cadence has changed for the day as far as when traffic peaks, but it is still a very, very important day for retail. The National Retail Federation, as a matter of fact, does it predict that 130.4 million Americans will shop in some form today, making it the biggest day of this critical 5-day stretch between Thanksgiving and Cyber Monday. Retail traffic counting firms forecast today will again be the biggest in-store shopping day of the year, even if not as many shoppers line up for those doorbusters as in year past. Still the biggest of 365 days of the year. Now, Adobe predicts that U.S. online sales will hit nearly $12 billion today. That's up more than 8% from last year, which also is the biggest growth rate of the 5 big days between Thanksgiving and Cyber Monday, what's often referred to as Cyber Week. Salesforce says the e-commerce sales on Black Friday did surpass Cyber Monday totals last year, and think they will again this year. Now, consumers, they're already awake and shopping, yes, behind me, but also online. According to Captify's network of 3 million websites, the top searched retail brands on Black Friday compared to last Black Friday. Apple, those searches up 315%, H&M up 248%, Samsung up 133%, Marshalls, that's owned by TJX, up 116%, and Adidas up 115%. Now, Thanksgiving Day, of course, the kickoff for what's considered the Cyber Week. As in recent years, orders surge post-Thanksgiving dinner. Third-party logistics company ShipBob says its peak was between 9 and 10 p.m. Thursday, and that peak hour was 182% higher traffic-wise than the day's low point, which was between 7 and 8 a.m. on Thanksgiving. Toys and games held the #1 spot, led by sales of Tony's. That is one of those hot items, at least that was expected by retailers like Target and Walmart and Kohl's. ShipBob CMO Casey Armstrong is somewhat surprised that beauty surged to the #2 spot as far as categories go, at 118% growth compared to this point last year. So we will see what happens, but as the cadence has changed online with the peaks happening later in the day, same thing happens here in store. Yes, there's doorbusters, but in a lot of cases, the traffic really picks up as the day moves on. Back over to you guys.
Yeah, Court, you mentioned H&M and Marshalls as being two standouts there. Those are obviously price-sensitive retailers. What do you see in terms of promotions, price promotions? Paramus has a pretty wide range of brands, but are you seeing any big sort of price promotions yet, or do you think we're going to see those closer to Christmas?
So I would call the promotions fairly typical from what you see on a Black Friday. So 30–40% off in some cases, which are pretty big percentages off, particularly when you have a retailer like an H&M or behind me an Aritzia that is offering sort of a blanket discount across the store, which you don't often see for the rest of the year. But shoppers did tell Deloitte that they plan to spend about 4% less on this 5-day stretch. Remember, what shoppers say they'll do and then what they actually do can end up being very different. Look at the consumer confidence numbers we got from the government this past week. They were pretty dour. But when you look at what the retailers were seeing and what they saw, they said actually shoppers are buying, especially when you offer them something that they find value in. And value means more than just what it costs, but if it increases performance, if it's a sporting good, for example, is what Dick's Sporting Goods says, or it has newness as far as a fashion apparel item, consumers are buying it, and even without a discount.
All right, Court, thanks so much. I know we're going to see you throughout the day, and you'll tell us later, I'm sure, how many actual shopping bags are full later today as opposed to people just coming in and looking.
Exactly.
Thanks, Court.
Thank you.
The average electricity bill is expected to rise about 4% this month and remain high through next spring. That's according to a report from the U.S. Energy Information Administration. Joining us now is an analyst who covers the sector, Ryan Levine, Citi Senior Utilities Analyst. Ryan, thanks for joining us this morning.
Thanks for having me.
So, how does this work? This huge increase in electricity demand from data centers, is that primarily what's driving up electricity costs?
So electricity prices are up about 23% over the last 5 years, and it's due to a variety of reasons. Yes, data centers have impacted some of the Northeast and Mid-Atlantic utilities due to unique regulatory mechanisms, but it's also due to just overall inflation. It's due to some storm costs in pockets of the country like California, Louisiana, and North Carolina. And then some of the more renewable policies have impacted select states in terms of drivers of the electricity bill. But data centers are just a part of the equation and more regional focused.
How do you handle this? How does a local utility handle this increase of demand, which drives prices up, but you can't really charge them more than you do another customer, can you?
Yes, and so over the last 2 years, there's been heavily negotiated contracts with a lot of these large hyperscalers, whether they're entering in 12-year agreements, trying to protect their residential customer from the bill, and they've, in some cases, created carve-outs, so the utility portion or the bill that goes to that customer doesn't affect anyone else. There's other negotiated transactions that have created structures outside of the regulated utility model to protect the residential customer. The reasons that it has an impact in certain parts of the country are more due to the regional power grid that's increased the price of capacity for power. That's created some short-term inflation to electricity bills.
So obviously the solution, Ryan, has got to be increased supply. What is your estimate for what is going to be happening in terms of bringing on new supply over the next several years?
Yeah, so we see that growing over 2.8% annually through 2040, and that number continues to push higher as CapEx and data center demand continues to inflect higher. In terms of how that could be fueled, that's a mix of short-term solutions, which is bringing back on old nuclear assets. There's 3 projects underway to restart there. You're seeing some additions around gas and less efficient forms of gas generation, keeping coal assets running longer, as we most recently saw in the state of Michigan with the Campbell plant. But that trend around kind of extending the life of baseload around-the-clock power is a bridge fuel or bridge resource until you can really build new power plants, whether it's renewables, but more meaningfully natural gas, and then potentially in the future some of these newer technologies, whether it's small modular nuclear or large-scale nuclear or other developing technologies that could meet the needs of this increasingly power demand hungry customer.
Is the administration's withdrawal of support for alternative energies meaningful for the outlook for supply?
I don't believe that has had a meaningful impact to the longer-term picture. There's supply chain constraints to be able to deliver that resource, but it's really intermittent or not available 24/7, which is what the hyperscaler needs. So that's not the preferred resource to be able to keep the lights on for the general public. The renewable policy has had a slowdown on wind and a number of resources, but that's not necessarily a deterrent to keeping the lights on for data centers and the broader economy.
Ryan, are there any particular utilities that you're watching and recommending?
Yeah, so we like some of the Midwest utilities, including DTE Electric, as they have a data center growth story that we believe will continue to emerge in the coming months with 2 to 4 large hyperscalers in the Michigan area, plus some behind-the-meter generation that they anticipate building with the expectation that they get an air permit on that front. The other names that we like, or one other to highlight, is First Energy, which is a more of a Mid-Atlantic, Ohio, Pennsylvania wires company, and we think that has meaningful earnings growth inflection higher as the need for data center grows in that area, and the stock isn't as expensive, so there's more meaningful upside potential for that security. So those are two names that we're highlighting in the current environment of this inflecting higher data center demand, and companies that have a solution to lower the bills for residential customers while driving EPS accretion for their shareholders and other stakeholders.
Great, Ryan. Thanks for joining us this morning.
Thank you.
We continue to follow the outage at the CME that has halted trading in stock index futures and other contracts. That was caused by a cooling issue at the CME's data center. However, services are gradually being restored, and treasuries, commodities, and metals are said to be trading normally at this point. You can kind of see the moves in the pound, the dollar, the euro. Stock index futures are still halted, though. We will keep you updated on when those might be restored. But again, it's been hours at this point. We are continuing to watch, and we'll let you know as soon as those stock futures begin to trade properly as well.
Coming up, from $11,000 handbags on TikTok to LVMH's holiday strategy. We'll cover luxury retail, something that Robert Frank knows a bit about after the break. And later, with more than $1 trillion worth of sales made on Shopify, a look at how the platform is setting up for the holiday small business shopping rush with the company's president, Squawk Boss, coming right back on this day after Thanksgiving.
there of Black Friday. Let's dive into the luxury retail sector. Joining us now is Michael Zakor. He's Five Digital founder and the author of the book, The New Retail. Michael, thank you so much for joining us. Great to see you. So I see this split now between the popular narrative, which is we have this K-shaped economy. The wealthy are doing well from the stock market. They're spending. Luxury's terrific. Everything else is not doing well because the consumer is under pressure from higher prices. But when you look at the stock prices of luxury companies, even Hermes, which is down 9% year to date, LVMH had just a big bump up about a month ago from their sales report. But these stocks are still well off their highs, in some cases 25% off their highs, down for the year. At best, we're looking for a globally flat luxury sector in 2025, maybe a point or two growth. There's a report out from JP Morgan this morning saying maybe some growth next year. So it doesn't look that great, even though popular wisdom say, oh, this is an economy driven by the wealthy and they're all spending on luxury. So which is it?
Yeah, so I think with luxury right now, the party's not quite over, but the guest list just got a lot shorter.
Yeah, 50 million fewer luxury consumers than there were 2 years ago.
And what we're seeing is a bifurcation in the retail sector. So we're seeing the ultra luxury companies, very high-end hard goods. You know, despite the stock prices, Hermes is still leading the pack. We're talking about high-end jewelry, watches, the hard luxury, the ultra luxury is doing well, but the middle has fallen off and the bottom has fallen out. So what we're really seeing is that aspirational luxury buyer has virtually disappeared.
So when you say hard luxury, so there's jewelry, watches, you're saying are doing well. Watches have been kind of a mixed picture, particularly given the tariff situation, although that's now resolved. But you were saying that what we would say soft luxury, so that's leather goods, that's handbags, that's shoes, that's clothing. That's been the tough spot?
That's been the tough spot. You know,
Why is that? Why is
the
that?
aspirational luxury buyer who might be saving for a long time to buy a $3,000 handbag, they're just not doing it anymore.
Yeah.
And so, you know, like I said, the party's not over, the lights are dimming, it's an exclusive guest list. This bifurcation, I think, is going to mark the holiday season. I think right into 26, we're going to see that. You know, if you look at some of the brands from Richemont and LVMH, they're really hurting this year.
But so much of it, as you rightly point out, I'm so glad you did, because people misunderstand luxury and thinking, well, this is where rich people spend their money, and they do, but most luxury consumers are aspirational consumers. They're not rich, but they want to splurge on that bag or the shoes, and so that's where that big drop-off has fallen. When you look at price sensitivity, if you look at the Chanel flat bag, that has doubled in price to over $11,000 in the last 5 years. What really hurt luxury was doubling, tripling price in things without any noticeable improvement. Do you think that margins clearly have come down? Do you think they're going to come down more? And what do you see in terms of price and profits going into next year?
Yeah, so that's a really deep and interesting question, because I think in that aspirational buyer's mind, you know, there's a real difference between striving to get that next leg up, I think it means basically the logo companies, you know, people who are selling logos on bags and shirts and fashion are really going to continue to have a hard time going into this year. But I think continue to see the hard goods will do well.
And your book, I know, talks probably a lot about experience, and I've seen, you know, we've been talking about experience becoming the new sort of luxury for years. We're really seeing it now accelerating, particularly as this younger generation, they want to go on trips, they want dining, they're less concerned about conspicuous consumption and status goods. What do you see luxury goods doing, particularly the hard goods company, doing to adapt to that? Are they changing the stores? Are they going into the experience business like we've seen Kering just do recently?
Yeah, I mean, listen, the luxury companies were the original experiential retailers, right? I mean, that white glove touch in store, the guest list, the special perks, being treated like a king no matter who you were. I mean, that was the luxury experience. I think that's dimmed somewhat because the consumer is saying, well, like you said, the prices are up so high, can I even square the value of a handmade luxury good for that price? That's hard to square, right? And so when the consumer's trying to square the price with the value, That's where they're disconnecting here. And so these luxury companies need to get back to what they were. They were the original experiential,
Yeah.
right? And one thing we're talking to our luxury clients about is they need to stop thinking about points of sale, and they need to start thinking about points of experience.
Yeah.
And if you can build a circle of points of experience, because you can turn any point of experience into a point
No,
of
and they're all Tiffany and some of the other stores, they're doing in dining, they're doing a lot of things to make those stores. But lastly, from an investor perspective, you mentioned it's the very high end, the brands, whether it's Hermes or Cucinelli, that are Loro Piana, that are really appealing and working right now. What brands or stocks do you think will be the strongest in the next year or two?
Yeah, I think I think LVMH is going to come out fine. I think Kering is going to do well. I think
Despite Gucci's problems.
Yeah, despite that, because I think what happened is in 2025 in luxury we had a step back, but I think 2026 is going to be the reset where these companies and their consumers, whether they're aspirational or hardcore, they're going to come together. It's going to get closer. I think it's going to get better, not worse. I think, we're talking about this a year from now, we're going to see these companies are doing pretty well if they reset, if they create these points of experience, and they get back to the core of who they are.
And of course, if the stock market holds up, because
And
that's driving the wealth effect, which is driving those wealthy consumers. Michael, thank you so much for joining us. We appreciate it.
All right, up next, the tech must-haves this holiday season. We'll get some picks from tech columnist Joanna Stern of the Wall Street Journal, and later, former Vice Fed Chair Roger Ferguson joins us. Squawk Box coming right now.
Time now for today's Aflac Trivia question. What Christmas song was originally written for Thanksgiving? The answer when Squawk Box returns. answer to today's Aflac trivia question. What Christmas song was originally written for Thanksgiving? Answer, Jingle Bells.
All right, welcome back, everybody. AI dominating many of this year's hottest gifts. Joining us right now with her take on which are actually worth it is Joanna Stern. She's personal technology columnist at the Wall Street Journal, also a CNBC contributor. Joanna, every year I look forward to this because I don't know which ones are going to be worth it, which ones are not. I appreciate your dry runs on these things. What did you find this time? Which was your favorite of all of the different things you trialed?
Well, look, I think we should say that first and foremost, AI toys are a bad idea. Do not buy your kid an AI toy. We've been seeing a lot of issues with these, and so I tried to figure out which are the best AI gadgets, or you could say toys for adults. I don't think we should give AI toys to kids. So I would say the first.
Wait, back up. Before we jump into that, tell me why. What's wrong with any of the AI toys you've seen? What are the risks?
Well, look, some we've seen, and there have been reports from other media outlets that they're just talking about things they shouldn't be talking about with kids, illicit things, things that are inappropriate. So there's that. And then I actually tested an AI toy with one of my kids here, and it's just something a little bit dark about this chatbot being part of a stuffed animal and your kid kind of bonding with it. Just don't think it's the greatest thing. And it's like people compare it to like the Teddy Ruxpins of our age. But it's really not that, right? It's not like a tape and like pre-programmed. It can talk about things forever with your kids. And so, yeah, I just
maybe it's a little early to figure out that kind of relationship with a bot instead of actual people around. Like, that's a fair point. I like that.
Exactly, but that doesn't mean adults shouldn't have AI toys, which we'll get to here. So the first is actually something I recommended last year, though this is the Oakley Meta Vanguards. It's a takeoff of the Ray-Bans, which I've loved so much and talk about almost now every year. But I would say that in the past I've loved them because there is the screen, the hands-free no phone recording, right? You don't have to hold your phone up in front of you. You have these cameras built in. But two great things now about the Oakleys. One, they're waterproof, or they're not fully waterproof, but a lot better, IP7 resistant, and that's going to help a lot if you're doing water sports or skiing like we're seeing here. And then the second thing is that, well, the camera has gotten better too. Let me put that in the first one. And the second thing is that Meta's AI has gotten a lot better. And so you can actually ask these glasses about what you're looking at, ask for tips, and just use the chatbot in your ear, and I think that's a great thing.
Joanna, you may have seen in the news this morning that Alibaba is launching these Quark glasses. I don't know if you've seen them yet, or if you've read about the on-screen display, but that has AI built into it. What's your guess about how that's going to compete with the Meta glasses?
So I haven't tested those yet, but you will notice that I'm not recommending the Meta Ray-Ban display glasses, which are Meta's glasses with the display inside. I have tested those, been testing them for the last number of weeks. And
you don't like
it's just not a great experience. No, I mean, I think it's a real clear vision of what's coming from Meta and what's coming in this space. I really do think we'll get these displays. They will be better, but right now it's not good enough, and the price is too high.
The Vanguard connected glasses are what, $500?
Yeah, $499.
Okay.
And look, they're not going to be like everyday glasses, but I really like these for water sports. I'm always wearing the Ray-Bans when I'm out with my kids doing things in the summer, skiing, and so now they're water resistant and a lot more durable when you get the Oakley ones.
Is anybody else freaked out by people walking around with glasses that can hit a button and start filming what's going on, or is it just
They
me?
got a light on them, right, to tell you if you're recording?
Do they all have lights on them?
They do have lights on them. I'll say they're a little subtle. But I think, look, people have been wearing these Ray-Bans for the last couple of years. It's getting more popular, and I do think this is where we're headed. So
Have you remember the Family Guy where the little doll gave you extra points if you gave it your credit card number? And it showed the credit card number going right back to China?
We trust Meta with all of our data. If they're watching everything that you're seeing every day, I mean, we trust this company.
Do you
right?
trust them? I'm the only one freaked out by this, or no? You're
No.
good at thinking.
I have a pair of them.
Joanna, help me feel good about this. I don't feel good about this at all.
I think you're very right. I think people are freaked out about it, or a certain fraction of people are freaked out about it. But I think also there's going to start to be a real understanding that if you are talking to your glasses, or you see this little thing, or you're going to see what these look like, that people know you're recording. We've come a long way since Google Glass in terms of utility and design, and so people are gonna start.
Plus, anybody with a phone in their pocket can record everything you're saying too, and they do. So I guess I've been creeped out for a while. I don't know if Joanna, let's talk about
It's a permanent state.
buyer beware. You're walking down the street, beware. Joanna, let's talk about the Harry Potter Ghost chess
Oh,
piece.
yeah.
We just put it up on the screen with the board. It's $430. I don't think we have the price on it.
Look, I love this. I love this because my son is learning how to play chess, and I don't actually really know how to play chess that well. And so, two really nice things about this. I'll be admitted, I'm not a good chess player. My son, who's 8 years old, is far better than me now. There's AI guidance in this chessboard. So first of all, you can play regular chess here, right? You don't have to use any of the connected items. But what's really cool is that there's smarts in the board, and so there are LED lights underneath the board that show you where you should move. So I can play against my son, who's really good, and I obviously can be taking some hints from the AI and, not do terribly. And then if I wasn't there and he just wanted to play against someone, he could play against the AI, he could play against someone online using the chess.com integration. So it's a really good way for kids to learn chess, it's a good way for adults to learn chess, and more importantly, you can play with another human, which I think is important.
Yeah, and I think it also, my daughters are big chess players, particularly my older daughter is a competitive chess player. She plays on chess.com a lot, and I guess this does hook up to chess.com, right? So you can play all the bots on chess.com, which she likes to do, and you can play other human beings.
Exactly. It doesn't move the pieces. I was a little upset it doesn't actually just physically move the pieces, like, these levitating pieces. I was like, that's the future we thought
That
we were
would be
getting
very
here.
Harry Potter-esque.
And they move themselves.
Exactly, but there are lights, so you can guide them and you can place them so the opponent can be putting them, or the opponent's image, you can set it that way for the opponent.
Joanna, we gotta run the Matic robot vacuum for $1,245. You're gonna have to explain that to me on another day. But Joanna, thank you. We appreciate your time today.
Look, money's no object when you need to clean your house. Thank you for having me.
Okay, thank you. Take care.
All right, coming up, Inflation Nation, a look at how states across the country are being impacted. And later, Shopify is the home for many small businesses and boutiques, with total sales topping $1 trillion. Shopify President Harley Finkelstein is going to join us to talk Black Friday, empowering small business with AI tools, and much more. Squawk Box, we'll be right back.
outage at the CME that has halted trading in stock index futures and other contracts. It was caused by a cooling issue at a data center. However, services are gradually being restored, and treasuries, commodities, and metals are said to be trading normally at this point. You can see the 10-year is yielding just below 4% at 3.98. 2 years just below 3.5% at 3.48. Stock index futures are still halted, but we'll keep you up to date on when those might be restored. In the meantime, Dom Chu joins us with some of this month's best and worst performing ETFs because, of course, Dom, it is the last trading day of the month. And by the way, I hope you had a wonderful Thanksgiving.
Same to you, Becky, and to Robert, and to Steve as well. And because, Becky, you and I have been using ETFs as a proxy for how the markets are going to open with that CME outage right now, we thought using ETFs as a lens would be an interesting way to kind of take a look at how the month has developed so far this final trading day. So with regard to the big thematic elements of this month in November, the downside move here has been highlighted, of course, by artificial intelligence stocks. So we'll use the Global X Artificial Intelligence ETF as a way to kind of look at that as a proxy. Month to date, down about 6% right now. You can kind of see the price action over the course of that period. But of course, let's put it in context for you. On the year-to-date basis for this particular ETF, we're still talking up about 30%. So that's the pullback that we've seen just this month. Another big move here has been in cloud computing stocks. Check out the First Trust Cloud Computing ETF, ticker SAYY. On a month-to-date basis, down about 10%, so that price action has been decidedly lower. But on a year-to-date basis, this ETF right now is still up about 7.5%. So again, that's just in context. The other one to watch here is what's been happening with, of course, with cryptocurrencies. If you take a look at some of these cryptocurrencies that track the ETFs that track these cryptocurrencies, FBTC is a Fidelity product, ETHE is one by Grayscale, Ethereum and Bitcoin you can see down about 16 to 21%, but on a year-to-date basis, of course, still markedly moving at least sideways. The Fidelity Bitcoin ETF and the Grayscale Ethereum still down about 2 to 10% overall. And then if you want to look at the winners, check out, of course, what's happening with healthcare, the best performing sector so far. The biotech ETFs that track it are up about 9 to 10% over the course of the month, and over the course of the past year-to-date period have seen some stunning moves here as well, up about 31 to 35%. One last place to look, Becky, gold miners. They've caught a bit of a bounce on a month-to-date basis, up about 13%, and of course on a year-to-date basis, that VanEck Vectors Gold Miners ETF is still up about 141%. So, Becky, you can check out more on etfedge.cnbc.com for a lot of these ETF stories. I'll send things back over to you, but an interesting move through the lens of ETFs, Becky.
Well done, Don.
Thank you.
Appreciate it. We'll see you later.
All right, up next, former Fed Vice Chair Roger Ferguson on the central bank's rate path. Also look at which states are really feeling the inflation pitch. Squawk Box just getting started here on this Black Friday.
All right, welcome back. Well, guys, so last week, Scott Bessent, Secretary Bessent, mentioned that he was talking about inflation, and he mentioned that the way to lower your personal inflation was to move from a blue state to a red state, because according to him, the White House has data that shows that inflation in red states, at least for the past 6 months, was running 0.5% lower than those in the blue states. So I went to find the data. The data, at least I couldn't find it. The CEA wouldn't give it, or it didn't respond. I couldn't find any other news outlets that could find it. What I did find, however, was data from the Joint Economic Committee, which showed the inflation rate between 2021 and the end of 2024 in various states, by states. They're not producing that data, or at least publicizing it anymore, but I did find it through the end of 2024. What it showed, let's go back to that chart, was in fact the opposite. And we'll explain why in a second, but basically you look at some of the highest, Tennessee, North Carolina, Georgia, Texas, all in the 22, 21%. New York, though, blue states, 19%, Maryland, 18%. Illinois was sort of higher on the blue states, California, 20%. But this shows the opposite. Now, when I dug into why is that the case, the case is that a lot of people during that, so this measures 2021 to 2024, this was driven by housing. And so what did happen was a lot of people did in fact move from higher tax blue states to red states. That boosted housing prices in those places. We know what's happening in Tennessee and Florida in terms of the average or median housing price, apartment price, rentals, because so many people move there. If even more people move from blue states to red states, that would presumably drive up inflation even more in those states. What we don't know is what's happened in the last 6 months, because that data just doesn't exist. But you could argue that with inflation as a whole higher, that could drive even more people in these higher cost states.
I was going to say, cost of living is probably still cheaper in all of these places, not just from a tax perspective, but because housing was cheaper there. Look, a lot of people moved in COVID when you no longer had to be in the office every day, and you got to choose wherever you wanted to live. You didn't have to be in one of these major metropolitan areas. So they moved not only to Florida, but maybe further out from any major city, because prices are cheaper. Affordability is much easier if you're looking for a house for your family and a yard and those things.
And what's interesting is, so New Yorkers moved to Florida, that drove up costs there. Floridians moved to North Carolina. The North Carolinians, they're going to Idaho and North Dakota because that's cheaper for them. So it just creates this giant sort of migration that's based on, no, it's just cost of living.
Yeah.
I tried to run that down too, and I couldn't find it. As far as I know, there is no red state, blue state calculation from the BLS.
Or even it's just state by state.
You can do it, I guess, because I think there is individual state data, so maybe they did it, but I'm not sure that it's that big of a deal.
The point is, it's bad everywhere, right? The inflation is, I mean, those inflation rates over that period, they're all in the 1920s, they're all large and they're all fairly similar.
Right, and I'm not sure why there would be a lower inflation rate in a red state versus a blue state.
Well, he mentioned regulation.
I think it's the other way around. I think that blue states, if they're more populated, have more competition and the ability to compete away higher than normal costs.
Maybe the next time we have Bessent on,
we gotta bring in here somebody who may know something about this. Former Fed Vice Chair Roger Ferguson. He is the former president and CEO of TIAA, and now Vice Chair of the Business Council and a CNBC contributor. Lots of titles, Roger, because there's lots of wisdom there. That's why.
You're absolutely right, Steve.
I want to get to the about face the market did with what happened last week. I was reporting one hawkish Fed president after another. The market was going down in terms of the probabilities, and then John Williams said two words: near term, and everything turned around. Was this the right call by the market, you think? You think John is out there, I call it the intellectual pulling guard for the chair?
Look, that's certainly the way the market perceived it. To be fair, I share some of your concern that one speech suddenly changes the outlook and the view that the markets have. No doubt that John personally is very close to Chair Powell, more importantly the role as Vice Chairman of the FOMC, which sits with the New York Fed, comes into play here. But I think the market is reflecting what it heard, and we'll see if that's the right call. I actually think it puts the Fed in sort of a tough bind now, because there are many folks who I think are not ready to make the move. But on the other hand, now the Fed risks, if you're going to use that phrase, disappointing the market. So, I think it's become a bit more of a conundrum than one would have liked.
Right, so they took away the flexibility, but Roger, I was sort of on board with some of these folks who were saying, hey, 4.5 years going on 5 years of being above target, the economy doesn't look that bad, it's time to start to address the inflation issue, but then they seem to be backing off of this. Where would you stand in this question?
I'm very much with you. Look, inflation has been running not just somewhat above target, but call it 2.9, maybe 3%. It doesn't round down to 2. A lot of the factors that have been driving that you've been talking about, some of them may ease. Housing may ease over time, but that's a serious structural problem. I think the argument for the labor market being dramatically weak so as to needing monetary policy assistance to me is not that strong. So I'm very much with you and with those who would be much more cautious about this December move.
There's a hear no evil, see no evil aspect to this, Roger, in the sense that we have a lot of private sector data on the job market, and we can sort of see that data getting weaker. We don't have good data when it comes to inflation in terms of what's happening out there. And so I think the feeling was I'm watching this jobs data get weaker, and as far as I know, the inflation data is okay. Do you think that they're siding on the right risk here?
I do not. I hate to be so overly critical of friends and former colleagues, but my view is the risk here on the inflation side, and most importantly, on maintaining short-term credibility around inflation, should not be ignored. I think there's a whisper in the market that maybe the actual inflation target is somewhere around 2.5, maybe 3. I don't think that's what they want in the marketplace. So if I were a voting member, which I am not and have not been for a period of time, I would be in the hold camp for now. And if I said one more thing, President Goolsbee from Chicago some time ago said something I found very insightful, as he often does, which is, in the absence of knowing what the inflation data are, it's a lot harder to get that genie back in the bottle. And so maybe you err on caution because you don't have information giving confirmation about inflation coming down.
All right, well, Roger, real quick, would you delay the meeting for the data?
No, I would not. Becky,
I think you're wrong.
You may think I'm wrong. No, you think I'm wrong. That's fine.
Answer the question, sorry.
Look, I've been thinking about this a bit since you posed the question a little while ago. My initial answer, I think, is still true, which is you don't want to be in a place where you seem to be whipsawed by, let's wait for the next piece of data. If you start doing that, then you're going to open up a whole new question, which is, should we keep to the original meeting schedule? And, you can have a debate almost every meeting that some new piece of information comes in. And I just say,
that was persuasive, Roger.
I would just say, though, this meeting would be 2 jobs reports and an inflation report, so it's not one piece of data. Roger, wisdom of all of your titles. Thank you so much for joining us. Up next, the president of Shopify will be right back. Roger, thanks again. up, Harley Finkelstein of Shopify and the Next Hour Small Business Administration, and Kelly Laughlin. Stay tuned. You are watching Squawk Box on Black Friday.
All right, welcome back, everybody. Black Friday is in full swing this morning, and our next guest is powering many of those sales. Harley Finkelstein is the president of Shopify. And Harley, thank you for coming in today.
Great to be here.
You've got data that is not just up to the hour, but up to the almost minute.
We do, yeah. We have minute-to-minute data right now. As we talked about, we have about 12% of all U.S. e-commerce on Shopify. Obviously, most people think that we support small business, which is our bread and butter. But some of your favorite brands, from Aloe to Viore to Figs to Gymshark to Mattel, also use Shopify as well. And so I have top product categories. I also have top trade now. So right now, 2.4 million sales per minute.
Becky, get off the phone, Becky. That's it right off the phone.
No, but at 2.4 million as of when? I mean, since starting at midnight?
Sorry, so right now we're seeing 2.4 million sales per minute.
Every minute.
Every minute. 23,000 change orders per minute. And since last night when we started counting, 17 million unique shoppers across all stores on Shopify. What's really cool is every one of those little dots, so that's a store, and that's the arc is actually where it's being shipped to. Something else that's really cool. Every 26 seconds, a brand new entrepreneur is getting their first sale right now on Shopify. So those little fireworks, that's a new entrepreneur being born effectively on Shopify.
Angel gets their wings.
Exactly, that's exactly right. Let's go into top product categories. So right now, top product categories: skincare, vitamins, supplements, activewear.
Wow.
So there is
wellness, fitness.
That's right.
Skincare,
vitamins, supplements, activewear.
So people are shopping for themselves right now.
Right.
Only people who do yoga are shopping.
Well, makeup also is doing well.
Women who are shopping for themselves, I'm telling you that right
Yoga women.
Let's talk about trending merchant products. So right now, the Aloe Yoga Accolade crew neck pullover is trending.
Very
Cozy Earth bamboo sheets. and Merit Beauty Flush Balm is also trending right now. Here's something that's really interesting. Home seems to be the hero in the last 12 hours or so. Last year was more the outside. You saw things like ski equipment, adventure equipment, camping. This year, you're seeing a lot of like Christmas tree with candles from Goose Creek, Caraway cookingware sets. You're seeing puzzles. You're seeing
back to the home, because we did the home in the pandemic.
Last year was getting out of the
tired of the home. I'm done with the home. I got
Now we're back at home.
Now we're back
How
home.
much of the physical sales that you were seeing are being driven by discounts?
Interesting you say that. So one of the things we're also seeing is that certainly discounts are there, people are waiting for it, but it seems to be that consumers are actually looking for value more than they're looking for discounts, meaning they're voting with their wallets to buy from brands they love. If they love Viore or they love On Running, they're waiting for discounts from those particular stores. The other thing that's happening
How
is...
big are the discounts really on average?
The truth is the discounts range from anywhere from 10% up to 30%, which is usually average. Steve, you probably look at that as much as I do. But the thing that's interesting is that a lot of the traditional online retailers, so for example, Gymshark, which is pure online, they're now opening up offline stores. Figs, which is the hospital scrub company, they open up physical stores near hospitals so that during lunch breaks for healthcare workers, they can go downstairs and buy directly there as well. Tecovas, which makes, I think, the best cowboy boots on the planet, they're opening these saloons all over America, 50 stores. That's Tecovas. That's a pure online store, historically, that now have 50 offline stores where you can go and get your boots shined.
Wait, an offline store is brick and mortar?
Brick and mortar, Steve.
Okay.
Yeah.
That's weird. You came at it from a different angle.
Yeah, so brick and mortar. That's right. And now they're moving offline.
Can we put you in the corner and come back to you every 10 minutes?
Yes, you absolutely can. I just one more thing though. Something else that's happening is they're going to hate this term, Steve, because you study this too. But I do think also what's happening is it sort of feels like a post-omni-channel world right now. What I mean by that is consumers are kind of starting with a TikTok video, then they're moving to the online store, then they're moving to Roblox, then they're going to the offline store. And so what we're trying to do with Shopify is power every single channel so that consumers can find their products wherever they want to do it. As opposed to this online versus offline, it's really retail everywhere. We do, yeah. We have tons of physical retailers that are using Shopify.
We can't let you go without asking what I think is probably one of the most important. How are we doing relative to last year or relative to
We're doing better than last year.
How much can you tell us?
I can tell you, yeah.
When can you tell us?
So too early. On Monday, I'll be able to. Monday afternoon, I can tell you what we did. Last year, we did 11.5 billion over the 4-day period on Shopify. The year before was 9.3 billion. We'll see what happens.
Can you correct for inflation and for the growth of your business in that data?
We do. I mean, obviously, we do have more merchants joining as well. In terms of inflation, obviously, one of the things I said this on the last earnings call, we have not seen our merchants increasing pricing all too much, which is really interesting. So they're actually keeping it fairly standard. But the thing that we are certainly seeing across the board is that this direct-to-consumer, these brands that have this connection with the end consumer, they're doing really well right now. Most of consumers' favorite brands are on Shopify.
Becky has the thanks here, but I just want to say, Harley, stay in constant touch.
Okay.
Thanks.
It means a lot.
Yeah, Harley, thank you for coming in. We appreciate it. And we want those numbers.
I'll get them.
All right, folks, it is just after 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Robert Frank and Steve Leisman. Jill and Andrew are off today. If you're just joining us or maybe just waking up, the futures trading was disrupted overnight by an outage at a Chicago data center. CME actually halted trading for most futures instruments. Since then, we have seen a lot of them pick back up. Treasuries, currencies, and metals have resumed trading. And we have just gotten word from the CME that the futures and options markets have now pre-opened as of 8 a.m. Eastern Time and will open fully in a half an hour from now, 8:30 Eastern Time. You can see the 10-year is yielding right now at 3.99. The 2-year is at 3.47.
All right, for more on the markets, not much visibility today, but if anyone can see it, it's going to be Mike Santoli. He is at the New York Stock Exchange. Mike, what are you looking at?
Yeah, Robert, we have our ways of divining what's actually going on, even in the absence of the index futures. Take a look at the S&P 500 ETF, the spiders. They were indicated higher by 1/4 to 1/3%, maybe a little bit less than that. So bottom line, follow through to a very strong 4-day rally. This is a 6-month chart, so that 4-day rally a week ago here on Friday, it was here saying, like everybody else, markets looking a little bit oversold. If this is just a routine pullback, this is kind of where you'd like to see it get some support. We did that. that. We're up more than 4% from those levels. And the effort here is to try and sort of regain that general uptrend. We were one of the longer periods without a 5% total pullback in the S&P going into this period. We finally got that streak ended and kind of refreshed. Also seemed to be some month-end out of bonds into stocks type trading, pension funds having to rebalance going into Thanksgiving. That probably gave a little bit of a boost. I do want to point out though, take a look at the same ETF, the S&P 500. Last year, the second half of last year in 2024, because everybody says, hey, at the end of strong years, they tend to actually follow through to the upside in December. Didn't really happen last year. We actually did have this strong rally, of course, especially after the election. And then right in here, we basically peaked in the first few days of December and then declined a few percent into the end of the year. I'm not saying we're going to see something like that, just to say that there's nothing baked in that you have to actually see follow through to the upside just because we had this little stutter step going into December. We also have had a little bit of a broadening out of the market. Take a look here at consumer discretionary on an equal weighted basis. That's the RSPD. That had really been flagging for a while. Obviously, concerns about soft patching the economy, labor market. Perhaps the Fed was going to forego a cut in December, and then we got the dovish Fed speak. That restored some of the strength in consumer discretionary. This is healthcare, though, and you see what a monster move it has been for healthcare. It fell to a historic low in terms of its weighting in the S&P, and we bounced hard off of that. So that's a little more of a defensive, not as much of a cyclical sector. Relationships interesting, but the discretionary part still has a little more to prove. That's what I'm watching to see how we're feeling about economic momentum going into next year, guys.
Yeah, and Mike, going into today is already a low volume day. It's a shortened trader day. Looks like some of these services at the CME are being restored. We don't know when they're going to be all restored, but given that it's already a low volume day, could it be a little bit choppy given that options trading is still uncertain, or do you think that's not going to affect individual stocks?
It seems to me that we're probably going to go with, the path of least resistance is upside drift or just drift in general. So I don't know that there were so many people who had to transact today that are going to be at a loss and they're going to have to force a lot of volume into a thin tape. So obviously, we'll see. It could be anything. A lot of times I've noticed in past years that a lot of folks are at home, and so they, got a half day of trading they want to do, and it sort of erupts into some volumes and some idiosyncratic stocks. Let me put it that way. I'm not sure that's going to happen today, but it's one of those things I watch for Black Friday.
Is that code for meme?
Yeah, meme-ish, or just sort of, very much kind of the stocks that travel socially, or that have
volatility.
There's a lot of those stocks got trashed in the November pullback, and somebody might say that's an opportunity.
I'm sorry, this has already been answered, but is this going to affect the open and the trade at 9:30, or does this have nothing to do with it? It's just the futures?
No, it would appear it's just the CME, and it's
just the
platform,
futures.
and they'll probably be up and running before 9:30.
So if you want to trade at 9:30, you can trade at 9:30. You just can't.
Oh, yeah. I think it's all gonna be processed as normal. Yeah.
So those guys can just relax a little bit, take a little time off, and then they can.
People should just relax as a general matter.
They can work their Jones off at 9:30, whatever they need to do. Okay, Mike, thanks so much.
Yep.
Up next, are you ready for some Black Friday? Wait, can I read that? Are you ready for some Black Friday football? Amazon Prime will stream 15 hours of exclusive live sports programming. We're going to speak to Jay Marine of Amazon about today's lineup and the streaming wars, and later small business administrator Kelly Loeffler. Talk Box coming up.
Attention sports fans, Amazon Prime was going to air the Black Friday NFL matchup between the Eagles and the Bears later today. Joining us now, live from Lincoln Field, it's Jay Marine, Amazon head of global sports and advertising, as well as the head of Prime Video in the U.S. Jay, great to see you this morning. 15 hours of live programming today. Tell us what that means for viewers and what it means for Amazon.
Yeah, well, first of all, thanks for having me. It's going to be a fantastic day for Amazon customers today. You know, we started this tradition a couple of years ago with Black Friday football, and we've really invested a lot to grow that on behalf of Amazon customers. So we'll have 15 hours of live sports for fans and customers at home. There's no Prime membership needed. We're making this available for free to all Amazon customers. It all starts at 9 a.m. with the Capital Skins game. We work with the PGA Tour to bring that Skins game back. We'll go then right at 1:30 right into our pregame for Black Friday football. We have an incredible matchup with the Eagles hosting the Bears, both teams in first place in their division. And of course, the crowd and atmosphere at Philadelphia is just fantastic. And then we'll go right from there to Madison Square Garden, where the Knicks are hosting the Bucks. That's actually an NBA Cup elimination game. And then we'll go out west, where Luka and the Lakers are going to host the Mavs. So really, if you're a sports fan and an Amazon customer, it's going to be a fantastic day. And we're going to have Black Friday deals happening all throughout the day that you can shop throughout the game and really take action right from your couch to take advantage of all those deals today.
Well, I can see why sports fans would love this. Now, from an investor point of view, we know that Amazon has invested a ton of money into the NBA, into the NFL, into these other sports franchises to get these licenses. What return are you seeing so far, or what returns do you expect from all that investment?
Yeah, it's a good question. It is sports are really working for us. You know, we've been at this for a while now, and it's not just here in the U.S. Of course, we have the NFL, NBA, as you mentioned. We have NASCAR. We recently announced we'll be broadcasting 4 additional hours of the Masters. But in Europe, we have Champions League soccer across the UK, Italy, and Germany. In Canada, we have NHL. So what you really see us doing is bringing Prime members the biggest top-tier sports in their country. And so our goal is to add more value to Prime, make Prime the best membership program in the world. So what does that mean? That means Prime members are getting more value than we're asking them to pay. And sports is another piece to that, to add on to everything we're doing in entertainment in Prime Video, everything we're doing with same-day shipping across the retail business, as well as Prime Music. So if we continue to do that and deliver for fans and deliver for Prime members, the rest takes care of itself. And we like what we're seeing. And you know, the other thing I should probably add here is advertisers also like what they're seeing with us. So, you know, as you can imagine on Black Friday, but also across the entire year, advertisers have responded to what we're able to offer on Prime Video in our entertainment as well as in sports, because we can really offer full funnel advertising and a chance to really close the loop all the way to purchase, which is great for customers, but it's also great for advertisers.
Hey, Jay, that was what I was going to kind of follow up and dig a little deeper into. I understand Amazon saying, okay, Amazon Prime has to be very important, Prime Video has to be very important to driving and making sure we're offering all of these things. But about also as the business leader of Prime Video, you're looking at it and saying we want to be profitable. I know advertising for Black Friday on Prime Video is up 40% year over year, and that's incredibly impressive. But is Prime Video profitable if you strip it out and just look at what you're spending versus what you're making?
Yeah, I think, as you know, we don't break that out. What I would say is we really like what we're seeing. And as proof of that, you see us investing more in sports, continuing to invest more in entertainment. Because at the end of the day, it all has to make sense and make financial sense and over the long run. And what we're seeing, we really like on that trajectory, which is why you continue to see us do more. And we're always going to try to find ways to invest more on behalf of Prime members and into the Prime membership. I should also add that the other thing we're doing differently this year as a first is all of these sporting events are going to be made available globally. So again, that's free to any Amazon customer globally. And so this will be the first year we're taking an NFL game globally. And, I give a huge amount of credit to Roger Goodell and that whole team for helping us to make that happen. And they've really done a fantastic job growing their international fan base with the number of games they're playing across the globe. And you watch the fandom that turns out for those games, whether it's in Munich or London. It's really fantastic. So we're excited to be a part of that.
All right, Jay, joining us from Lincoln Field. It's going to be a great game today between the Eagles and the Bears. We appreciate your time. Thanks so much.
Thank you. Have a great Black Friday.
And by great, I think he means buy a lot of stuff online.
While watching Prime Video, of course.
Exactly. All right, when we come back, U.S. Small Business Administrator Kelly Loeffler is going to be joining us ahead of Small Business Saturday. We've got that interview next and some breaking news as we head to a break. The CME says that stock index futures are set to resume trading at 8:30 a.m. Eastern Time. That is less than 15 minutes from now. Squawk Box, we'll be right back. Holiday shopping is in full swing today, and tomorrow marks Small Business Saturday. According to the Small Business Administration, there are 36 million small businesses in the United States that employ almost 46% of the private sector workforce. Joining us right now is Kelly Leffler, Administrator of the Small Business Administration, and thank you so much for being here today, Administrator. Let's talk a little bit about, first, what you're seeing in terms of the health of small businesses at this moment.
Well, good morning, Becky. Great to be with y'all. Look, small businesses are more optimistic than they've been in 7 years, according to the data. In fact, small business confidence is above its 52-year average, even after a protracted 43-day government shutdown that affected thousands of small businesses. And that's because President Trump's agenda has created tailwinds for small businesses that we haven't seen in 4 years. So what we've got going now are tax cuts, deregulation, fair trade, and we see that playing out across the economy with strong economic growth from GDP, rises in U.S. capital goods orders, inflation coming down to about half of where it was under the Biden administration. So all of this has set us up for a great shopping season, which is forecast to surpass $1 trillion as we head into the Christmas season. So this is all thanks to the President Trump's agenda that has empowered small businesses and stopped the government crowding out of big government spending, high inflation, high interest rates, and we see all that reversing under President Trump.
Deregulation is certainly something that small businesses say they desire every time we talk to any small business or anyone who represents the small business community. But we do hear from small businesses that are really frustrated when it comes to some of the tariffs, particularly because they have a harder time sidestepping or lobbying against or trying to get exemptions from those tariffs. It's a little harder to navigate when you're a small company, or much harder, I should say, than if you're a big company and you have the manpower to be able to do that. What do you tell small businesses when it comes to anybody who's caught up in any of the tariff uncertainty?
Well, it's actually what I'm hearing from small businesses as I walk hundreds of factory floors. Becky, as you may know, 98% of all U.S. manufacturers are small businesses, and they were left behind by decades of unfair trade practices that were the result of bad economic and political policy, and President Trump is reversing that to empower U.S. producers, finally put a level playing field to restore jobs in this country, and the president believes in the American industry and the American worker. We see the labor force participation ticking up as a result, but small businesses say the number one concern they have now is a skilled workforce. It's not tariffs. It was taxes and inflation, but thanks to this economic agenda, that's getting reversed. And so now we're really focused on skilled workforce to build those made-in-America products that consumers want. And that's where you've seen retail sales be really strong because they know the American comeback is well underway.
Small Business Saturday is a big deal. I think it was started back in 2011. What do you see on Small Business Saturday? Are people actually making sure they get out and frequent those small businesses?
Absolutely. Look, 77% of Americans surveyed said they would do all of their Christmas shopping at a small business if they could, but 66% don't even know about Small Business Saturday, so that's why we're getting ahead of it today. I mean, Black Friday today is a perfect day to start with small business. Look, these are our local job creators. 70% of every dollar spent at a small business stays in the local community, compared to about 15% at big box. And under President Trump, small businesses are flourishing. You just heard the Shopify CEO saying every 26 seconds a new small business gets their first sale. Well, we're seeing that on Main Street, that they're all getting ready for a Small Business Saturday, where as much as 20% as their annual revenues could be created on this single day. It's a make or break day, so I'm encouraging everyone to support small businesses, support your local communities, job creators, and the great employees that are providing a memorable experience. I promise you there won't be any fights breaking out over big screen TVs at a small business.
Administrator Leffler, go ahead, Steve.
I just want to be clear about something. I'm looking at the NFIB Small Business Optimism Index, and it peaked in December with a lot of optimism among businesses about the election of the president. And I have a number here on a seasonally adjusted basis of 112. It has fallen pretty steadily, including falling steadily the last 3 months, down to a number that is 107 now. Are you concerned at all that some of the policies of the president might be catching up with small business, the issue of finding labor when it comes to immigration, the issue of tariffs, and the inability really of small businesses to adapt in a way that large businesses have difficult, it's easier for them relative to small business to adapt to the tariffs?
Well, Steve, great question. Small businesses want skilled U.S. labor. They want that steady workforce, and that's what's exciting. You just saw the jobs report in September, doubling projections at 119,000, so those jobs are coming back, participation's coming back. What I hear from small businesses, their biggest concern really is making sure that we continue that labor pipeline. But look, small business optimism took a hit in October because of the Democrat shutdown. 43 days that over 10,000 small businesses couldn't get access to capital just in SBA lending alone. 65,000 small business contractors were shut out of government contracts due to stop work orders that cost the economy $12 billion a month. So of course you're going to have some puts and takes, but it's still above its 52-year average, and they tell me state by state, they are spring-loaded for growth thanks to the working family tax cuts that President Trump pushed through, and this deregulatory agenda is rocket fuel for small business.
So that was something we discussed briefly, which is, do you think most small businesses know about these tax cuts? Which is, I talked to some people at the Treasury who said you could really get an investment boom because people are unfamiliar with the changes that happen in the tax bill.
Well, you're exactly right, and that's why I spend almost every week traveling across the country nonstop, visiting our small manufacturers who are just spring-loaded to invest. It's 100% expensing not only for capital purchases, but for R&D. And so small businesses generally know about it. The 20% pass-through deduction made permanent. There are so many great things in that tax bill, no tax on tips and overtime, of which double-digit Americans are going to benefit from and have huge refund checks. It's going to bring people into the workforce. It's going to create more overtime. So yeah, there's a lot more to talk about in this great one big beautiful bill that brought working family tax cuts for the first time in 4 years, and almost, if they had not been passed, a $4 trillion tax hike on small businesses and hardworking Americans. So they have a lot to be excited about for 2026.
Administrator Leffler, thank you for joining us.
Thank you, Becky.
All right, coming up, Black Friday shopping is underway. You're looking live at Roosevelt Field Mall in Garden City, New York. We'll talk to an executive from a company that develops and manages malls in Michigan and Florida. That's coming up next.
Welcome back to Squawk Box, everybody. It's just after 8:30 a.m. on the East Coast, and we are watching the futures market. Stock index futures have actually now reopened after an outage at a data center for the CME. You can now see that, yes, we are in positive territory. Dow futures are up by about 70 points. S&P futures up by close to 10. The NASDAQ up by 80. And by the way, this comes on the back of 4 days in a row of gains for the major averages. This has been a pretty strong week in what has overall been a weak month.
It's going the other way now. There's some traders that were like, they were having withdrawal symptoms. You're going to be able to trade for all morning.
Here we go, folks.
Okay, our next guest will give us his insights on holiday retail and the state of the consumer. Joining us now, Nate Forbes, managing partner of the Forbes Company, who owns, develops, and manages high-end shopping centers in Florida and Michigan. So the story that we get, Nate, is that you're okay. You're on the upper part of the K-shaped economy. Give us an idea of what you're seeing in your malls when it comes to the higher income consumer.
Yeah, you know what, Steve, the higher end's really held firm. And I think the scarcity of product on the higher end is what's driving our retail sales. And those with the highest levels of income are continuing to shop. They're showing stability in the marketplace. They're showing a drive and a need to consume and invest in material pieces that will stay in their closet and really stand the test of time. So it's been very resilient.
I want to stop you, Nate, because this whole idea of not having enough product, what's going on with that? When in America did we never have enough product?
You know what, I think it's a balance between the retail brands and the stores. And I think some of it is done to increase prices. So you see a little bit of an upswing in driving an increase of prices, which a lot of that has been borne by the consumer. But it's not hurting brands like Chanel and Hermes that are not so widely distributed, Steve. And they really try to limit their distribution, and they try to create that scarcity, and that's what allows them to drive prices. And the consumers that follow those goods and collect those goods have to have them at any cost.
What could you tell us, Nate, because we had a nice conversation in the last hour, that luxury is not driven strictly by wealthy people, but also by aspirational people who want to trade up and want something nicer for themselves. What's happening with that cohort of shopper right now?
You know, I've said for years, the Gap shopper of today is the Gucci shopper of tomorrow, and I think that aspirational shopper really drives and really works hard and wants to spend a lot of their disposable income on having high-end product, whether that's product with labels or that's product that goes down the runway or tunnel walks. And they're really driven by the aspirational consumer that believes that if you follow the social media post and follow what's hot and what's new, that you're going to be with the latest trends. And that's what they're displaying today on their backs.
Nate, at the end of the day, you can talk retail all you want, but if you own a mall, you're a real estate guy. And if you're a real estate guy, you're a rates guy. So tell me about the outlook when it comes to debt and rates and how much all of that matters for you in terms of financings and refinancings.
No, I think it matters a lot, Steve. I mean, we watch the debt markets every day. And I think right now where we are with the short curve and the long curve, the 10-year curve, I think we'll be within a band of 50 to 75 basis points of that for the next couple years. I think you might see a couple ticks down in 2026. And I think all of those that have retail or residential or commercial coming due, we plan ahead, we look at our long-term debt expirations, and we try to finance within a band that will allow us to continue to reinvest in our assets, invest in our consumers, invest in our projects and properties to make sure we're at the highest end and the highest level of retail shopping centers across the country.
Nate, it's Robert Frank here. The word of the year in luxury seems to be experiences, with all this money shifted from things and status goods to experiences. I know you try to create experiences at all of your malls, but what I'm seeing when I talk to LVMH, Kering, Richemont, all the big luxury companies is they want fewer stores, but they want big flagship stores that have cafes, they have special pieces, they have VIP rooms. They build these sort of fewer stores into luxury experiences. Ultimately, do you see that sort of smaller footprint by these luxury companies hurting malls like yours?
Well, I would tell you this. First of all, I think when luxury was coming out of COVID, luxury expanded beyond their boundaries. And now they're starting to peel that back. So they're looking, number one, at all the gateway cities where they can have freestanding flagship stores in downtown areas. Number two, they'll go to the best regional shopping centers outside of those areas as their next strategy for growth. So if you're in the top 50 shopping centers in America, brick and mortar shopping centers, not downtown areas, top 35 to 50, you're in a good spot, because those luxury consumers are depending less and less on department stores and more on creating their own experience in a way to touch the consumer, develop those relationships, and develop loyalty with their consumer base.
Nate, just one more question. I want to go back to the debt. Are you feeling confident enough about current rates now that you would go into, say, fixed financing, or you're still floating, or are you going to mix in a hybrid of the two to hedge your bets?
So Steve, we've done a couple in the last 6 months, and we've stayed short term. So we've been between 3 and 5 years on our last handful of financings, and we have fixed those rates, bought a cap, fixed the rates, locked them in for 3 to 5 years, and feel good when those expirations hit. We're going to be in another band, in another period of time where we probably think about doing the same thing. But right now we're focused on the short term, and for us that's about 3 to 5 years.
I just love the opportunity to come on and quiz these guys about their financings, because it's just so interesting, because I go from the theoretical, the Fed is going to cut rates a quarter or not, and these guys are out there making deals and making stuff happen, and it's interesting right now. I mean, there's plenty of liquidity though, Nate, right? In terms of going out and selling it, that's really a key for your ability to do what you want to do.
I think there's a lot of liquidity in the market. The key is going to be that the loan value, your loan amount to the value of the asset. So we don't like to over leverage. We like to maintain a nice safety valve. We want to be in a position to withstand all kind of economic downturns. So we are not in a position to over lever our portfolio, and we.
Nate, are you acquisitive here? Do you feel like this is a moment here to be out there buying things? And I mean that both in terms of value in the real estate, but also ability to raise debt and financing to do deals.
We take a very conservative approach, Steve, and the numbers, the underwriting has to work. You have to have a safety margin safety on the low end. So as long as you protect your downside and you have a long-term view, the upside in real estate will take care of itself. But you better make sure you have a margin of safety that's pretty comfortable.
Hey, Nate, I realize on the luxury end, things are working pretty well. What happens to some of the B or C class malls that are out there? I mean, I see some of these places that have been closed for years. I don't think they're ever going to open. What happens to those places?
Yeah, Becky, it's a real transition for our business, because a lot of these older malls either have to repurpose and reposition themselves. A lot of them will go to box uses. A lot of them will be torn down, or sections of them will be torn down to allow the way for multifamily development for residential housing with a combination of retail box uses. So if you have good real estate, you look to position these things long term, and that involves reinvestment and repositioning of those assets.
Do you get involved with any of that stuff, or is that just a no-go for you?
Well, we've looked at a lot of it, Becky. It's really hard to make those numbers work, because part of those malls are functioning. There's a net operating income that's in place, so you got to buy into an existing center that has net operating income, and then have enough money and capital to spend on repositioning half of that asset, which is going to need to be torn down, converted to different uses, and it makes the numbers very challenging.
I've seen different uses in some places. Like you have a seasonal place that comes in, like a Spirit Halloween followed up by a Spirit Christmas store, or maybe a hospital takes over and has some doctor's offices that are set up in some of these places. What other unique and different, I mean, I was thinking that some of these places should be turned into, basketball and volleyball training centers or different things. You look at what consumers need right now versus what they don't need. What have been the most interesting use cases that you've seen that are different from what these places used to be used for?
Yeah, it's really hard. I mean, they'll put in, when you have vacancies, you'll put in whatever comes your way. So I've seen them convert to pickleball, paddleball clubs and courts. They do pop-ups over seasons. They'll do big football showings up here in the Detroit area. A couple times you'll see on a big Saturday or Sunday football weekend, they'll convert them into kind of temporary theaters, and they'll sell food and beverage and show the game and attract people. And they'll do creative different things as a way to fill space, so these shopping centers, these B and C malls, as you rate them, don't sit empty and vacant.
But you don't like to buy them blow them up and build on the property there. And I'm asking that question made in part because some of these units and some of these properties, they end up being owned by the government, right? Through taxes, there's a series of those as well. So do you get involved in any of that in terms of restoring them?
Not a lot, Steve. Again, it's really tough to make those work. In a lot of cases, these department stores, they own their own building, they own their parking areas. So if you take a 60-acre piece of ground and you have two department stores that are operating, they might own, half of the land, and you can't get access to that land. So now you're only dealing with half of that development, and you have to operate the ring road, you got to operate the parking lots. So it really is project specific and depends on what the reciprocal easement agreement allows you to do for that particular asset.
Nick, thank you so much for joining us today and walking us through all these aspects of your business.
Thank you, guys. Happy holidays.
We talk about the K-shaped economy. He's the C-shaped, the Chanel-shaped economy. So we're doing well. Coming up, futures markets back online, finally. After a CME outage earlier this morning, we're going to tell you what you need to know ahead of the shortened trading session today. And we're going to talk about Black Friday and how consumers are using AI to shop this year. You're looking at a live shot of the Tyson's Corner Center in Fairfax County. We got malls all over the place this morning.
While U.S. families gathered for Thanksgiving yesterday, they were also shopping. New data from Adobe says consumers spent $6.4 billion on Thanksgiving. That's up 5.3% year over year. Adobe expects a record $11.7 billion in sales today. That would be up 8.3% year over year. For Cyber Monday, it's looking for consumers to shell out $14.2 billion, or a 6.3% increase year over year. So, Robert, the consumer does not seem strapped based on that data. These are expectations.
Again, we're looking at aggregate data, and it's like, sure, if your head is in the oven and your feet are in the freezer, your average temperature is fine. But it's really a bifurcated market where it's the top that are driving things, and most of the other consumers.
You think only your people are shopping?
No, I don't think it's only my people, but I think it's a spectrum where a large part of the spending. I mean, we've seen these estimates from Moody's and others that the top 20% or 10% are now accounting for about half the spending, and I don't think it's just this sort of top 1 or 10%, but I do think the higher up you go on the income and wealth ladder, the more spending you're doing as a share of the economy right now. And a lot of consumers are just under pressure.
Okay.
But our next guest says this holiday season could see the rise of AI enthusiasm after built up the AI fears of the past year, with research showing consumers plan to use AI to shop for gifts this year. Joining us now, Rosenblatt Securities Senior Research Analyst Barton Crockett. Barton, it's great to see you. I want to actually pivot back a little bit to what's happening in the markets, what we've seen particularly earlier this week on the Google, Meta, NVIDIA trade. You were on about a month ago saying that you believe that Alphabet or OpenAI could be the next Google. In fact, the market was sort of looking at it as Google could become the next OpenAI, i.e. the leader in the AI space. So how do you read, I mean, Alphabet stock obviously on a tear the past few days. What do you see, and I think you have a neutral rating on Alphabet. How do you look at Alphabet, OpenAI, and NVIDIA?
Sure. Look, I do believe that the LLM benchmark horse race is likely to be a horse race. I mean, the amount of capital, the amount of expertise marshaled by the likes of OpenAI, now also by the likes of Meta, suggests that, Gemini 3's win is not likely to be every day's win, that these other guys will come out with releases that are better. We saw some hint of that with Claude and Anthropic. So that's a different world. I mean, you see in LLMs, Google, one of the leaders. In search, they're the dominant player, the only winner. So what I think the market has done with Google is they've sprinted to the notion that LLMs, AI, will be a winner-take-all. They've priced that into the stock. And they've looked at others and they've said, you guys are losers. And look, I would lean against that today in this way, which is, I would think a lot about Meta. I think it's hard to find a company that has a clearer ROIC on AI spend argument than Meta. The AI spending has accelerated their ad growth into the 20-25% range. They've talked about $60 billion of annualized recurring revenue from their end-to-end AI performance ad tools. AI is revolutionizing the direct marketing advertising space, and Meta is a great play on that. And if their CapEx goes from $40 billion in 2024 to over $100 billion next year, that's $60 billion to spend, and they're arguably covering that just with the ARR from their performance tools.
So I want to mention that because they are spending a lot of money, and there's been a lot of turnover in executives and talent in Meta's AI division. What makes you confident that with $100 billion in spend in the future, that they're going to get that return and that they're going to maintain some kind of lead? Because you would think they have to be in the LLM space, compete with OpenAI and Google.
Right. I mean, the argument is they've already gotten the return. I mean, they said on their third quarter call, $60 billion in annualized recurring revenue from their end-to-end AI advertising performance tools. That revenue is largely margin, and that compares to $60 billion of higher CapEx, perhaps in 2026 versus 2024. So you've covered that with the incremental revenue very quickly. And that's not providing any credit for the call option on other things like maybe personalized AI does lead to something, which is their vision. Certainly it's helped kind of engagement from users within their website and helped them in myriad other ways. So, they're getting a great return on investment from this spend, and the market should be applauding that.
Pardon, I know enough not to think of things as zero sum, but is the money coming from someplace else? Is this whole technology taking revenue, taking business from another technology, or is it added? In other words, people weren't spending this money before, and now they're going to find ways to spend new money.
So, if you're thinking about advertising, there's this clear megatrend, right, which is legacy media, linear television is a source of funds, and performance media, challenger brands is where the new spend is going. And, Meta dominates that. And, it's interesting, the AI has boosted their ad growth, well above what the AI has done for Google. I mean, Google Search, Google YouTube, mid-teens growth hasn't really inflected to the degree that we've seen at Meta. So, it's, certainly I think all performance marketing is benefiting from this big share shift in advertising. I think you've kind of thrown the baby out with the bathwater with the pressure on Meta.
Right, Barton, just to wrap it up, other than Meta, which clearly you favor, are there any other stocks in this category or for the rest of the year or next year that you think investors should know about?
Well, look, I think that one of the things that's going to be emerging is the idea that AI is driving a return on investment. And I think you're seeing that visibly at Meta, and I think we're starting to see that at Amazon, particularly in AWS, where they've got traction with some great new deals, with the government, with OpenAI, but also with their reInvent annual conference coming up next week. We're going to see some more news, I think those guys are benefiting in AWS, and I think AI is going to be helpful for their e-commerce business as consumers use their assistant tool, Rufus, and others. They're outpacing the rest of retail, and I think that's going to be a good story over the holidays.
Yeah, they're certainly all connected. That's one thing we've learned. Barton, thanks so much for joining us. We appreciate it. Happy Black Friday.
Great, thank you.
Okay, coming up, the morning's must-know stories, including an update on that overnight outage at the CME. Squawk Box coming right back. right, welcome back to Squawk Box. We're talking about regressions in AI. We're stock index futures have resumed trading. Let's go to Dom Chu for a look at what's finally moving, Dom.
Well, outside of those stock indices and those futures tied to them, let's take a look at some of the stocks that we are individually focusing on today. And of course, with it being Black Friday, the retailers are always in focus. So here's a pre-market check on some of the big names that we track all the time. Ross Stores right now currently down just about 0.2%, but Amazon, Target, Walmart, and Best Buy, all among the names to watch, all up between 0.25% to 1%. So Black Friday done and dusted. Let's move on to another big part of that trade that we're seeing so far. These names right here have seen some of the biggest bounces within the S&P 500 so far this week. Robinhood Markets, Broadcom, Applied Materials, Coinbase, and United Airlines are anywhere up from 10 to 20% on a one-week basis. Right now, they're all up again in the green in the pre-market trade, so keep an eye on some of those momentum plays on the shorter-term trade. And then, of course, with the Mag 7 big stocks out there, these ones are among the biggest gainers in that elite group of mega-cap technology and comm services. Alphabet, of course, Amazon, Microsoft, Meta Platforms, and Tesla, all up fractionally. Alphabet's continuing that trend higher, up about 1.25% as well. So Steve, Becky, Roberts, some of the names that we are talking about a lot this week as we close out the month in the green. I'll send things back over to you guys.
Any retail stocks at all, other than the one Amazon, obviously, on your chart there that are sticking out this morning?
Well, Ross Stores is an interesting one because we oftentimes talk about the trade right now, about the value hunt these days. So off-price retailers might be something to focus on. Burlington Stores has been another one that's been talked about a little bit, but it hasn't really traded at all pre-market. So we'll keep an eye on some of those ones. But consumer electronics, always a big trade for Black Friday and Cyber Monday. So Best Buy, a key stock there. So I guess if you take a look at some of these names, Amazon's going to be one of those ones everyone talks about, especially ahead of Cyber Monday. We'll keep an eye on whether or not that's going to be the case this time around as well.
Hey, Dom, are the clubs away for the season now, or are you...
The clubs are effectively away for the season, but thanks to some very, very good golfing buddies who have places down in Florida, I do make a trip a couple times during the season to go hit the golf.
Put a down jacket on and go out with that nice sweater you got.
Although I will say this, sometimes in Florida, in December through February, it actually does get rather cold out there.
I'm still throwing a fly rod. 40 degrees is mine.
That's the over-under right there?
It was 31 this morning.
No, I'm done.
It was cold. All right, happening on Squawk Box this morning, many of the normal data points that we track were offline today because of data disruption at the CME at a data center there. Some of those systems, though, most of them, including the S&P futures, are now coming back online, which is why we're able to see where things stand at this point. In the meantime, the Starbucks Workers Union is ramping up its strike, coinciding with the start of the shopping season. Hard to shop till you drop with no caffeine, but 120 stores in 85 cities are now impacted as employees demand more staffing at stores and higher pay. And data out just a few minutes ago from Adobe showing online shopping on Thanksgiving Day was up 5% from last year, consumers spending $6.4 billion. Adobe's expected to record online shopping today totaling more than $11 billion in sales. Now, let's take a final check on the markets, and maybe a first check almost, since things were closed for most of this session because of that data disruption. You're now looking at the Dow futures up by about 67 points. S&P futures up by 12. The NASDAQ up by 78. This comes after 4 days in a row of gains for the major averages, but for the month, they are still below. You're looking at, I think, the S&P down by about 0.4% for the month to date. The Dow down by 0.3%, and then the NASDAQ off by about 2.1% for the month to date. If you check out Treasuries this morning, you'll see right now the 10-year is yielding 3.99, the 2-year is at 3.48, and then oil prices very quickly. Energy is higher. WTI up by about 0.3 to 58.84. I want to thank both Robert and Steve for being here with me today. Thank you guys. We appreciate it.
Happy holidays to all of our CNBC family and viewers.
That's right. Make sure you join us on Monday. Right now it's time for Squawk on the Street.
Friday morning. Welcome to Squawk on the Street. I'm Carl Kingston here with David Faber and Sarah Eisen at Post 9 at the New York Stock Exchange. Kramer has the morning off. Final trading day of November. S&P goes for its 7th straight monthly gain. If some of these gains hold, it's an early close for stocks and bonds. We are still recovering from this trading halt halted the CME due to a data center cooling issue, which did knock out futures and options across markets. Our roadmap begins with the markets as we wrap up this final day of the month. S&P goes for its best Thanksgiving week in over a decade.
Plus the AI trade going into year-end as Alphabet, of course, continues that historic run. NVIDIA shares, they're deep into a correction territory right now.
And Black Friday, kicking off the crucial holiday shopping season. We'll get the early read and discuss which retailers are best positioned right now.
Let's begin with futures, which are resuming after being halted by the CME overnight due to this data center cooling issue. We're still learning more about it, talking about the vendor here, which I think, David, is a KKR property, but sort of draws attention to the cooling issue, which is just getting started if this AI demand keeps up.
That's a good point. It just overall reminds you of the vulnerabilities in the system of companies few have perhaps heard of. You're right, CyrusOne was briefly a public company taken private by KKR some time back. But, you know what, these kinds of things, yes. I mean, given the rapid construction of data centers across the country, of course, and how often we talk about power, the power is key to cooling these, given how hot GPUs can run. And so it is an interesting point, Carl, to sort of think about. I'm not sure what exactly was at issue here or why they had the issue. I'm not sure we've learned that much about it at this point.
Yeah, you hear data centers and cooling and think, uh-oh. I guess the last time something like this happened was back in 2019, so 6 years ago. It didn't last quite as long as this. On one hand, it's not bad that it, not awful that it came today. There's no economic data today. It's a shortened holiday trading day. Although,
month end.
It is month end, and so it is important for sort of settlements and rollovers. But it does appear to be back on track. Also, didn't affect individual stocks, right? So the individual stock futures traded. Google, I saw Alphabet was trading higher in the pre-market. So not necessarily a tell on what's going to happen with the resumption of the AI trade, which is sort of back on, and why this week looks a lot better. It's so interesting that in the month end, for November, yes, it's a down month for the NASDAQ, but at one point the S&P was down almost 5%, and it looks like it's going to close closer to the flat line. I mean, down for the month, but not as bad as it was. Things have really picked up in the last week or so.
Yeah, no, we were at one point, David, on track for the worst November since 2008. And we managed to claw back quite a bit.
Yeah, well, a lot of that due to just the performance of Alphabet alone, the likes of which we've discussed every day. Now, it was, it did get back a bit, of course, as it sort of approached that $4 trillion market cap and then backed off ever so slightly. You do have sort of these opposing camps almost now that have been formed in investors' eyes, namely the ecosystem sort of around Alphabet that certainly includes names such as Broadcom, AVGO, or Celestica, and to a lesser extent, or others as well, sort of in that. And then you've got the OpenAI ecosystem, and we certainly think about Oracle there. We've talked often about the decline in those shares of late, or certainly over the last month as well. CoreWeave, any number of other companies. But that, I don't know, Sarah, if you've seen these two charts that sort of have been making the rounds with all the different names.
The Alphabet ecosystem and the OpenAI ecosystem.
Correct, right.
The OpenAI pals, the Oracles, and the SoftBanks haven't fared as well.
No, and SoftBank is another name, I'm glad you mentioned, that's been played in some ways as a proxy almost for OpenAI. Of course, it's a private company. Is OpenAI, the $500 billion value at least the last time that its employees were able to sell shares, they did so at that value. But if it was a public company, it probably would be down since then. And you can see what's happened to SoftBank. I mean, just take a look at the month to date. Talk about November in general, is this the last trading day? But wow, that has been one ugly month, and in part because they are so closely aligned with OpenAI.
Oracle's down 22% month to date.
Yeah.
On a related note, and also these concerns about the rising debt levels and borrowing costs.
There have been any number of rumors around Oracle. In fact, I can combat one of them, this idea that somehow they would try and raise equity with a large partner of some kind, a sovereign. Everything I hear indicates that is not on the table. But it goes to this idea, well, do they need to raise more money? And it is important to remember that while they do have enormous commitments at Oracle, and we know they've done a big bond deal not that long ago, some $18 billion, the fact is, the building of the data centers is done by partners. For example, Abilene, the lead is Crusoe. That's where a lot of the initial borrowing takes place from banks to build the actual structure. Then Oracle comes in and puts all the stuff in there. And by the way, that's the real expense, but that's not today. That's yet to come when, of course, the actual structure fully takes shape.
Yeah. Interesting piece in the FT today looking at this Morgan Stanley recommendation where they previously said go long Oracle CDS, but hedge it by going long the bonds as well. Now they're just saying take out the long position and just go long CDS. Which is, a way of shorting AI in a sense.
It is.
The FT calls Oracle the runt of the hyperscaler litter.
And it is in the sense of, even though it's an enormous company with large cash flows, it has gone to negative free cash flow as a result of all the spending that it is committed to doing, that it is doing, and it doesn't compare favorably to the likes of a Microsoft, an Amazon, a Meta, or an Alphabet when it comes to the ability to obviously continue to spend. We talk so often about the enormity of the spending, but we couple that as well with the enormity of the cash flows of the companies that I just mentioned. Not quite the same for Oracle, which though is very committed to its strategy. And you can see it's been a great trade, obviously, to have bought that CDS at any point in the last month.
Yeah, we are going to get earnings from Oracle before the end of the year, along with, I think, Broadcom and Marvell. So the Morgan Stanley note suggests be on the lookout for an updated financial plan, although they also say that might underwhelm or might even be delayed. We'll see what we get.
Yeah, I don't know that there's going to be any real change. I just don't know. Obviously, we will be closely attuned to it. And again, when we come back to OpenAI, we have to, it's still very much unclear what exactly their subscriber numbers are going to look like, or their, I should say, monthly and weekly average users are going to look like. Subscribers as a percent of that is also very important, those who are actually paying. But a lot will ride on that. Brad Gerstner, who knows the company well, a big supporter, owner, of course, of OpenAI, in a recent post I cited on Wednesday, but certainly pointing to 900 million weekly users being the next threshold that they may already have crossed. We just haven't gotten any information, at least officially.
Right. You saw the Apollo chart today, looking at AI adoption.
Kind of leveling off.
We're backing off since the levels of the summer. This is all out of Apollo and Torsten.
So all of these are what you're saying is, that was the story of the month of November. It was that, the market got pickier and the market started scrutinizing. And we were going into November saying, are we in an AI bubble? Because things were just going straight up. And that's not what happened. NVIDIA is down a little more than 10% for the month. And it's 15% off its high. And now we're wondering about the credit picture of companies like Oracle, or the revenues and adoption rates of AI companies like OpenAI. That's healthy, right? It tells us that it's not necessarily bubble-like behavior, and in fact the market has really started picking different winners and losers, i.e. Alphabet has been really strong, but some of the other AI players have been weak. So that's the story. That, and the other question that was really propelling this market straight up so far this year, which was the Fed doing insurance cuts, on a healthy economy, getting ahead of weakness in the labor market by cutting interest rates. That was sort of questioned, especially a few weeks ago, by some Fed members that didn't seem like they were in the mood to be cutting, and a labor market that is showing increasing signs of weakness. And so there goes the whole, the Fed can get ahead of it, insurance cuts. If they're still worried about inflation, and if the labor market is weakening further, that paints a more complicated picture ahead. So I think those two things, the questions around AI and the Fed and the economy, that's really what's happened. And it's why we're a little bit more optimistic now, because now the odds go back to 80% that the Fed cuts in December. Meantime, crucial holiday shopping season is also getting underway. Let's get an early read on this Black Friday holiday. Courtney Reagan is live at the mall in Paramus, New Jersey. So what does it look like, Courtney? Actually, the traffic is really picking up here, Sarah. This mall has been open for about 2 hours. I counted more than 70 people in line at Lululemon before the doors opened, about 40 at Hollister. Our CNBC crew outside a DC mall in Tyson's Corner said they also counted about 100 people in line at Lululemon. And look, we can look at other malls and see anecdotally what we're seeing, but from what we understand about Black Friday trends and what the expectations are, it's that retail firms do forecast today will be the biggest day for in-store traffic of the year. Maybe it's not as big as what it once was, but it still will be the biggest of 364 other days of the year. The National Retail Federation predicts 130.4 million Americans will shop in some form today, making it the biggest day of this critical 5-day stretch between Thanksgiving and Cyber Monday. Adobe predicts U.S. online sales will hit nearly $12 billion today. That would be up more than 8% from last year, the biggest growth rate of these 5 days. Salesforce says e-commerce sales on Black Friday actually surpassed Cyber Monday totals last year and will again this year. That number is sort of debated depending on how the data sets are pulled. Now, Deloitte and the National Retail Federation do forecast toys to be among the top 3 categories today. Jeffries says the average promotion for toys is around 32% this year. That's down from 38% last year, but thinks Hasbro is having a pretty strong showing for classic games like Connect 4, Sorry, Trouble, and Candyland. Nostalgia is kind of the name of the game across categories. Third-party logistics company ShipBob, it says toys and games were the top category on Thanksgiving Day. It was led by sales of Tony's, again, sort of a children's item, an audio box, and that is one of those ones that was highlighted as a hot item by retailers like Target and Walmart and Kohl's. And Planalytics' Evan Gold tells me that colder weather will be hot for winter apparel. He says that this drop in temperatures, particularly in the eastern half of the United States, should lead to a 5% increase in sales of boots, jackets, hats, and gloves this weekend, and then a 15% lift for early December. Look, I'm even a meteorologist on Black Friday. I mean, if it impacts retail, I'm going to tell you about it. Back over to you guys.
Hey, Court, there's been so much discussion about lower shipments coming into the U.S. from overseas, especially from Asia. Would that mean more limited inventory, and would that essentially mean fewer promotional discounts? Are you seeing anything anecdotal on that front?
So it's so interesting. We talked and looked really closely at the inventory levels when the retailers reported, most of the large ones, to be fair, over the last 10 days. It's not a super clean comparison because of tariffs, right? And inventory is reported in dollar value. But for the most part, when you ask executives, are there going to be shortages? Do you feel like you didn't get the inventory that you wanted? Nobody said yes. Everyone acted like it would be very typical. Even on a day like today, most retail executives said, look, if you end up seeing stockouts of items, it's going to be more about demand rather than supply that was the issue. So expectations were pretty good going into today, especially after those retail results and commentary that we heard sort of throwing water in the face of those consumer confidence numbers. Remember, consumers will say one thing, but often do another.
It's important to have you there as we go into the most important time. Of course, it's going to be a big weekend. That's our Courtney Reagan joining us talking some Black Friday. When we come back, we'll get a closer look at the retailers that might be best positioned for this holiday season. Watch futures here. We need about 68.40 to go green for the month. We're back in a moment.
dig in further on the retail sector on this Black Friday. New data from Adobe expecting a record $11.7 billion in sales today, which would be up more than 8% from last year. But while retailers expect to see a surge in crowds, they are facing a more frugal shopper this year. With us now at Post 9 to break down the holiday expectations amid the macroeconomic uncertainty is UBS senior retail analyst Michael Lasser. It is confusing because we hear all about, the low to middle income consumer getting worse. We hear about uncertainty, we hear about tariffs, and yet we're expecting growth year on year. So how do you characterize what's happening with the consumer?
The way we would characterize the consumer is stable but choiceful, and that's been the case throughout the last several quarters and much of the last few years, where the consumer's coming out for events, and in between those periods being a bit more careful with their spending, and we would expect the same this holiday season.
Is Black Friday one of those events?
Without a doubt. The Turkey 5 holiday weekend is going to see some pretty strong sales, and then what has happened is the drop-off post those periods tends to be deeper each progressive year, and that's going to be the case this year as well.
There were questions about how deep the discounts would be because tariffs. What are you seeing so far?
So we heard from retailers like Dick's Sporting Goods and Best Buy as recently as earlier this week that they expect a more promotional and deeper discounts this year than last year. Because the consumer is under pressure, being really sensitive to those good deals.
That goes against the inflationary story.
Well, what's happening is retailers are taking prices up, and that's providing a little bit more cushion to take some deeper discounts around those key events because the consumer is so sensitive to what they're spending right now.
We were talking during the break about the explosion of ads during football yesterday regarding not just retailer ads, but ChatGPT ads and providing examples of how you would use it to shop. Is the story still about long-term margin compression because it can hunt for deals better than you or I can?
Yeah, this is going to be the last holiday season before the pervasive use of agentic commerce, artificial intelligence becomes widespread. If you're not using it today, you will in the future to assist your holiday shopping experience. We're going to have agents who stand online to get those deals instead of we can enjoy some warm weather in the holidays. It is going to make it more competitive because some of the pricing will become more commoditized and much more attuned to everybody. So retailers are going to have to adjust to a different environment quickly.
Well, how do you see that adjustment playing out, let's call it, over the next year, given you think a year from now we're going to be having a somewhat different conversation?
We are going to have a different conversation. They're going to have to continue to evolve the profit pools. For example, retail media, trying to sell advertisements, has become so much more important to the profitability of retailers. You've heard that consistently over the last few years. That's an example of how these retailers are trying to adjust their models in a world where pricing becomes more ubiquitous for every retailer. So we're going to see that become much more important over time.
Who's the winner?
Who's the winner? Yeah. It's going to be the large, well-positioned players like a Walmart, a Home Depot, a Costco. Those are three retailers that continue to stand out, lead in the deployment of technology to assist the consumer.
You didn't mention it.
The Target is quickly trying to change and improve its performance. We believe as far as the stock, the probability of successful improvement with Target is greater than what's being priced into the stock. So that's why we still like the stock from here, but it's no doubt had some difficult times as of late.
Yeah, there's another retailer. It doesn't usually have any brick and mortar, but it's called Amazon. I'm just curious, given this conversation, what your thoughts are.
Yeah, it is a very competitive environment. Amazon is obviously very important to the retail sector. It's interesting. Amazon's trying to run its own playbook versus Walmart and Target that have now partnered with OpenAI to make their product catalogs available. And so this is going to be interesting to see how this evolves with these different strategies unfolding.
Biggest turnaround story, you think?
Target.
Target?
Without a doubt.
Really?
Yeah.
Of all the names you cover?
Without a doubt.
Where does your conviction come from there?
Conviction comes from a few different things. Number one is they are seeing some improvements in their shopping experience. In stocks or product availability is getting better. Number two, there's going to be a change in leadership. Change should catalyze some better performance. And number three, Target tends to do well when there's a lot of newness in the environment, when it's offering new and innovative products. And there are some good new innovative products in the environment that should benefit Target.
Yeah, I mean, they articulate all of this. They seem to understand what they need to do
They do.
going forward.
I agree with that.
Michael, thank you very much.
Thank
Good to
you.
have you.
Good to see you. Happy holidays.
From UBS. Happy holidays.
When we come back, a look at what to expect from Apple with the holiday season now underway. One more look here at the pre-market as we get started on a shortened session. NYSE closes at 1, bonds at 2. Stay with us. So much drama revolving around Bitcoin and memory. That's one reason we're watching Strategy and Micron so closely, leading the NDX pre-market. By the way, next week we'll get a ton more earnings from Dollar Tree, Dollar General, Salesforce, PVH, HPE, and others. Opening bell coming up in just about 4.5 minutes. Don't forget, you can catch us anytime, anywhere. Just listen to and follow the Squawk on the Street Opening Bell podcast.
Background in business or finance. I needed further insight. Jim was just a person to give me that.
Join the club with Jim's best deal of the year at cnbc.com/Club Black Friday. Terms and restrictions apply.
There's a reason Kitsch has millions of happy customers. We've created sustainable, functional shampoo and conditioner bars made for every type of hair. Our rice water protein bars repair damaged hair and promotes healthy hair growth for everyone. Our coconut oil bars are a perfect match for curly hair. They deliver major moisture and help reduce stubborn frizz. And our purple toning bars help grays and blondes fight brassiness while bringing in much needed hydration. Find the bar that works for you. Visit us at mykitsch.com.
Ready to add a Bitcoin fund to your portfolio? Get the Grayscale Bitcoin Mini Trust ETF.
the Bitcoin Fund, from the world's largest digital asset-focused investment platform. Just search for ticker BTC wherever you invest. Grayscale. Invest in your share of the future.
ServiceNow connects every corner of your business, putting AI to work for people.
Every corner?
Every corner, Nick. So, Kate, in HR, you focus on people, not process. Patty in IT is using AI agents to deal with the small stuff so she can work on the big stuff. AI helps Jim solve customer problems before they're problems.
Oh, so we all work better together.
My work here is done.
Excuse me, which way back?
Watch this! It's the Helio Air Broom, the lightweight, flexible broom that's sweeping the nation. Ordinary brooms only get half the mess, but Air Broom's Ultra Flex blade lifts and grips and leaves nothing behind. Even pet hair comes right out of carpets easy. For any mess, wet or dry, big or small, Helio gets them all. Get your Helio Air Broom and we'll include our Helio dustpan, plus our Helio Mini that cleans carpet better than a vacuum. Get your Helio Air Broom 3-piece set at helioairbroom.com.
Nuveen invests with the foresight and vision to anticipate the needs of future generations, to build strong portfolios that deliver lasting legacies, to innovate and adapt for what's just around the corner. Because after 125 years of yesterdays, Nuveen knows your ultimate stakeholder is tomorrow. Nuveen, invest like the future is watching.
The opening bell is brought to you by Nuveen. Invest like the future is watching.
With the opening bell about 90 seconds away, let's bring in our senior markets commentator, Mike Santoli, talk about the month in review and what a close shave it was sort of mid-November there.
For sure. Everybody was running their studies of, okay, what happens when the S&P's been up 6 straight months, but then not a 7th? And actually was a net positive message on that. In other words, when that's happened in the past, usually the market resumes the upward trend. Well, now we're kind of nip and tuck for an up month on a price basis for the S&P 500. And guess what? Even 7 straight months higher, it usually also has positive implications. Momentum's a real thing. I do think that what we saw in the last 4 days in particular was, the market getting just oversold enough below the surface to be perfectly ready for, the dovish turn in Fed speak, the fact that Bitcoin stabilized, and all the things that were pressuring it. The other piece of it is the rethink of the AI trade could have been much messier, but Alphabet rescued the market. Absent what Alphabet did this month, we're not talking about us possibly being up for November. Whether that matters or not, it just shows you that it's rotational around the AI theme. It's not all in or all out.
Mike, don't go anywhere. Let's get this opening bell and the CNBC real-time exchange. At the big board today, it's Amex celebrating celebrating Black Friday. Harley was on Squawk today talking about some of these year-end trends.
I think that overall, the forecast looks good for growth this year on online shopping, on in-person shopping. The question is just who are the winners and losers, like always, when it comes to retail, because there are promotions, there are tariffs, there are choiceful consumers that are picky. There is evidence that the low-income consumer is under stress, and yet, overall, it's been a very resilient picture when it comes to overall shopping. I mean, Mike, if you look at even just some of the retailer results, you see the strength that we saw in Walmart, for instance. Even Dick's Sporting Goods, which had a tough reaction. I mean, some of these retailers that are executing well, giving consumers what they want, and benefiting from, even if their core consumer is under a little bit of pressure, they get a little bit of the trade down from the higher income consumer. There are a lot of retail winners.
Yeah, the category leaders continue to do pretty well. What I've been interested in is the market's response on the consumer cyclical side has been really aggressive, almost like a kick save, because it was looking pretty dicey a few days ago even. The equal weighted consumer discretionary was like flat on a 1-year basis as of a week ago. So we've actually had a very aggressive response, and even things like hotels and other services that people were getting concerned about, they were not acting well. Maybe it was through the government shutdown and you had this big confidence shock. I do think they've also had a pretty good response to those conditions where they had this pullback. I still think it's a market that needs to prove itself on that front. We benefit from the fact that it's not a huge mover within the S&P 500, just the aggregate discretionary piece of it, that if you get rid of Amazon and Tesla. So I think it's okay on that side of things. And what you are left with this time of year always is it's a flow-based bullish case, right? It's like we got pretty much all the earnings we're going to get. The Fed's going to shut up today because it's the blackout period, and we kind of know where we're going through the end of the year. And absent that, everybody's bull case is, well, seasonals are always positive this time of year. Positioning is not very light. Therefore, you have a lot of tactical funds that have to buy this time of year. Retail hasn't been scared out of this market, all that kind of thing. And I do think you've got a pretty good reset in the market. Even today, before the open, the median S&P 500 stock is only up 4.3% this year. Okay, the S&P is up 13 plus. And the median S&P 500 stock is 13% off of its 52-week high. So damage done below the surface, very small percentage of individual stocks beating the index. So whether that means that it's an unusually narrow rally or it means there's a lot of stuff for people to buy if they're so inclined, I think both can be true.
When I look at the banks, though, the big banks, all of them are outperforming the S&P this year. Every single one of them, led by the likes of Goldman Sachs, up 43%, Citi up 46%, JP Morgan up 30%. As we enter the last month of trading of the year, by the way, the market cap accretion with JP Morgan at $850 billion has been tremendous. So there are areas that you would have wanted to have been over allocated to.
There's no doubt about it. Yeah, and what's fascinating about that is, and I think really you go back a year ago, you go back 13 months ago, and the bench were the absolute clearest play on a deregulatory move. We know how it falls to their bottom line. We know they'll be able to do more. And that's worked, but really only for the largest banks. The kind of global, universal banks have won in this instance. And they've kind of solidified their advantage. What's also fascinating is it wasn't really coinciding with some kind of massive upturn in capital markets activity, because that's what we were talking about a year ago too. All the IPOs that were waiting to come, and really M&A and all the rest. Now, you've had a great year for debt underwriting, and things have been busy, but it's not been off to the races on all those fronts.
IPOs, Savita's out today, so we're tracking for the best year, a number of deals since 14.
If you look at any measure of the amount raised relative to public market cap, relative to how the S&P's performed over the last 3 years, we're kind of lagging. Maybe that's structural on some level, because we have a company supposedly worth $500 billion that is not even really planning the IPO yet. So.
And when it comes to M&A, of course, I think your point's well taken. A year ago this time, everybody was gearing up for what they thought was going to be an avalanche of deals. It has been, and the pace of deal making has picked up. It has been a perfectly decent, good year, but not perhaps what certainly a year ago had been anticipated. We may start to see some of the come to fruition, some of the things being discussed now. In the early part of next year. Certainly I hear plenty of things, many of which won't make it to the finish line though, but to your point, Mike, you haven't even seen what many had perhaps hoped for, along with that deregulation, that activity that would have sent these stocks maybe even higher. I don't know.
Yeah, who knows? I mean,
look at Goldman Sachs. What a year it has had.
For all the strength in the big banks, the underperformers in the financial sector are interesting too.
Huh.
Yes, regional banks are behind, but also the private
Hello, Sarah.
companies in particular.
Alternative asset map.
Goodbye, honey. You don't do it for me anymore. Schwab. George. Good morning, retail traders. I'm Washboardjim with a sneaky snake trading strategy where I talk about chart patterns, moving averages, and being in the now. That's me. I'm here. Yeah, I was watching Mr. this morning. MSTR. We just broke a resistance on SPX. SPY, I have 682.49 to break. 682.49. Hi. Today's Black Friday. I think 68.40 is today's resistance on SPX. 68.40. AMD's flagging out. We got NVIDIA at support with a double bottom. And Meta called the bottom on it. It's up. Let me see NVIDIA. Good morning, Debbie, on YouTube. I need to take off my shoes. Okay, we got AMD pulling down to support. New low on NVIDIA. Okay, I just hit a support level here on a trend line that I had Friday. What is today? Wednesday. SPX. Today's a half a day, so. Ooh. Little issue here with the options. Platform. I don't know. Yeah, I don't know. I don't trust this. Something fishy going on. Tasty trade. I mean, I'd take the trade right now. Things have been acting strange here in the last couple months. We got 3 black crows on AMD with a lower low. We got 3 black crows on the NVIDIA. Oracle new low. It sell off on Baba Wednesday. I don't know about that. Might not trade today. Just seems odd. We got 0 right here on this one. I don't know. Price ain't moved at all on that one. Today's the last trading day of the month. AMD bounced up off them 3 black crows. Yep. What the hell's wrong with these people?
Highs, subsequent lows, that would be the supported area. Now, if we were to transition into our yearly chart here, we can see that our volume profile point of control, in this case on our longer term basis, the point of control is down here near 597, but there's almost equally heavy trading activity up here near the 670 level or so. So that would be a standout area to watch as well for potential support. It's also noteworthy price cleared it. Our highs come in here near about 690 as well here. RSI showing a breakout. Momentum could be improving as we head into this weekend after a shortened holiday week.
All right, and next up we have, thank you for that, and then we'll take a look at the small caps. I was looking how Russell's up nearly 5% this week. You're looking at the IWM. Explain that and what we need to see there.
Right, and the reason that we're looking at these ETFs instead of the underlying indices is because we have to, or we wouldn't have to, we want to include the volume profile here to give us greater insight into these heavy trading areas. In this case, we can see that the Russell is breaking above its relative previous highs here near 246. We are still within the confines of this volume activity here near about 247 to 248. The next spike is up here near 250, so that could be a consolidation point going forward on the road up to 252, which is our highs on the short-term basis here. When we zoom out a little bit, we look at our yearly chart here. The heavy volume area is between about 240 to 245 here, so we remain above that point here. The bulls would want to see a strong push above the best closing high that we had here, 250.33. So keep that in mind as well. Our moving averages are coming together here near about 240, giving us a supportive confluence, and RSI also exhibiting a corresponding breakout here. So as I said, the small caps could be the bellwether here to see if we do start getting us a lasting rally. Notice we did break above our short-term downward sloping trend line here, but so far we have this range that's been established and we haven't quite broken out just yet. The downside limit would be about 230 here based on these lows, and that was subsequently, or previously, an old high point there as well. So some points to consider.
Okay, Rick DeCat, thank you so much. And as you mentioned that, I was just looking at the months to date on the Russell, and months to date, it's up almost 0.7%, so that has been a bright spot. Thank you so much.
Kind of a bummer.
We turn our attention over to Alex Coffey, because we're looking at this trading action, and what I'm noticing is that the Dow is just a little bit close to the flat line for the month of November.
Working a little bit better now.
And the S&P now is only 0.2% lower for the month of November. If we get a little more here, we get a barrows and surprise folks. Some of your thoughts?
Yeah, and that's, I think, ties to what we talked about, Nicole, about an hour ago at this point at the top of your program, how there really isn't that much weakness in this month. It's been such a nice run for the markets. You start reading the headlines like potentially the first month lower since April, for the NASDAQ since March. But you look at the performance, it's been broad-based, it's been rotationary, but it's all in all been relatively muted in terms of the true unchanged nature of the movement in the month of November.
Oh, that's bullshit.
I would also note, too, is the end of October, early November was also
We just had a good week last week.
You're benchmarking things to the highest levels that this index has ever performed at. When we left things on Friday on Market on Close, Nicole, I left the viewers with the question that I had for the market, which was, you look at how the S&P's performance in November had been. Its historical or realized volatility was sub 15%, yet we had a VIX or an implied volatility that was upwards of 25 or even higher. That divergence between those two metrics is not sustainable. So my question was, are we going to see real volatility this week? Or is the VIX going to collapse back to more historical long-run averages? And I think we got that answer. Look, knock on wood, we still got a few hours left in today's session. But look at that collapse in implied volatility, Nicole. Now
Google's at 320.82.
This is a lot more indicative of how this market is actually traded.
Yeah, and also, I mean, the dollar has been holding up now against other currencies. We've had an up arrow there. Bitcoin has been clawing its way back, you know, after being in the 80s level. The highs were close to 127,000 in October, but right now we're seeing that back above the 90,000 mark, right? It's at 92,710. So that's a bright spot too. It shows a little bit of risk on and appetite, right?
Yeah, it really does, but I also think that it shows that you can have a market that lets some of the air out of the perhaps bubble or the more speculative sides of the market, and then the whole rest of the market doesn't need to go down with it. The S&P 500 is about 1% or so away from its all-time closing high, yet Bitcoin is still tremendously off of its highs, which I think is probably healthy for the market, all things considered. Because, you know, like Bitcoin, don't like Bitcoin, invest in it, don't invest in it. It's certainly a little bit further out on the risk spectrum. It's certainly a higher beta asset than, you know, the traditional benchmark for U.S. equities, the S&P 500. So it's good to see stabilization there, but it also has now underperformed dramatically, you know, risk assets as a whole. So something to watch for sure, but it's a different style of investment. And, you know, typically a smaller percentage of portfolios for money managers and you know, even traditional retail investors.
Yeah, look, we have the likelihood here of the Fed cut, and that's some good news there. It's Black Friday, and we'll watch some of the big box retailers and online retailers. I did see there was a strike for Amazon in Germany, but it doesn't seem to be affecting the stock at all. You know, final quick thought here on folks, you know, if they have jobs or if they're going to look for value in the holiday spend.
Yeah, I think we've seen that for the last couple of years as price pressures were a real big part of you know, the discussion around the dinner table. Even though that is moderated, it's still changed behavior. And so you have a very value-oriented consumer, one that waits for these deals that seem to be more and more frequent. But this is one that's on the calendar every single year. So expect a ton of activity all across the nation this week, this weekend, and Monday, of course, as well as Cyber Monday.
All right, Alex Coffey, great to see you. Thank you so much. And thank you, friends, for being with me here on Opening Bell on this Friday where we have a short trading day. The market closes at 1 p.m. Eastern Time. But keep it right here. Morning Trade Live with Tom White is next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
We got a little flag forming.
Welcome to Schwab Network, where real-time market coverage means expert strategy.
From the opening bell to the closing bell.
Nvidia.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on the guidance, but not the same rate of change on ETFs.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time.
Got a long snake on Google.
Accuracy and precision.
I think one of the most important things is you're making a play in a risk-defying way you're going in earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and
Nvidia.
financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December.
Usually I like to trade on a day like today, but
Market outlook.
not when this
Your guide
platform's
to
not running right.
stocks, local markets, inflation, rates, and more. Hear from experts on where the markets may be headed, spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m. Eastern on Schwab Network.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please. But there's a Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
I'll get out here.
Where are you going?
Schwab.
You mean woman.
Schwab, a modern
How can you do that to Carl? Tesla getting ready to squeeze.
Welcome to Morning Trade Live. I'm Tom White in for Sam Vadas. We got
Spies flagging out.
Here and abroad over the next hour. Here's a look at what's coming up on the show.
Abroad?
We'll dive into potential rotation targets.
How can you say that on TV?
Year-end, what names are worth watching? And over the next hour, we'll have some example trades in both Oracle and Costco.
Google just hit support.
A $38 billion debt offering to fund its OpenAI centers, and Costco will be in focus as holiday shopping season kicks into high gear. Now let's take a look at where markets are. About a half an hour.
There it is, right there, man.
The S&P 500 up 0.2%. NASDAQ 100 up 0.3%.
Google.
Dow Industrials up over 130 points, or 0.3%. Russell 2000 small caps, which have had a good month in November, up nearly 0.4%. Now let's take a look at some of the foreign markets. We've got the FTSE up 0.2%. The DAX over in Germany up 0.3%. Nikkei out of Japan up 0.17%, but the Hang Seng falling just over 0.3%. Now let's take a look at some of the other asset classes that should be on your radar. We've got the 10-year yield just above the 4% level. It did dip below 4% earlier in the session at nearly 1 month lows. The dollar index relatively firm, just below the 100 level. Gold up 0.6%. Silver, on the other hand, hitting record highs today. Crude oil up over 1%, back above $59 a barrel, but still in that downtrend. And Bitcoin rebounding from those lows that we saw earlier in the week at about 80,000. Now we're back above 92,000 for the Bitcoin futures. So lots moving here today. Now let's bring in our first guest. It's going to be Alex Coffey. He's joining me now. He's a senior equity contributor here on the network. Alex, I want to get your take here because all this volatility that we've had so far in the month of November, it seems to have dissipated within the last 4 or 5 days. We're on a 5-session win streak if we're positive by the end of the day.
The 330 strikes for next week for Google at 220.
The markets were kind of experienced in the first few weeks. It's gone.
Yeah, I think also an important note to this is in the context of the recovery post the tariff tantrum of March and April of this year, that any signs of a little bit of a down move feels maybe bigger than it actually was. And
Or is.
By that is if you were to look back over the last 21 sessions, which is essentially a pretty typical barometer for what we could consider 1 month in trading circles, the realized volatility of the S&P 500 is 14.6%. So that's going to include all that movement that we saw.
Right.
Yet, a week ago on Friday, we had a volatility index as measured by VIX that was 25-ish, 27, as, depending on the moment that you looked at it. Those two things can't be sustained at the same time. So my big, takeaway on Friday was how is this going to resolve?
This option thing, I don't
Are
trust
we
it.
really going to start seeing serious downwards momentum? It's likely that would be how the volatility on a realized basis was going to resolve. Or we're going to see volatility collapse in terms of the VIX. And, you look at volatility now, sub 17, I think we got that answer.
Yeah. And I think that was a lot of the concern because typically we see a lot of
There it is right there,
volatility in
man.
September and October. We didn't have that at all.
I'm tempted to get some
Earnings
Google.
were kind of driving the markets higher. We had the government shutdown that didn't seem to negatively impact markets. But now it seems like that volatility is dissipated, and one of the main reasons, Alex, is
20 shares
the
times
Fed's supposed to cut in a week and a half.
318.
25 basis points. Just a couple weeks ago, there was no anticipation of a Fed rate cut. Now you've got the Fed Watch tool up to 87% chance that we're going to get that Fed rate cut in about a week and a half on the 10th. And that just kind of goes to show what the market's reliant on at this point. And sometimes that can get a little bit dicey, but it just seems like everything seems to be cooled down a little bit as far as the anxiety in the equity market.
Well, a couple things. If we want to pull up a chart I sent over, which is the seasonality chart, I think this will actually address your first part of that, which is October and September sometimes being perceived as more volatile, in quotes. But the reality is, over the last 20 years, that's true to some extent, but really they're just more consolidation periods after the summer sees a leg up. And so we kind of did see that. If you were to go back until July, August, kind of going into September, the market was up about 10.5%, 11% this year. It's up about 16% now. Well, at the pace we are on, that's sort of a slowdown to some extent, but also it's still an upwards trajectory. If you were to look at where we were a week ago, we were up about 11%. So
SPX, we bounced off the 63 earlier, so there's a major support right here. $460 for the 68.45s. Major support. We could hit the 200 if it doesn't hold. 460 to 520.
Think over the past couple of quarters really outperforming, and that's kind of helped support this risk on trade that we've seen, especially, since those
Oracle bounced up from 198.
One of the areas, the S&P 500 is only about 1.4% from its all-time highs.
Yeah.
We're nearly flat in the month of November after an auspicious start to it, where we were selling off a little bit, down over 5%. But then you've seen small caps. I think one of the things that's also lent some support to this risk on trade is the fact that, hey, when people are selling something, whether it was AI, whether it was healthcare earlier in the year, they're rotating into different pockets of the market. I mean, the Russell 2000 is less than 2% from its all-time highs. It's actually positive this month. So that rotation is actually good, where people aren't spooked out of the markets. They're just going into pockets that maybe were underperforming, or they're just reallocating money to this risk on trade, right?
Yeah, if anything, there's almost like net new money going into those, and you can almost argue that the rotation is amongst the AI names. I would say the last 2 weeks, if they're indicative of how the rest of the year is going to go, maybe the early parts of next year, the broad market has been relatively consistent. It's why the Russell 2000 has done well. Right. It's why the S&P is within 1.5%, 1% of all-time highs, whether you're looking at the intraday or the closing high. It's because the rotation has been, are we moving out of an NVIDIA-like name? Are we moving out of a Palantir or an Oracle and into an Alphabet, into those type of names? Oh, and by the way, we're also going to buy the more broader part of the index too. And if that continues, that's a really good way for this to resolve. It's a big if, though.
Yeah, and you mentioned NVIDIA is down 1.4%.
And Alphabet's down, though, too, so I don't know how that's working.
Yeah, I mean, that massive rally that we saw in Google Alphabet after the proposed announcement that Meta platforms may be using their TPUs, maybe a little bit of profit taking, but this Meta trade, or this NVIDIA trade's really thrown me for a loop, because those were great earnings that they had just over a week ago.
Yes, they were.
The stock just has not recovered like maybe a lot of traders had anticipated. All right, great wrap up for us here, Alex. Appreciate it. That's Alex Coffey, Senior Equity Contributor.
I think they're doing the wrong thing there, Tim.
Stick around. When we come back from break, we're going to dive into what's next for the Fed ahead of that December meeting in about a week and a half. Morning Trade Live is back after this short message.
I don't know why I think they're on to, this is my opinion. The NVIDIA CEO says he wants to make America great again. That's the only thing I can think of why they're bashing it. Why they're not into it as much as they used to be. Because he's one of Trump's buddies. That's just my opinion. But I think it'll be a buying opportunity.
I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
I'll be right back. I'm going to go out to my car. I'm going to have to get my vacuum cleaner looked
What's up,
at.
Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Your video is starting to bounce up a little bit.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical
SPX, it kind of has a symmetrical flag. Resistance will be the top of the orb for sure,
Wealth management.
if not
No
sooner.
politics, no spin.
With a double,
just
triple
the
top, or
market.
almost a
Open to
triple
close
top.
and beyond. Streaming 24/7, any screen,
Right
anywhere
there.
at schwabnetwork.com.
We're back here on Morning Trade Live. Reuters is reporting that Baidu has begun layoffs after reporting a third quarter loss. The company is facing increasing competition in
6831.47.
AI and declining ad revenue. The layoffs are expected to run until the end of the year. Stocks
Almost
up
an
about
ascending
1%
triangle
on
if you
that
want to count the
news.
wick.
Now let's take a look at some of the S&P 500
Which is
leaders.
bullish
Intel
looking.
Up. There's just a report that they're going to start shipping Apple.
We got Cyber
chips
Monday
in
Monday for
2027.
Amazon.
Coinbase, with that rebound in Bitcoin, up 4.4%. Block, up 3%. And Palo Alto Networks, after their earnings, up over 2%. On the laggard side, Eli Lilly coming off of those record highs that we hit earlier this week, down about just over 2%. Oracle, weak again on that potential $38 billion capital raise. Best Buy down 1.6% after their earnings last week, and Gilead Sciences also down about 1.4%. But now, joining us for a look at the bigger picture is Andrew Wells, CIO at Sanjak Alpha. Welcome to the show, Andrew. You know, when you look at the markets and the way that they've reacted since that volatility that we had at the start of the month, give me your take here, because it seems like the risk on trade is back in motion here for investors.
Yeah, absolutely. Happy Black Friday, Tom, and thanks for having me. I think we have to zoom out here just a little bit and look at how this year started. And I was one of these people who told the markets that if we could take an 8 to 10% year in the equities market, we'd probably take it, coming off a couple of 25% plus gains in the NASDAQ and the S&P. So here we sit at the NASDAQ up 20%, the S&P up 15. I think we're pretty happy with where we sit, even if it just stays here through the end of the year.
683307.
The risk on sentiment is in the markets. We see a pretty robust looking retail sector shaping up here going into the end of the year.
The option calls up $100.
Let's see if we can finish strong.
460 to
and
570.
See the markets kind of continue into the end of the year with some nice gains.
Yeah,
560.
When you look at just the impact that we've seen for equities, you mentioned those gains that we had in 2023, 2024. It seems like earnings has kind of been the good base case for this risk on appetite at this point. Deregulation may be coming from the administration. You know, even the government shutdown, tariffs, they can't really create these headwinds for markets. If we can get through stuff like that, Andrew, does that bode well going into 2026 for equities as maybe, another double-digit gainer for 2026?
Well, I feel a little bit of deja vu of how I felt last year.
Here she goes.
Boom. Perhaps the customer is fading a little bit over the medium term. We look at things like the New York Fed released a study that they did back to around 2012 and showed that credit denials are at the highs for the last 15 years. And that tells us, we're seeing about 25% of people who apply for credit in things like auto, retail credit cards, mortgages. About 25% of those people are being declined. And that tells me that the market wants to spend money, the consumer wants to be there, but perhaps the banking sector is just not being cooperative and tightening up a little bit. So this is why the Fed, I believe, even though you're seeing inflation persist here,
There's a paper trade at 460.
As much at that as they are at things like unemployment.
And then we're at
rising a
$6.
bit here and seeing some cracks in the labor market. And then certainly the free flow of credit to the consumer base, that's an area the Fed is looking at as well. So this is why we see the Fed kind of becoming a little bit more accommodative than you would normally see staring at 3% inflation.
Yeah, and expectations are for that to start to come down. It hasn't really surged, but when you look at maybe this last 4 or 5 days that we've seen in the equity market, Andrew, one of the big reasons is, hey, the expectations for that Fed rate cut in about a week and a half are up to, above 85% at this point. So they're being more accommodative. We've seen some bifurcation as far as the Fed members and the voting members kind of pushing back and forth between each other. Is that the key here for going into the latter stages of this year, into 2026, that, hey, as long as the Fed stays on this maintenance cut rate cycle, lowering these interest rates, that's going to be a benefit. And do you see inflation maybe resurging if we do get any more cuts in early 2026?
We actually do. At our firm, we do look at inflation as probably the big risk factor in terms of surging in 2026 as opposed to kind of where we stay sort of persistently high in 2025. This doesn't seem to bother the risk markets that much at this point, and we certainly don't see inflation running really hot. But still, if you're talking about low threes, mid threes inflation, that's still much higher than the normal Fed target. So again, the Fed has to be looking more at the jobs market, looking at where wages just aren't keeping pace with inflation, and they're looking for ways that they can be accommodated to the market. And I would use, for example, the fact that they froze the balance sheet in the last Fed meeting in terms of making the announcement that they would begin to stop the runoff of the balance sheet. That too is something that can be more accommodative to the long end of the market, seeing a lot of the reinvestments back into the balance sheet that they had been shrinking literally for 2.5 years now. And again, even with a shrinking balance sheet, certainly didn't bother the risk market. So with the balance sheet not shrinking anymore, we don't expect it to bother them going forward from here.
Yeah, and when you look at it, Black Friday here, Andrew, the consumer, we've seen some dismal consumer sentiment. Maybe that's a little bit skewed politically, but then consumer confidence is at low levels that we haven't seen since April. Do you feel like maybe once we get through this holiday shopping season that we might run into some problems in early next year? Because I think a lot of people are calling for that. We're in that no fire, no hire type of situation, but unemployment's ticking up a little bit and people are strained. Or do you feel like we're going to see a resurgence on the consumer? What's your take here going into the end of the year?
Well, a couple of things. If you go into the end of the year, of course, that we typically see the one reason you have kind of a Santa Claus rally, you see some tax loss harvesting happening now in some of the names that have been down this year. And some of those names have been retail. You look at places, the names like Lululemon and some of the retail names that have just had a really abysmal 2025. And those names, as we see the tax loss harvesting here at the end of the year, you can see that re-enter back in January. We saw a lot of that happen here earlier than normal in October, November. That tells us that people are looking to re-enter some of those names, take the tax loss, and then come back in January and maybe re-enter some of those names, especially if retail shows a little bit more robust than expected. And that's the key here is expectations, because the expectations for this holiday season were not actually very high because we've just been hearing all the consumer confidence being so low. So if that shows to be just a little better than expected, you can see a lot of people re-enter some of those names.
Bounce back up.
Looking in January for some of those rotation magnets, maybe out of the tech that has run up so high, and as people exit some of those names, looking to not pay taxes on those huge gains until 2027. You can see some of that money rotate into a little more value-oriented plays. So it's one of the things we can see to kind of level things out for 2026 and keep the equities market moving.
Yeah, and Adobe Analytics just had something. Thanksgiving sales were up over 5.3% from a year ago levels as far as online sales. So maybe the consumer's saying one thing and doing the other at this point. All right, great discussion. Andrew, have a great weekend. That's Andrew Wells. He's the CIO at Sanjack Alpha, helping us out. But coming up after the break, we're going to take a close look at the big picture with the team from Charles Schwab. We got Joe Mazzoli. He's going to join us after this quick break.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
How's it going?
Let's say
Sometimes, you know,
Next.
try again.
You could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions. From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close. Here on the floor, I bring you real-time sentiment from traders driving the action. And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings. Live coverage of the close every single day. This is Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
We're back here on Morning Trade Live. Let's take a look at a name that's moving. UBS has raised the price target Five Below to $204, up from $184. They keep buy rating on the shares ahead of the company's third quarter earnings next Wednesday after the close. Firm believes that there will be continued noise about the consumer when discount retailers begin reporting next week. A lot on the agenda there as far as retailers go. Shares are trading just below last month's 52-week highs there in Five Below. Now here's a look at how some of the other discount retailers are doing today. Five Below up slightly, TJX down just fractionally, Burlington down over 2%, and Dollar Tree ahead of their earnings next week, up just over 1.1% on the day. All right, let's get into our next segment here. We're going to bring in Joe Mazzola, head trading and derivative strategist here at Charles Schwab. Joe, I wanted to get your impact here. Markets, we're on a 5-session win streak. We can close positive today. Pretty healthy snapback rally. I mean, are you a believer in this? Or should we just kind of ignore that volatility that we saw earlier in the month and, hey, it seems like it's just risk-on trading again?
Can it be both, right? Can you believe in the fact that the market breadth is improving? You're seeing a lot of cyclical undercurrents in terms of where the expansion is. So financials are doing well, materials are doing well. You're seeing quite a bit of buying below the surface. So it's not just a tech rally. Yes, you can make the case that semiconductors are up 8%. From last week, but so small caps, Tom. So I mean, there's money flowing into these sectors, and it's not just the narrow rally. Now that being said, we've seen this before, right? Where people have been willing to say, okay, well, here's where you really want to get in front of the Russell and buy up all the small caps. So let's kind of talk about maybe what has predicated the move. It's the expectations of the rate. And so when you're talking about something like the Russell, where you have small caps, that these are companies that are not very profitable. 40% of the Russell is not profitable, and you're borrowing at a short-term rate, and you see the potential of short-term rates going down. Those companies become a little bit more attractive in the short-term or in the interim. And I think that's part of what you're seeing. But I think there's, as you mentioned, there's a bit of kind of this risk on sentiment that we held at a couple levels. And now we're getting a bit of a bounce back, and whether or not it's a Santa Claus
pulling back,
because things have been, kind of pushed back a little bit. But I think the other thing, Tom, is too, it's just not a normal market cycle with all the different things going on, government shutdown. So I don't think you can just kind of go back to history and say Santa Claus rally is starting right now, because there's a lot of different factors.
Yeah, and it seems like, Joe, and just from my, view of the markets at this point, there's a lot of bifurcation, right? You've got consumer sentiment, consumer confidence numbers way down, but then they just had, Thanksgiving Day spending up 5.3% according to Adobe Analytics. And then, the Fed rate cut cycle, that's helping support equities. But then you've got 3% inflation that the Fed's kind of fighting at this point. But at the end of the day, Joe, it feels like equities are still going to be the winners in this because of all the turmoil that we've had, whether you mentioned it, the government shutdown, the tariffs, headwinds. Earnings have been great, Joe, so that's kind of what, the investors doing. They're just sticking to the narratives that make risk on asset trading more popular, right? And that, hey, we can get supported. We've got all these outside, things that are kind of headwinds for the markets, but at the same time, when you got a lot of, assets and capital on the sidelines, hey, earnings are great, right, Joe?
Don, I think you bring up a great point. Remember, there's all this noise out there, and you're getting all these mixed signals, whether it's Brett signals or what you're kind of hearing from all the different sentiment measures out there. Ultimately, at some point, it comes back to the fundamentals, and I truly believe that. And we came off a really strong earnings season, about 83% beat rates and earnings per share, and then the revenue side was much higher than we've seen in a long time, in the high 60% on revenue beats, and expectations for 2026 have actually gone up, which is interesting as well. So there's still a lot of high expectations for what the earnings cycle can be in Q4 and beyond. And I think when you start pairing that with what we saw on the charts, where dip buyers continue to step in, and we see that not only from the technical perspective, but we also see it from some of the measurements that we look at here at Charles Schwab, and our stacks measurement. When we looked at the end of October, that final week of October was some of the heaviest buying that we've seen all year. And some of that has carried forward. It's been a little bit more choppy in November, and I'm assuming that's kind of expected given what we've seen. But for the most part, when we have seen pullbacks 3%, 4%, 5%, investors have been willing to step in. That has not changed. And then a couple of things from the options market that I just noticed recently, Tom, as well too. Some of that hedging that's kind of pulled off from the S&P 500 that was more institutional led. You're starting to see more and more kind of upside call buying in the semiconductor index, showing you that at least at this point right now, there's belief that there's more upside to the tech rally.
Yeah, and you bring up a good point about the retail side of trading. You guys track that quite a bit. Is the fact that, hey, retail trading and retail investors were the ones buying in April. It wasn't hedge funds, it wasn't institutions, and they're buying dips now. We've seen that over the last 4 or 5 trading sessions. They're buying this November dip. So hey, retail is smart money at this point so far here in 2025, Joe. But looking ahead to next week, anything sticking out that might throw a wrench into this rally or actually help support it as far as maybe data earnings?
Sure. Well, I mean, look, we're still catching up with the data, right? So next week we're going to get the ISM manufacturing, ISM services. I think both of those are going to be important. We're going to get the Challenger job cuts for November. These are some private sector data points that are coming out that the markets are going to be trading off of likely. We get things like PCE. So as we're kind of, as you mentioned, Tom, looking at 3% inflation. The Fed prefers to look at the PCE, but this is the September data, so it'll be lagging. So you're going to have to kind of mix that and maybe throw different probabilities on that. But we're still waiting for the October data. But
I got 68, 31, 47. Kind of the key one today, but
as well as some of the different earnings that we had.
I had to go wash my jackets. They smell like cigarette smoke. I'll be right back.
And more time learning. Trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on SchwabNetwork.com.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
We're back here on Morning Trade Live. We're talking Oracle. Stock's off a little bit today and giving up more than 41% of its gains to those all-time highs that we saw in early September. Oracle is in the news today due to an upcoming $38 billion debt offering to fund the next phase of its Stargate project with OpenAI, another round of debt offerings here for the company. That's going to be the focus of Morning Trade Live here. Let's bring in our next guest. It's going to be Marley Hayden. She's host of Trading 360 and Market
Well, I'm going to go do something.
We talked about this
I
earlier.
think today's going to be a short day for me.
This is a big deal because I think the pullback that we've seen, everybody was high on Oracle when they announced this $300 billion deal with OpenAI. But now when you start taking debt on to build out this AI infrastructure, that's going to be a concern for investors, right?
It potentially could be, sure. I mean, you mentioned the pullback just in the last month alone. We've seen Oracle pull back more than 28%, well off of those highs, like you mentioned, that we saw earlier in September. You mentioned this new funding round. There are several banks discussing this potential $38 billion loan package for Oracle, alongside its data center builder Vantage, to fund those additional sites for OpenAI. Now, this is not their first debt offering, of course, as you're hinting at by saying investors might have some concerns if they're taking out more debt, but it is the largest offering to date if this one does come to fruition. They took out an $18 billion debt financing back in September, late September, to support some of these massive data center plans already, including those Stargate campuses. Now, OpenAI back in September as well disclosed plans for 5 different Stargate data center campuses in the U.S., alongside their existing one they already have in Abilene, Texas. That construction has already begun. Since then, analysts have started to try to estimate how much might need to be taken out to just meet the contract alone with OpenAI. And right now, the number sits at about that Oracle would need to source up to $100 billion in debt funding over the next 4 years just to meet this OpenAI contract alone. Now, that said, it's not being viewed by the sell side in a bearish way. We got a note from Deutsche Bank saying that this sell-off actually offers a really attractive entry point. The analysts also made note that they don't think that Oracle is given little, they said, quote, little if any credit for its business with OpenAI, and that while the deal brings financial and operational risks, these are offset by what they call a very real opportunity that OpenAI offers. And that's a very interesting perspective, Tom, because we've had a lot of these conversations about the cyclical spend and how a lot of these headlines are driven, and we see these shares pop to the upside. But now a lot of this AI bubble conversation, we're starting to see them met with a little bit more scrutiny and a little bit more caution. So interesting to see Deutsche Bank putting out this pretty bullish note when we've seen a significant pullback in Oracle.
Yeah, and you know, the note out of Deutsche Bank, you know, they're kind of reiterating their $375 price target. And then the day before, DA Davidson came out with a note lowered from 300 to 200, and this is based on OpenAI. So maybe just a quick follow-up here on this partnership and how everybody was on board if you partnered with OpenAI. Now it's kind of reversed where is OpenAI, with all these commitments they have, and this roundabout circle of investing that we've seen from the chip makers, OpenAI, others in this space, it's going to be maybe some volatile times here because if you're tied to OpenAI, it's a positive, but at the same time, are they going to come through on those commitments, right?
Short day today, so I'm going to go get my vacuum looked at.
But overall sentiment is strong. Right now, Oracle's trading at 201. You mentioned they are a little under pressure today, but the average price target right now is 342. So I mean, that's a roughly 40+%, upside move from where they're trading right now. Street high is 430, while the street low is only 175, only $25 off of where we are right now. So, sentiment's still strong in terms of the AI trade, I think.
Yep, you got to watch the technicals on that. It's broken through its 200-day moving average to the downside, also down 41.6%. From those all-time highs that we saw in September. Thanks to Marley Kane here for joining us. But now, let's bring in our next guest to trade this. We're going to talk to Dan Deming. He's a managing partner at KKM Financial. Welcome back to the show, Dan.
Hi, Tom. How you doing?
I'm doing good. Long time no see. I know. It's unfortunate, but happy Black Friday here. Dan, so we're talking Oracle. We've talked about, the fundamentals are maybe still there, but now the commitments with OpenAI, trying to hit sentiment here from the investor at this point. Give me your take here on Oracle before we take a look at the trade here.
Yeah, Tom, I think, that's the question right now. Is the debt structuring something that they can manage moving forward? And there's a wide dispersion as far as the expectations there. Hence why we did see Oracle come off so dramatically here in the last couple of months. And, if you look at the price action here, Tom, certainly around this 200 level valuation, so much more compelling. It does appear that it's trying to form a bottom here after spiking down below 190 briefly. Now we're seeing at least some buying pressure here and some stabilization short term. I think, longer term, just based on the evolution of the AI space and just some of the dynamics, that Oracle's still in a good position. But yeah, there's no question, relative to some of the competitors out there, they've taken on a massive amount of debt, and will they be able to manage that moving forward? But I still think here it's oversold. We look at it as a possibility of regaining some traction here, getting back up. I don't know if it's going to challenge up that 350 level anytime soon, but at least I think we'll see a 50% retracement back up to the 275 level. And if that's the case, then I'm looking from a short-term perspective to capture at least maybe a bounce here off the 200 level.
All right, so Dan, that's good because we're down below that 200-day simple moving average. We did get peak back above there, but now a little bit weaker today. So go ahead and break down your trade example here for us.
Yeah, this is a short-dated trade example, Tom, and 21 days out, just December. Define risk, I think that's the key right now, given the price movement we've seen in the stock over the last couple of months. And I'm looking at the December 200-230 call spread. When we were trading just below 200, you could do it for about $9. It's a little bit better than 2-to-1 risk reward on this call spread to the upside. I still think that if we see some stabilization, 230, I think that it could be hit very quickly. We've seen this price movement in the stock to quite dramatic volatility. So I do think that we could challenge that 230 level here over the next 3 weeks if we see some stability in the price action. And again, like I said, define risk though. If there's still some outliers here, and certainly a trade example I gave for Oracle about a month ago was a risk reversal, which got run over. So I think the key here in my mindset is looking forward to these short terms to define risk, but able to capture some upside should we see a nice bounce here off the 200 level.
Yeah, let's break this one down. December 19th monthly option, so 3 weeks expiration, 21 days. Buying that slightly in the money 200 strike call, selling the 230 call against it. Dan, when I look at this, I always look at trades as, somebody might go, well, why not just buy the 200 strike call? And I'm like, well, you're going to pay $15 for that. So you got $1,500 in risk. And over the next 3 weeks, do you really expect it on a percentage basis to go much above 230, if at all? And that's why you can sell the 230 call against that reduced risk by over $4.5, nearly $5, to where this spread might cost you around $10 because the stock has bounced off low. But isn't that one of the keys, Dan, when you're looking at option strategies like this, where hey, let's offset some of the costs on the bullish part of this trade, right?
Yeah, absolutely, Tom. I mean, that's certainly the thought process here is to lower your break even and still have a nice capture zone to the upside. So that's the idea of selling that upside call, lowers your break even. You don't need to have quite the price appreciation to have it intrinsically become of value, and you still have better than 2-to-1 risk reward profile on this. Should we see it run back to 230? Of course, if we get above 230, all right. But you know what? You had some defined risk. You lowered the risk profile, and you're able to capture a significant amount of upside on the bounce if we see the stock continue to move higher.
Yeah, and on a percentage basis to get above 230, you're still talking over 20% that it's got to get up there. So yeah, offsetting some of the costs on this bullish trade. All right, great stuff, Dan. Appreciate it. Have a great weekend.
Thank you.
Yeah, good seeing you too, Dan. That's Dan Demi, managing partner for KKM Financial. All right, let's take another quick break. Coming up, we're going to take a closer look at sectors on the move this morning ahead of the market close at 1 p.m. Eastern Time. We're leaving early. Morning Trade Live coming right back.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are. Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Welcome back to Morning Trade Live. I'm Tom White, filling in for Sam Vada. It's time to take a look at the sectors that are moving markets this morning. Alex Coffey, he joins us back here in studio here. When you take a look at it, markets gaining some momentum here, broadening out as far as the rally that we're seeing, trying for this fifth straight day of gains. Alex, what's sticking out to you?
Well, what's sticking out is exactly that. It's been a really nice streak now of about a week. Worth of trading, but beyond that, it's really broad-based today. I mean, you're looking at about 82, 83% of the S&P 500 components higher on the session, 419, 420 to be exact. NASDAQ, just as strong, pretty much 79 of the 100 higher on the session. A little bit of outperformance, neck and neck between the NASDAQ 100 and the S&P 500. But then when we look at the sectors, 10 and 11 in the green. The only lower one is healthcare. Well, we know that's driven largely by names like Eli Lilly. Eli Lilly is underperforming a little bit today, down 2.4%. Going to be hard to outperform as a sector that's very, very top-heavy, and one of your biggest names is having an outsized down move today. So all in all, really nice performance. S&P equal weight is outperforming the cap weight index once again, which I think there's mixed takeaways on that. I think it goes to show that depending on how you're invested, you still do have that concentration risk, but you don't feel it nearly as much when you have 80, 85% of the index consistently higher. And that's been the story, if you include today in this, the last 5 sessions going back to those recent lows that we made on Friday.
Yeah, you mentioned healthcare is the only sector that's down, but it's down from record highs that it hit earlier in the week. So that had been outperforming. And Eli Lilly is a big chunk of that, nearly 15% of the healthcare portion.
And there's a correlation between those components too, right? So that also, when one moves, they all tend to move.
Yeah. Now, let's take a look at the Max 7 because this is interesting to me because you mentioned the NASDAQ 100 up 0.3%, about what the S&P 500 is, rebounding a little bit, still under pressure, and off of those all-time highs by a couple percent, but We got 3 of the Mag 7 names in negative territory today, and we're still doing pretty well as overall.
Yeah, I think this explains that cap-weighted, equal-weight disparity that we were just talking about, right? I mean, if you were to ask just a random person who follows financial markets even just a little bit, and you said, hey, what would be the 3 most important names? I almost certainly assume they would say NVIDIA and Apple. And then recently, I think Alphabet has definitely stepped into that at least third space. And so, of the Mag 7, the 3 most important names probably of any in the S&P 500 are the ones that are lower today, yet you're still up about 22 points for the market, about a third of a percent. If you were to index the Mag 7, even without those 3, we're still up about a 2/10 of a percent in the Magnificent 7 as an index. So not big moves, but notable moves just because of where they're at. All 3 of these names lower. Alphabet and Apple down about 0.4%. And NVIDIA continues to slide down about 1.4%. That's something to watch. Every rally in NVIDIA continues to see selling pressure into it as this rotation amongst these mega caps continues to happen.
Yeah, Google Alphabet's still up over 6% so far just this week. So maybe a little bit of profit taking. But NVIDIA, that's down 12% so far in the month of November. So that's taken a beating here. All right, great stuff as always. Thanks to Alex Coffey, senior equity contributor here. But coming up after the break, it's time for Inside Out. We're going to take a closer look at Costco and bring in an example trade. This stock has been in a downtrend going into their favorite quarter of the year. That's holiday shopping season. Stick around.
Hey, investors, you know the market moves. Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on the Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
We're back here on Morning Trade Live. It's Black Friday to those, happy Black Friday to those who celebrate. It is one of the biggest shopping days of the year. And here's what big box retail stocks are doing on this shortened trading session. Got Walmart up 0.8%. That's hitting record highs today. Costco up fractionally. Amazon up over 1%. Home Depot up nearly 0.4%. So we'll continue to watch that. Probably have some data on Monday as far as Black Friday sales and weekend sales. All right, now it's time to go inside out on retail, and specifically Costco. Joining us now is senior markets correspondent here on the network, George Stills. George, we're talking Costco, and this stock, I mean, it's been in a downtrend for several months now, and this is always at the top of everybody's list when they talk retail. What's going on here with Costco, George? Why are we seeing a pullback? This is one of my favorite places to go.
Yeah, so it's kind of an interesting situation. I mean, first off,
at Costco performance-wise over the last 5 years, it's been tremendous. But there were some concerns going into the end of last year, earlier this year, about valuation, and I think that has played out. If you look at the price action in Costco since February, the stock hit around 1075. It's been down about 15%. And one of the things I noticed is that if you look at the earnings multiple going back to about 2 quarters ago, just as approximately a time frame mentioned, the earnings multiple actually was trading around 57 times earnings. Now it's around 45 times. And I think what's happened here, Tom, is irrespective of the fact that sales are expected to be, as they are going to be reporting earnings coming up around 8% higher, earnings around 6% of the upside, and membership fees have actually increased in terms of total net income for the business to around $5.3 billion. That the reflection in the stock price isn't necessarily a manifestation of the business itself. I think it really came down to valuation. It was trading at sort of these, lofty tech valuation levels. But if you look at, like I said, the sales and earnings for the business at around the high to mid-single digits, that has certainly played out. Right now, if you consider that the price is down since February about 15%, what I did notice too is that you look at the earnings estimates for this year, they've actually risen, by about 15%. And next year's earnings are expected to be around $20 versus the estimated prior 6 months ago or 2 quarters ago, they were expected to earn around $19.80. So over time, Tom, the name has actually improved in terms of sales, market capitalization has improved, net income has improved. The price has gone down, and I think what's happened here is we've seen just a general multiple compression in Costco. Maybe it was due, and maybe again, considering the holiday season, but also how the retailers have performed exceptionally well, we may end up seeing potentially a reversal in this name.
Yeah, you mentioned that we're down 15.7% from those all-time highs that we saw in the early parts of 2025. So this has been a trending lower stock. And you mentioned the performance over the last couple of years has been just spectacular, but valuation comes into play. They report monthly numbers on this. Sales in October, comparable sales were up 6.6%. We'll get more of that over the next couple of weeks into earnings also. But George, you got an example trade for us. Break it down for us.
Yeah, so one of the things about this is, again, it may end up being right now, if you look at the weekly charts, at some level of support right around the 100-week moving average. So what I'm going to do is I'm going to structure going into the earnings coming up on the 11th, also seasonality for Costco, under a condition now, just keep this in mind, that it holds the 100-day moving average. What I'm going to do is I'm going to structure a bull put spread or a put vertical for a credit. This is going to be a December monthly, so it expires in 21 days for the 3rd week of December. I'm basically going to sell a 32 delta put. That's the 885 strike, and I'm going to buy the 875 strike below that. So this is, again, right below that 100-week moving average. And altogether, you could harvest or earn about $3.50 a share or $350 a contract. So the whole premise of this trade is to basically hold, at the very least, the 885 level. That's where your max profit position would lie. You have to consider your return is 350, risk 650. You get about a 53% return on risk, about a 68 probability of percent of profits. And then again, the break even on this trade is 881.5. And then again, if the stock does fall below the 875 long strike position, that's where you'll achieve that max loss of 650. So this is a conditional trade that it'll hold up 100-week moving average and potentially a reversal off that 100-week moving average level.
Yeah, let's break this one down. Out of the December monthly options, George went out 3 weeks in this example trade, selling the out-of-the-money 885 put, buying the 875 put short $10 wide neutral bullish. Put vertical, you collect roughly about 350 credit. The credit you collect is what you can make on this one. And as George mentioned, $650 in risk, but these are the trade-offs. You're risking more to make less, but you've got a better probability of success on this neutral to bullish stance. So you can still take a directional bias, but it's more passive, more conservative, with improved probabilities of success. Remember, on a trade like this, Stock goes higher, you profit. Stock stays where it is, you profit. Stock goes lower, you're wrong, but remains above that break even, as George mentioned, of 881.50. You're still going to be potentially profitable on this conservative, passive, bullish trade here, short put vertical that George brought. Good example, good look at this example trade, risk defined, I think key on such a high price stock here, just like Costco, looking for maybe some consolidation, reversal. Remember, it hasn't traded below that 875 level. That's acted as an area of support recently. All right, great stuff. Thanks to George Tellis, senior markets correspondent here, joining us. That's going to wrap it up here from Morning Trade Live. I'm Tom White. Download the Schwab Network app, available in the Apple App Store, and tune in 24/7 on SchwabNetwork.com. Trading 360 with Marley Cade's up next.
Trading in Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage for you.
Not to mention, Schwab is a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on ETFs.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way you're going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December 11th for 2026 Market Outlook, your guide to forces shaping stocks, global markets, inflation, rates, and more. Hear from experts on where the markets may be headed, spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m. Eastern on Schwab Network.
I'm Sam Barnes, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Welcome to Trading 360. I'm Marley Caden, coming to you live from our Chicago headquarters. Here's what's coming up in today's show. In our 360 Spotlight, we'll highlight Black Friday and discuss the unofficial start of the holiday shopping season and what it means for the consumer. Plus, Oracle is seeking a $38 billion loan to fund its data centers for OpenAI. We'll have the detail and an example trade in our Disruptor segment. Then for our 360 round, we'll highlight the holiday travel season coming off the heels of one of the busiest travel days of the year. Before we get to all that and more, though, let's take a look at where the markets are standing right now as we are trading after that outage we saw overnight. The S&P trading up 4/10 higher at 68.39. The NASDAQ trading 4/10 higher as well, 25,348. For the Dow, we are 285 points up right now, 47,713. And the Russell 2.5% higher right now at 24.98. As we take a look at some of our futures products, the 10-year hovering right around the 4% mark. The dollar just below 199.38. As for gold, we're much higher on the day, up more than 8/10 at 42.3670 a troy ounce. Crude oil up 1% as well, 59.27 a barrel, and Bitcoin has found its way over that $90,000 threshold, but still well off those all-time highs we saw up in the north 120s. It's up 2.5% at 92,645. Now let's take a look at some of our top moving stock stories in the market today. Joining us to help us do that, Alex Coffey, our senior equities contributor here on the Schwab Network. Alex, let's talk about Baidu. There were multiple headlines on Baidu this morning. The first one that really sticks out to me is this Reuters report that they are going to begin what could be some pretty impactful layoffs after some really disappointing ad revenue numbers.
Yeah, well said. 1.2% to the upside, though, today for Baidu. But I think the big key piece of this is that it's not just some layoffs. It's expected internally to perhaps be pretty wide-scale layoffs. And so this is a report that came out this morning. It cites 6 sources briefed on the matter. It's expected to hit multiple business units, and as you said, this is shortly after, on November 18th, of course, that the company reported a third-quarter loss within that search engine segment, which, of course, is the biggest search engine for China. They're expected to see these layoffs run all the way through the end of the year, so something to perhaps expect some updates on. The layoff numbers are expected to vary by business unit, performance ratings, and performance ratings, and they could reach as high as up to 40% for some of these teams. So, this is always where it's difficult because there's not exact figures here, but 40% is a sizable impact. The mobile ecosystem group is expected to be where the brunt of these cuts are expected. They do think that the roles tied to AI and cloud computing largely will be protected. So much like what we're seeing in many other firms that have announced layoffs, it's maybe more of the management type roles in some cases, or some of the things that are tied more to automation. But it seems like the areas that are tied to working on these AI and cloud computing projects are not expected to be impacted. As of last year, 35,900 was where Baidu's workforce was. That was already down from 39,800 in 2023 and 41,300 from a year earlier than that. So this has been a trend for some of these tech firms, and we saw these huge, kind of scaling up post-COVID as kind of the difficulties of getting workers, and now we're seeing some of these companies, trim the fat, as they say.
And we've seen it reflected here in American companies as well. We've covered this layoff story pretty in-depth at this point across a lot of these large tech companies. But this is not Baidu's only headline today. The other one likely, which could be driving us to the upside today in addition to the overall markets, is this roadmap that they've unveiled to potentially replace NVIDIA in China.
Yeah, exactly. So this is a 5-year roadmap, and this is for its Kunlun chips, which starting with their M100 in 2026 and M300 in 2027. According to the report, they're already deploying their own processors. They just do this alongside NVIDIA hardware to power their early AI models. But as we know, some of the geopolitical tensions, restrictions on some of that trade is going to make it difficult for NVIDIA chips to even get to mainland China. Beyond that, we know that we've also seen from the Chinese leadership as well that they want to reduce that reliance on NVIDIA and other US-based technology firms in general, as a lot of these supply chains are looking to be onshore as they're seen as geopolitically impactful. The business is gaining traction. Earlier this year, they had already secured suppliers, supplying orders from China Mobile. Deutsche Bank really sees this as a leading AI chip developer, targeting LLM training, inference, cloud, and telecom workloads. And so this explains really why in recent, I would say, months or really weeks, we've seen a ton of optimism from analysts. You look at the whole breakdown, it's over 80% of analysts in the buy camp. The balance are in hold, so no sells. But in just the last few days, buy rating from Macquarie, buy rating from Nomura, buy equivalent rating from JP Morgan, 188 from JP Morgan is the price target. That implies a ton of upside for that particular firm. That was, of course, an upgrade as well from Alex Yao over at JP Morgan. Susquehanna, the only in really the last week, I would say that is a little bit more neutral. They provided a neutral rating and a price target of 110, but even that applies 5% downside or so. So there's a lot of optimism, and part of this is because of the core business, right-sizing that firm, but then also this new growth driver, new opportunity to step in and maybe fill this void for some of this hardware.
Well, Alex, we appreciate you being with us to break down some of the action we're seeing in buying. Today's shares up about 1.2%. Right now, that's Alex Coffey, our senior equities contributor. Now I want to bring in our next guest, talk about, get some insight on news that's shaping the markets. For that, we'll welcome in Sam Miller, the Executive Vice President of Investment Strategy at SEIA. Sam, thanks for being with us on this last Friday of trading in the month of November. With that being said, I'd love to get your thoughts on the action we've seen so far this month. It's been a very volatile month.
Absolutely. The tech rally has taken a bit of a pause in the last month. I think that's just been a healthy part of the cycle here, and a normal part of a bull market rally. I think importantly, we're also seeing some other areas of the market pick up the torch in the last couple of weeks here, with healthcare showing signs of life, and then this week we've seen small caps really have a fire lit on them, trading off of expectations of a rate cut in December. So I think this is all, again, part of a healthy correction and sideways consolidation in the market as we get ready to move into year end.
So Sam, you say it's healthy. Are there any warning signs that you're keeping an eye on, under the surface? And what do you think that the markets are digesting the most right now? Is it earnings? Is it what's going to happen with the Fed?
Yeah, I think it's mainly earnings in the last month, and I think this market has been characterized by the rising AI tide lifting all boats almost simultaneously, and I think what's going on under the hood is that's probably going to change going forward as the market gets more discriminating on which companies are going to benefit from how things play out. So for us, what we're watching are three different things as we look at companies in the tech space. One, we look at ROIC, or return on investment in invested capital. So the massive amounts of spending on these projects in the AI space, are they actually profitable? Are these companies getting a return on their investment? Number two, capital spending. So how are they funding these projects? Are they using cash from their balance sheet? Are they taking on debt? I know you're going to be talking about Oracle coming up in a little bit here, and that's another case in point. So we're watching those balance sheets carefully to see for signs of weakness from a financial perspective on the balance sheet. And then thirdly, revenue growth. So we've seen some eye-popping numbers on revenue growth. Will that start to moderate going forward? So those are the things that we're watching within the tech space. We see who the winners are going to be going forward versus the losers.
And as we take a look at this, we were talking about hyperscalers, and this CapEx spend has been such a focus. Projected to spend more than $320 billion just next year in terms of that spend. We've seen some of these really large companies get rewarded for their numbers. Others get seemingly punished. Some of the mid-sized companies generally getting more punished. At what point do you think that we're going to start to see these capital requirements become a headwind for some of these weaker AI players?
I think that's what we've seen over the last month. Some of the lower quality names start to get punished and have more washouts. I think that's evidence of the market becoming more discriminating in who the winners and losers are going to be.
So after looking at those winners and losers, you mentioned healthcare as one of of the sectors, and certainly not the first person that's mentioned that to us as a potential opportunity as we start to see this rotation here. What do you think is driving that interest in healthcare? Is it more attractive valuations? Is it defensive positioning?
I think it's really what we see in the last earnings season is an inflection. The bar has been so low for healthcare stocks. It's not going to be that hard for them to beat expectations. But what we've seen in the last earnings season is an inflection. You've got leaders like Eli Lilly, that's now the first $1 trillion market cap stock in healthcare. They've got incredible demand for their product. In addition to all the blockbusters that they've released in the last 10 years, they now have. They're really owning the GLP-1 space. And again, if they can get supply online to meet that demand, I think they're going to continue to inflect higher along with a lot of other names in the healthcare space.
And do you think that healthcare's move higher will carry through into and through 2026? And if so, what parts of the sector look most compelling to you?
I do think it has room to run here, again, coming from a really low base. Again, we like Eli Lilly, we like Thermo Fisher. I think again with a Fed cutting cycle, that's going to propel more venture capital and investment into biotech. And Thermo Fisher is one of the names that benefits along with others in the biotech space.
Sam, we appreciate you taking the time to be with us on Black Friday and this last day of trading in November. That's Sam Miller, the Executive Vice President of Investment Strategy at CIA. And we've got plenty more to come here on Trading 360. Next, we've got the big three stocks, 3 charts, 3 trades. Rick Ducat will take us through the technicals, and Tim Bowen will be here to take us through the trades for GigaCloud Technology, Broadcom, and Kohl's. That's next on Trading 360 on Schwab Network.
Trading floor in the world. This is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute by minute breakdown of the biggest headlines, earnings, global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE.
Okay, I'm back. Oh, look at that run.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please. But Carl's Way is the best way.
Look at that run.
At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out of here.
Where are you going?
Schwab.
I'm back.
Schwab.
Anybody miss me?
Wealth management.
I took it to my vacuum repairman. Oh, Marley looks hot today. Girl. Let me see them fingers. I don't think she has a ring on them. So my vacuum guy that I've known for 20 some years retired. My vacuum repair guy, I had to go find a new one. Fred's on Kearney. And I remember when I first started my business, I brought in about 7 or 8 vacuum cleaners, and I bought this business out. So I brought all these vacuum cleaners in, see if we could repair some of them and get a couple of them to working good. I think I got 3 out of the deal. I brought it all in.
And then he come back.
So he said he can fix it. I said, good.
But he's talking, S&P 7,000, and it's like, what changed? Really, it's just kind of that too zoomed in at times. So it's still a big, major bull when it comes to AI, technology, and the overall market for sure. Especially going into 2026, rate cuts. I mean, Trump's just going to keep pounding these guys and force them to cut rates, whether it's the right decision or not. And the market loves lower rates.
It is the right decision.
Inspired by the tree behind.
They need to be cut, you idiot.
Your first pick today, I'm not as familiar with. I know they just posted a top bottom line beat though. GigaCloud technology. Does that tie into why you picked this one or something else?
Yeah, 100%. It's kind of funny. You didn't recognize this ticker when it showed up on my swing trade AI Wednesday. I'd never heard of this company either. And basically, I spent about 9 months kind of teaching the AI how to do fundamental and technical analysis. So basically, Wednesday, this ticker showed up, said, "Hey, strong fundamentals, strong sector, also a strong chart." And I looked at it, I'm like, you know what, I've never heard of this company, but I really like the fact that they're a computing play, kind of under the radar, big breakout Wednesday, kind of chopping sideways today. But I kind of like that when you think about, going back to a minute ago, all these names, everybody knows, everybody's invested in the Googles and the Metas and the Microsofts and all this.
You got a problem with that?
To see these strong charts on a name that you hadn't heard of, and until 2 days ago, I wasn't familiar with this ticker either.
All right, you said it has a strong chart. I'm looking at it. It didn't even dip off too much during Liberation Day. But, Rick, if we take a look at it, in the last 6 months, more than 107% for GigaCloud. What did the technical show us here?
Yeah, and just to give a little context first, B2B wholesale for large parcel items, furniture, appliances, stuff like this, mostly in Asia. So it's kind of like Amazon for wholesaling, basically, is what it looked like to me, to put it kind of in a nutshell.
You're a little late, baby.
34.35 was an intraday high point from right here. We tested that point again to give us this kind of range activity here with this being our ceiling. We had a floor that accompanied
Rick, look at the weekly.
Old high, subsequent low a few times here.
We just hit the right shoulder.
So 25 to about 34.45, 34.50. That was the range to watch here. We broke out pretty convincingly to the upside so far. Our pullback retested that level and held on. Now we can continue to climb. We made new intraday highs on a 52-week basis here, even though we are backing off a little bit from that open. We are within our channel still. We have our trend line.
I don't know. I think I'd rather wait.
You can potentially project where you might find some resistance here. One of the few tools you can use when something is making new highs to try to gauge where you might find some consolidation.
Now he's looking at it.
Or pullback opportunities. So now when we look here at RSI, our measure of momentum,
hourly.
bringing into the overbought territory.
Looks like the weekly.
Overbought RSI in a trending market here suggests strength. So bullishness here is how that would typically be interpreted here. Our moving average closest is our 21-day EMA, lining up with that trend line near about 32.50 or so to give us a bit of a confluence. When we assess our volume indicators here, most of the volume is really in this area, between about 27 to about 32 or so, the big clump of trading activity. That would be the supportive area to watch if we were to
3160.
Once again, plus 2 channel, standard deviation channel,
$33.
41.18. A snapshot at this point in time where you might
$42.
Resistance at that relatively extreme move.
And you mentioned that support levels right here where we're trading right now are 37.36 for GigaCloud. This next name, though, Tim, one pretty much everyone is familiar with. It's always a part of the conversation. Broadcom. Walk us through your thoughts here.
Well, this was an idea I shared with you guys. I can't remember the exact date.
That's one of them he was talking about.
Kind of just went into sideways chop mode, which, from a technical perspective, we like to see those areas where they just kind of that consolidation zone. So
the SPX dropped huge here.
Last month, and then big breakout. So, from a technical perspective, like the trading breakouts, and then basically
Not holding up. Ooh, yeah. We're at the 63.
And when you combine the technical
Three back crows.
and that's story stock. As you mentioned, everybody knows Broadcom, everybody knows the story behind it. So now you've got that kind of media exposure, discussion of it, it's kind of in the zeitgeist. So when people see these stocks on their breakout scan, they tend to chase and pile into them, which creates that continuation move higher.
And we did just see Raymond James assume coverage with an outperform rating and a $420 price target on Broadcom. So some potential move to the upside there as well. Rick, as far as that $420 price target where we're trading right now is below the $400 level. When we look at the technicals for Broadcom, are we moving in that direction?
Got a triple top.
Broadcom's been the strongest, perhaps.
Randy.
Maker names, maybe not a household name, perhaps, but an important one nonetheless. I would say this chart has kind of a similar pattern that we saw in our last chart, but actually looks even perhaps a little bit more bullish here. The reason
We're at support.
is we had our initial low here after our gap up from earnings near 332. Even though we did make some fluctuations below that point, we held on. But then our next set of lows was above those intraday lows. Similarly with the highs, we had our initial high point near 375, but then an upside breakout. So our highs were getting
$4.20.
getting kind of gradually very higher here. Now we're seeing another breakout here. 402.63 is where things topped out. Longer term upward sloping trend line is still in play as well. So now when we look here, our RSI study, a very gradual line you could draw going across these highs, suggesting a longer term slowing. I don't like that interpretation as much as I do of just looking at the shorter term view here. From here to here, I think is more important. If we make new relative highs
From here to here,
if we push back into the overbought area, that would be more of a short-term, more important signal, I would say. So that would be a sign of additional strength, as we said earlier. Notice that our 63 EMA lines up with our trend line as well, near 344. Finally, similar volume profile characteristic here, very big plump of trading, lining up with some of our supportive factors. That comes in around 345 plus one channel. 420, roughly lining up with the price targets that you mentioned.
Yeah, right now trading just
It was at 470 a bit ago.
Off that new price target. But Tim, this last one I'm excited to talk about. It was such an unexpected winner in the first part of the week. Almost meme-like movements to the upside. We're talking about Kohl's. I think they were up 53% just in the 2 days post-earnings. Really impressive report. Newly appointed CEO. Walk us through your thesis on Kohl's.
So, it's almost kind of funny to think back to the wild west days of COVID, but, as you mentioned, meme stock, as they called them back then. So we had a new CEO, big breakout, retailers.
Might hit the orb now.
I've shared American Eagle. Actually, last week's idea, Walmart. I couldn't believe Walmart's up like 10% from last week's trading 360, pretty wild. But you got that retailer theme, and then also the kind of meme idea. And this is one of those stocks that was one of those manufactured kind of gamma squeezes back during COVID. I watch a lot of these, Wall Street bets and X accounts, and kind of seems like they're trying to get the band back together, as they say, and squeeze this into the end of the year as well. So again, more of a speculative play. Very curious to see what Rick says about the chart. But I like this stock because of the combination of the retail story plus this kind of manufactured.
Two more here.
All right, Rick, I'm curious about the chart on this one too. Let's walk
I
through
am too, baby.
the info here. The last 5 days we're up 62.5%. In the last 6 months we are up more than 200%. So take us through the technicals on Kohl's.
Well, the squeeze is a lot more fun when you're the juicer and not the orange. This exhibits kind of the dangers of being, kind of too bearish in a beaten up name like this, because
she has a squeeze.
Breakout can be extremely energetic, and a stock could theoretically go up forever. So any kind of play would be risk definition would be something very important to think about.
Damn.
2139.
That's it, right.
We didn't even really stop there. We kind of just blazed through it, but that would be one point to look for potential support if we do start to pull back. Another level that sticks out is our low point after our gap up, 1937. We also had another range here, similar to our previous ones, 1825 to the upside, 1450 to the downside. Didn't actually test it that last time. It was an old high point as well here. So our trend line is so steep it's almost useless, but still something to consider. If it does get breached, we could see further declines here. 21-day EMA is our closest one, lining up with that old resistance level near 1825 could be a place to watch. RSI overbought, once again breaking through this longer-term trend line as well. So 78, quite a high reading. RSI only goes up to 100, 0 to 100. So that would be a pretty elevated reading here. Finally, when we look at our standard deviation channels to assess the relative extremeness of the move, I guess you could say, the +3 channel comes in at near 2550, so 3 standard deviations away from our fair value line, our linear regression line here. The +2 channel comes in at around 22. Those could be some short-term boundaries to keep an eye on here. It can be difficult to assess these things when it's having such an explosive move, but those would be some ways to consider those factors.
Yeah, and very interesting too to look at their chart. Pre-COVID, gold was trading up, in the $80 range. So to see the significant move to the upside,
let's go.
Trading at about 24.20. Interesting to put it in perspective like that. Rick, thank you for walking us through the technicals.
We got 420 and $3.
And Tim Bowen, of course, technical trainer at StocksToTrade.com. We will be right back with more Trading 360. Stay with us.
360. I'll stay with you. I want to meet you. Marley, when I first met you, I didn't know what to think of you. But you kind of grow on me. The average is at 340. I have one at 420 and two at $3. I'm up $30. Now I'm even. Ugh. Where did I put my key at? There we go, $4. We're at the shoulder line. This is a head and shoulders right here. You got your left shoulder, head, and you got your right shoulder. So what do? You hit the 63. 2 reasons to sell that trade, right? Say yes. $3.90, $4. It can break out, but you want to get out in the heat of the moment. Just like I did. from Washboardjim. I'm the thinking strategist behind the sneaky snake trading strategy, where I talk about chart patterns, moving averages, and being in the now. Damn it. Now they're at $4.20. Okay. Another resistance right here. The top of that first crow. At 440. 50. $4.70. We just hit the 50 SMA. Oh. Oh. Yeah, this is me again.
Yeah? What's going on?
I was going to say, that's just between you and me.
Alright.
The cigarette thing.
Okay.
Promise?
I promise.
Pinky?
Pinky.
Okay, bye. Goodbye.
What's the secret?
The cigarette.
Oh.
Okay, bye.
Alright, bye.
Well, heck, 520. Shit. Jim, did you just leave $300 on the table? Hey, yeah, I did. I left more than that, I tell you. 500, 300, almost $400 on the table there. Did anybody take that trade with Bobo? Did anybody take the trade with Bobo? No? Was I on my own? Hello, Sharon. Nice to meet you. For I'm Washboardjim. I talk about the sneaky snake trading strategy, where I talk about chart patterns, which was the 3 black crows, and the inverse head and the head and shoulders, and the triple top, and the yin yang, moving averages, and being in the now. And right now I'm going to go make some coffee and wait for Fred. When Fred calls, I leave again to go get my vacuum cleaner. So I didn't want to have to go out and buy a new vacuum cleaner, because them things, you're talking about $500 or $600. Fred's got a pretty good little shop. Oh, Nicole's up. Well, shoot. I went to 540. So we've got a yin yang. In case nobody knows what a yin yang is, when you have a resistance and then it pulls back and finds a support. So you just run that trend line all the way across. That's where I got into that add-on. Right off the orb. And we're bullish because we're staying above the orb. And then I sold it a little too soon, but this is a head and shoulders. And it looks like it created another head and shoulders right up here. So that's going to become your new resistance if this thing pulls back and breaks out and comes up. And we're going to draw that on there. Brings that up, and that will be almost a double top. Then you want to go ahead and put a double top on there. And use the body. So between that channel, then support will be the old resistance. When it comes back down and hits the 63 EMA, it bounces back up. We're at 410, so I can get back in where I got out at. I do believe we could hold this, or we could easily come back down again and hit this other support channel. What time is it? 11:42. So the market closes at 12 here. 45 minutes. So we're getting into the power hour. Okay, get ready. That's really probably the only support. That was a bad idea. I should have jumped in that. It did stop at that shoulder line. I got one trade in today. I'm halfway happy. Whew. Right there had been a pretty one. That didn't feel good. Go get my coffee. Hope everybody had a great Thanksgiving. George.
Bull call spread by buying the $200 call option, then selling the $220 call against it. So you have, 21st of December, every week of December. Now altogether, this would cost you about $8 a share, $800 a contract in debit. So in essence, the stock has to be higher for this to work. 208 is the break even by expiration. But I'm generating, if you do structure this trade, a trader would generate about 1.5 return on risk of $1. So the return is $12 on $8 of risk, and the stock has to hit 220 or higher by expiration. So for what it's worth, when you structure this trade, keep in mind that this isn't a stock that has made a trend reversal, but it could possibly do that as the news kind of rotates, and maybe some money rotates back into this name as opportunistic buy for institutions.
All right, we're about $20 off of that level right now, 201.35 right now for Oracle. George, thanks for being with us today. Have a great weekend. Now it's time to spotlight Black Friday, of course, our biggest shopping day, busiest day of the year. Joining us now to help us do that, Owen Carr, Chief Merchandising Officer at Spreetail. Owen, good morning to you. Thanks for being with us. I'd love to just start with, what this weekend's expectations are in terms of spend for the overall holiday.
Hi, hey Marley, good to be with you. Yes, I think overall we are expecting this to be a record holiday performance, over $1 trillion in sales, which should be the highest that's happened in the peak 12 event. What we're seeing right now is that consumers are out shopping, but they are a little more cautious, and I think the retailers have done a good job of stretching out the shopping window. So historically, we've had a Cyber 5, and now we're looking at a Turkey 12 event.
They say that every year. The retail trader is going to be more cautious. They said it last year. They said it the year before. It gets old after a while. They don't know what they're saying. I think they're just kind of psychologically trying to freak you out. I don't go way out of my way any Christmas for anybody. I used to when I had a girlfriend. But I don't have the big budget for Christmas. I usually just give it all year round. I think I did the shoebox thing already. I donated for the house. And both of them are going to third world countries. I don't think anybody here in the States is worthy of it. Unless you're in favor of Trump. These were at $4 and they went to $5.10, $5.20. I think actually they might have been cheaper than that, but what I saw $3.90, $4 on that last pullback. Oh, we got an hour and 9 minutes left. Randy's back. VG took off. Oh, it did. Sure enough. They got a price target to $10 on it now. They lower the price target to 10. JP Morgan. There's your ascending triangle on SPX. I'm going to go get my coffee and I'll be right back. The guy's going to fix up my vacuum cleaner. There's 540 out of double top. Double top resistance. It was a good call. Go check my coat. My mom and sister are real bad cigarette smokers. So when I got back in my car to come home, I said, God, my shirt smelt, my jacket smelt, my vest smelt. So I've always took my jacket to the cleaner, and now I've got it in. This is the first time I think I've ever washed a jacket, ever. I just took it to the cleaners just about a month and a half ago, 2 months ago, for the winter cleaning.
It certainly does. Even before the shutdown, we were short 4,000 controllers. And in addition to the havoc that
oh hell, that'd be a mess.
It makes it very difficult for airlines.
Short 4,000 controllers? Are you serious? How can that be? That don't make that 4,000 controllers. That's a lot. What is a controller? Airport controller. There can't be no 4,000. Unless they're baggage people. Air traffic controller monitors and directs the movement of aircraft on the ground and in the air. So that's the people that are out there doing the flashlight thing. And 4,000, that's a lot of people. Job requires a high level of concentration, quick decision making, and adherence to strict and physical and mental fitness standards.
That only adds more strain to the system.
And David, with the strain that we have in the system, but knowing that we're expecting more than 31 million travelers just in the airlines alone during the holiday season, what's your outlook for the rest of Q4?
Oh, good question.
Well, it's not going to surprise me to see, a couple of fee announcements as we go through Q4 in here. The one thing that we're seeing here is that even though there's obviously demand, and the legacy carriers are best positioned to deal with that, United and Delta, there's price sensitivity out there. Goldman has a survey out right now saying that they're expecting, fares to be down about 8% year on year.
Dow had a 5-day run into Thanksgiving.
A consumer that's price sensitive, almost by definition. They're willing to spend, and I call it the lipstick effect, they're willing to spend on experiences, but they're very price sensitive and they're shopping for bargains and they're likely to get it.
And with that, fares are down roughly 8% year over year, Magna, despite us seeing some record volumes. Do you think that that's simply supply catching up with demand, or is this a greater sign of what David's saying, that customers are just much more price sensitive now and they simply won't book unless they like the number?
Yeah, so I think generally there's a bit of seasonality to it as well. This is typically not the busiest time of the year for airlines. I mean, now that's been beginning to change as people sort of change their vacation patterns, but historically the month of December is not very busy for airlines. It's mostly fueled by business travel, the profits there. So I think there's definitely an element of that. And I think also just for the past year, airlines have been cutting down domestic capacity quite a bit just because it's been underperforming a lot more compared to international. And that underperformance, I think, can be explained again by having those more price-sensitive travelers. They've been pulling back their spending. I think there's also been some impact from the tariffs among that cohort of travelers as well. So we've been seeing already that pullback that was happening before those government-mandated flight cuts.
And David, we're starting to see the industry seemingly split. Some of the carriers, emerging as winners, others emerging as laggards. I know you mentioned United; they're certainly one of the winners. Delta potentially the other. Some of the others struggling to keep up. Why do you think that these two are positioned to outperform right now over the rest of the major air carriers?
I think a lot of it is long-haul international. That's the more profitable way to go. They also have deeper pockets. Right now, the competition for cruise is very high. A senior captain can make well over $500,000 a year. I have friends of mine who are in the industry, and they hop from one airline to the other. Some are getting as much as $250,000 signing bonuses just to change carriers. I don't know that some of the smaller airlines can keep up with that.
Well, I might be in the wrong business if that's the signing bonus that they're getting, but I appreciate both being with us to talk holiday travel on this very busy holiday shopping day on Black Friday. That's Megan Montgomery, Chief Airline Reporter for Skipped, and David Nelson, the Chief Strategist over at Bell Point. I also want to thank all of you for joining us on Trading 360 today. I'm Marley Caden. You can download the free Schwab Network app available in the Apple App Store and tune in 24/7 on schwabnetwork.com. Fast Market is coming up next on this shortened trading day. Have a great rest of your Friday.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on ETFs.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December 11th, 2026 Market Outlook,
that's what
your
matters.
guide to forces shaping stocks, global markets,
Okay,
inflation,
I'll be
rates,
up in about
and
an hour
more.
or less.
Hear from experts on where the markets may be
Yep,
headed,
bye.
spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m. Eastern on Schwab Network.
I'm Deb Lannis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Fred did me good. Fred's vacuum on Carney.
Our rally on Wall Street, of course, today is Black Friday, and we'll keep our focus here on the U.S. consumer and a lot of the shopping that has already begun. We'll take a look at some option strategies for names like Walmart, like Folio will join us to take a look at consumer sentiment, and key names like Amazon as we take a look and dive into the charts of Shopify. So that is our roadmap, and we are seeing some good trading action, and I bring in my co-hosts, Tom White in our Chicago studio, and Joe Mazzola, head trading derivative strategist at Charles Schwab, also joining us. It is great to see you both. Well, the Grinch has left, and he was upset that we had all up arrows today. He wanted to come on a more Grinchy day. Joe, I was going through some of your notes that really were talking about the market breadth and 55% of the S&P 500 above the 50-day moving average, and so much more that went along with it. I do want to talk about the CLE outage, but a big picture market thought, Joe.
Yeah, I mean, well, number one, it's hard to follow the Grinch, so I'll do my best. But number two, even after I sent my notes, we're seeing even further expansion. It's up to 58% above the 50-day moving average. The weekly advanced declines I think are interesting, and be mindful of the fact it's a holiday short week and there's a little bit of volume. But overall, it's about a 7-to-1 advance to decline on the NYSE, which is a little bit of a broader scale of the overall market as opposed to the S&P 500. So it's it is rotating in different sectors. I think it's definitely a cyclically based rally where you're seeing financials outperform, materials outperform, discretionary. So there's movement kind of below the surface that's supporting this overall rally as we head into the end of the month. And it is starting to kind of lift all ships, and it's showing some strength and it's building strength as we speak.
And you noted how 7 of the 11 sectors were above the 50-day moving average. You talked about healthcare, 80%, utilities, and energy, 68%, materials, 65%, and financial, 61%. I saw those in your notes, Joe, so I cheated and I used them now. I wanted to ask you, Tom, the rich is my best friend. I'm up to anything here today. Tom, some of your thoughts. I would say how we started out this morning with so much uncertainty when we had the CME outage and we couldn't see futures.
Yeah, that was kind of an odd thing, right? Data center went down for over 11 hours, so you didn't have anything trading overnight. But then again, at the same time, this is typically a low volume day. We don't get a lot of volatility, a lot of movement on a day like today. But I think just kind of harking back to what Joe said, it seems like the sentiment has shifted, right? As those expectations of a Fed rate cut in a week and a half when they meet. It's basically 87% probability at this point. So anything typically above 65%, and it's a go. And that's lending a lot of support to the equity market. Now, we've gotten through a lot of those headwinds, whether it was the government shutdown, whether it was tariff concerns, inflationary pressures have been pushed to the side as data's been coming out delayed and kind of ignored at this point. But I think one of the keys is earnings are helping support this risk-on type of mentality that we've seen since hitting those lows about just over a week ago. 5 straight sessions in the green. S&P 500 now positive just slightly for the month of November. So that volatility is gone. A lot of the concerns are gone. You're in a rate cut cycle that the Fed is putting into place here. It's kind of alleviating any of that earlier volatility that we saw in the overall equity markets. And I think one of the keys is earnings have supported this rally.
Yes, they have.
Kind of look for maybe an outlier that, hey, why do we keep rallying? Why is this the most hated rally that we've seen in years? Well, the earnings are backing it up.
It's not the most hated rally. Just you fat cats think it is. I think it's the most beloved rally that we've seen in 4 to 5 years, if you want to know the truth, especially when you cut back on government spending.
And look, we had guests on today who was talking, Phil Rosen, who was talking about the likelihood, being more likely than not, to see a Santa Claus rally the last 4 days and 2 days into the new year. We take a look at some of the semiconductor names. For example, the SOX is up 9.5% this week or so. So that obviously has been a winning trade. We've seen upside calls pushing towards the chip stocks, names like NVIDIA and Marvell will report on December 2nd. But a name that really
December 2nd, NVIDIA?
is Oracle once again. I mean, this was a name that was
Is that right?
45 right now. It's trading at 201.
They just had earnings.
And the S&P 500, and of course, looking here to fund $38 billion to finance OpenAI data centers. And that's in addition. So this brings some questions, and it was a darling and moved as high, but it's since pulled back. Your thoughts, Joe, on Oracle and or some of these tech names?
So it wasn't Oracle that kind of kicked off the whole going into the debt markets to fund the AI trade, but they're getting the most attention because they're going back. And what's interesting about this is, look, investors have been willing to scoop up that debt. It's not like they're finding a hard time finding buyers for their debt. They definitely are. I think the difference though is that the first year and a half or 2 years of the whole AI trade was really funded with cash from operations. And we were talking about companies that had, sparkling, sterling balance sheets that had billions of dollars.
Coin pulled back $7.
Cash to fund operations to fund this expansion and this buy into AI and with chips and data centers, and they were doing all that on solely from cash from operations. Now we're talking about changing and looking to going towards the debt markets, and that kind of changes this weighted average cost of capital a little bit, doesn't it? So now, the street is kind of looking back at these companies and they're saying, okay, well, what is this company really worth now that they're taking this debt on the balance sheet? Do we need to kind of recalibrate their worth going forward now that we understand that there's a different cost of capital that they're applying to that leverage ratio? So to me, it's I don't think it's the end of the Oracle trade, but I look at it as the markets are responding and saying, this was something that we were rewarding you for your growth because you weren't adding additional debt on the balance sheet. Now that you're doing that, we're going to have to kind of recalibrate a little bit on what you're saying.
And so, what's interesting, I'd like for you to expand here, Tom, on what Joe's been saying here about not only Oracle, but the debt financing, the circular funding that we've been seeing that really brings a lot of question marks because it's unprecedented, Tom.
Yeah, and the cost to carry this debt, there's some warnings.
Good question.
Morgan Stanley came out with a note on that these are the worst levels since 2021 for Oracle. They could continue to rise that insurance on this debt, and that could get up to levels we haven't seen since the financial crisis in 2008. Those are concerns. And I think one of the biggest, stories and why this stock has pulled back over 40% from those all-time highs that we saw just in September. Remember that $300 billion, deal with OpenAI. Everybody wants to partner with OpenAI. Everybody's going to do well. Well, now there's some concerns that maybe some of these deals, some of these partnerships aren't going to come to fruition, right? How is, OpenAI needs to raise $230 billion over the next couple of years to help finance a lot of these partnerships. And will they ever get done at the levels that they've already announced? That's going to be a concern, I think, for investors when you're taking on debt, even though you've got rock solid balance sheets like Oracle. It's one of the smaller hyperscalers, and when you see this, when they're taking debt, it still raises some red flags, I think, for a lot of investors. Even though this might not matter in the long run, but right now it does, just due to the fact that the build out that they're doing, and the amount of money that they're spending at this point has yet to be monetized. When you look at their RPOs, which is at $455 billion, $300 billion of that is from OpenAI. So, their RPO, the remaining performance obligations, jumped up after that deal was announced. But now you have to start wondering, hey, are these connections going to pay off for Oracle in the long run?
It's interesting, they talk about monetization. I had a great conversation with Jen Ives yesterday, who of course is saying that it's NVIDIA's world and everybody else is just paying rent. So he still continues to push NVIDIA as the greatest, but likes all the Mac 7 names. Yesterday I did ask him about revenue generation. I said, listen, people want to know when will revenue really be generated from all this CapEx spending that we're seeing. They're getting a little frustrated, and it's coming the day of truth. I mean, when do we see it? And he actually said 2026 will be the year of monetization. I mean, he said we're already seeing it with Meta, but he felt pretty confident that 2026 would be the year of monetization. Let's get to Warner Brothers and the takeover that we've been seeing. Obviously, it's up to the bidders, and now we may be seeing some better offers. The game players here are Comcast, Paramount, and Netflix. And now the New York Post is reporting that Comcast is considering to enter the second round of bidding. And we've seen Warner Brothers, of course, jumping in a big way. Warner Brothers, 3 months is up over
That's COMQ.
Tom, I'll start this one with you.
Yeah, the cycle continues. The company basically came out, Warner Brothers Discovery came out and said, sweeten your deals. They want more for their catalog. And then you start looking at the bidders, right? Paramount, Skydance, they're supposed to be in the lead, right? Comcast is the dark horse, and then over in the corner you got Netflix with a bunch of free cash flow and a bunch of subscribers kind of waiting in the wings. Where I think they just want the content portfolio that Warner Brothers Discovery has at this point. So maybe they're not one of the leaders in there. But when you've got those assets, remember that's what matters. And I think that's what they're probably going to play hardball. We'll probably find out something by Christmas what type of deal, but when these companies start looking at how they're going to pay for this, are they going to take debt out, are they going to try to pay cash, are they going to use stock, what are they going to do? That starts to get in the weeds a little bit, but eventually they'll probably get something done because the company has stated that they want to sell themselves or create that partnership. So yeah, Comcast, Dark Horse, I think, and Paramount, Skydance still in the lead.
Look, Paramount's most recent bid reportedly around $25 a share for the entire Warner Brothers Discovery. That was up from its previous $23.5 a share. That would have been a $53.8 billion offer. And now apparently Comcast is reportedly looking to dig deep into the pockets, Joe. And this is due date December 1st. So this has to come out. And the report saying that it would submit an offer of $27 to $28 a share, 66.9 billion to 69.4 billion in value, according to the New York Post. Your thoughts, Joe?
These are all big numbers, aren't they? I mean, it's interesting. Think about the real estate market. What do you
Wow.
Multiple bidders, right? So now you have a company that has multiple bidders, and to a certain extent, they're getting really high premiums for the value of their assets. So it'll be interesting to see how much of this is a cash offer versus more debt. Is we've been talking about that the markets aren't looking very friendly upon high debt yields right now. So
This is cool. I was sitting here and I was looking at my morning call out here, and it said right here, explain this post. Push the button, and the post features a trading view chart, which is false, of the SPY. Identify key support channels of 675.84, which I put on here. 675.84, 678.15, and then it turned around and 679.64 or 681.53 with overhead resistance at 682.49, which I put on here, suggesting potential breakout opportunities for day traders. Posted pre-market on Black Friday of 2025. The SPY opened at 677.63. Right here down at the bottom, which I didn't really pay no mind to, but that's what it did. The SPY opened at 677 and closing at 681.59. November 26th. I think that's pretty cool. I mean, it took my numbers. It didn't even, it saw it on here. I didn't type it in. I'm impressed. I really am. In case anybody has a Twitter account, I'll put my link in here in the room and on YouTube. But I have to say I'm quite impressed with that. Aren't you, Randy? I thought you called me dear.
Black Friday starts and kicks it off where we're expected to see some improvement year over year. We'll go through it. We'll be right back here on Fast Market.
I mean, that modern technology's got me buzzing right now. Do 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 do. Huh.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to
I'm
help
really
you develop
impressed.
a deeper understanding of
Technical analysis with Twitter. I mean, huh. Okay, my calls are now at $3.10. We're going to come back and hit the VWAP on the /ES. Oh, that's a SPY. Let's look at the /E. Oh, here we go. That'd be the 200 if we don't hold this support. SPX. $68.45s. We come down and hit the VWAP once before. So if we come down and do it again, I'm jumping in. That or I buy one now and buy two later. Let's buy one now. Might not have to, might just wait. $2.70. 2.75. Okay, I got two at 275, and if we dip down and hit the VWAP, I'll buy four more. Fred fixed my vacuum cleaner within an hour. He put new blades on it, he put a new plug-in on it, and he done something else. For only $35. I said, I'm paying you $50 for going the extra mile. I might even give him $75. What the hell? I feel generous today. We're at 3:30. Randy. Jim, will you show me where resistance is? Hello? Show me how you draw resistance to break on that chart, Jimmy. Well, you take your... Right now, you could get out at 340. You run that, hit that right there, We're going to make a channel of resistance. And you bring it on down. So now you're at 340. You're close to that channel of resistance. And you're above the 63. So you make a business decision. Because you're at a resistance level. You don't want to hit it. Don't ever count on hitting something. Get out before it hits it. So I can sell these at 330 right now. That's $55 profit. Or I could sell them at 350. And that's a lot better profit. This is a hammer, so that's bullish. But we're getting close to the end of the day. We got 33. Oh, there it is. 370. I'm up almost $200, and I'm see, extend that up to the right. We just hit resistance. Look at that. How in the hell did you get it to the penny, Jim? Well, it wasn't hard. But I'll take it to $150. From Washboardjim. Are you impressed, Sharon? Say yes. Oh, she left. Right when I asked her to say yes. Part-time, are you impressed? Say yes. Oh, that was to 350. Not to 250. So on a mediocre day, now we're coming back up. So we have one of them, 2 bits, but this one didn't hit. Only the wick did. So maybe we get back up here one more time and break it on number 4. And we got an inverse head and shoulders. Close to a double bottom, high or low. Okay, here I go again. The calls are now at $2.30. Jim, have you ever... Oh! $2.20. Right off the 200 EMA. 270. How in the heck does he do it? On the Run is impressed. Welcome to the room, On the Run. I want to see if I break out of this flag. This is the 200 EMA on the 1 minute. So you got your channel. Let's see if it's coming back up. We could come down and hit the 200 SMA. They're 255. Not sure what's going on here. It's kind of just sitting here. We've got a hammer, 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 and a spinning top. We need a big fat candle and I sell it. Boom! Woo! 270. 5. 270. Now we want to break the pivot point inside of this channel. And if we break the 9, I can get out now with 270. 5. But I want to see if I break the 9 and get this up to like 3 1/4. There's 295. $3. Oh shit. Uh-oh. Uh-oh. $3. Profit. That's $80 a contract times 5. What should I do? Jim, I'm your next door neighbor, and I was watching you on YouTube, and I heard you called out this trade down at the 200 EMA, and you just hit resistance. Well, I took the trade, and you run it to the 63, and I got out at $3.10. I'd like to know if you want to come over and have dinner tonight, and make sure that you're wearing your pajamas. out at $3. Where'd Rob go? Rob, where did you go? Rob left early? Rob, don't leave. The prison guy's on.
Free retailer is up, Amazon up 6% is at the bottom of the list, and that's simply because of the law of large numbers. Normally, we would see Amazon plus one.
So you had Wenham, Tubits, Wick, and a freebie. 1, 2, 3, 4. It's either was going to break out there, and you had like a minute and so to make up your mind to get in and out of that trade. And we got 22 minutes left. Rob, you left. Now you came back. Did you not like my imitation of the neighbor? She said I could come over in my pajamas. I'm going to take her up on it. Oh, you didn't hear her? I'll show you what she looks like. Ain't she gorgeous? Livid Goose is back. We're at the 200 SMA here. Here we go again. I love days like today. Shall we do it? They're at $1.45, $1.50. Let's do it. Let's do it. I think so. 1.50. This is my Black Friday special. At the 200 SMA. Black Friday special. Come on, baby. Oh, 135. No. That wasn't supposed to work out like that. We're at the bottom of the channel. And 25. 150 and 125. We're at 160. $170. Very good. Oh gosh, it's 8:43. So far we got higher lows off the 200. So this has to hold right here. This candle above the 200 would be better. Yep, it held it, but this one didn't. Okay. No, 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 no. See if that candle holds above that. We're still safe there, but if it goes below that, I got to get out. Maybe. It's hard to stay in a losing trade. Dow Jones up 241, NASDAQ up 102, S&P up 21, and the Russell up 8. And the closing green. We had the VWAP over here off the /ES. Oh gosh. These things are dying. Mm-mm. Hmm. 13 minutes left. I think I'm kind of praying right now we get a bounce here. We got to see, George.
In the past, one of the things that they've been doing is expanding their footprint and partnerships with major
shop. There we go. Woo! Okay, that's plenty. I don't want to get greedy here. 170. Watch me sell it and boom, another one. Woo! I'd say I got lucky. Boom, baby. Ain't that pretty? Well, thank you, Bobby. Oh, very nice. Now look at her fly. definitely depreciated. Okay, I'm done. I'm done. Oh. That's not cool. And Florence's birthday today? Oh. Another shot up, but premium didn't bounce up with it. Oh gosh. Well, I'm going to get out of here and get my brand new cleaned up vacuum cleaner from Fred. I'm going to give him a $20 tip. I want to get in good with this guy. He could be my new guy for at least until I get ready to retire from Always Clean. Might just walk through Walmart and see all the idiots in there shopping. Look at that. Boom. Yeah. $2.01. Well, that's Google. Boeing bounced up. I called the bottom on Boeing. So this is SPX. I'm going to show you a couple things on this chart. Kind of help you out. The 68.31.47 is called a pivot point. That's when you have a support level below it and the resistance above it. So we came back and we pulled back and we hit that pivot point on the chart. Then we bounced up. Then we came back again and created what you call a bull flag. That's a bull flag. This right here is the yin yang, where you have the resistance and the support level from earlier today. Now look at that thing fly, 285. So we came back and we hit the pivot point on this first one, came back and retouched that yin yang, and then we came back here at the end of the day and almost touched the yin yang again. So it's a very important support level to recognize. Now we're at $3.20. So this is called a bull flag. When you're going up, and then it comes back and it creates a channel. That's what you call a snake. So we had a big engulfing candle. I didn't know it was going to do this. We're at 450 now, 460. So usually you got all fat cats sitting out right now. This is mostly done by retail traders. This is a short week. This is a short day. It's a holiday. So when it comes time for next Thanksgiving and on that Friday, remember what happened on this Friday. And it usually is about the same every Thanksgiving. And the same thing will happen on every big holiday like this when you're open like a half a day. So we're at $5. $1.38 to $5 to $6. Just write it down on your calendar and remember it. Remember the holidays and remember they have what you call Santa Claus rally that happens during the last part of the year. And we could be having that rally this week because this month has not been that good. And we've made it all back in 1 week. It's been a good month for me. Randy said he had one of his best weeks this week, I think. One of his best days. Didn't you say that, Randy? So it could have been, that's why I say don't ever give up when things are really looking bad. And learn to size your position so you won't get hurt too bad. But this trade right here, this went to $6. But that's a bull flag. It's all about chart patterns, moving averages, and being in the now. Why did I pump? Uh-oh, now I got somebody in the room mad at me. Well, it's over. The day's done. I'm going to go pick up my vacuum cleaner. I wish everybody a great weekend. We'll see how Monday turns out. Don't listen to a lot of this rhetoric you hear from these guys, these analysts. They're hardly ever right. They are. I mean, I don't know where they come from or how long they've been at this job. But I guarantee you, I've traded more than probably 3/4 of these idiots on this show. Or not on this show, but most of these young pups that come in here. And Sam's showing cleavage. Look at that. Girl. Navidier. Hey, get your eyes off her breast and let's get talking about stocks. Okay, well, I'm going to get on out of here and shut this thing down. Now I'm out of here. Uh-oh.
Thanksgiving Day, the best of the year. Friends, family, football will stand up and cheer. A day to sit back and give thanks and praise. The start of the season for the holidays. So pile up the turkey, mashed potatoes and stuff, and forget about the vacuum cleaning and dusting. Leave all your drama, swearing and cussing. Today's your reward to sit back and do nothing. We're giving thanks and praise. The start of the holidays. Load up a plate, sit down and say, hey, we're gonna do
nothing. Yeah. All right. Thank you, Livid Goose.